Hello. Hello. Sure. Sure. Very good morning, everyone. How are you all? Super fine. Okay. Now, last class we almost completed India's 116. Only one concept is left. That concept I will do at the end of the day. We will start with a new chapter, that is financial instrument chapter. Before that, any doubt in MCQs? The two doubt came to me. First come to India's 1 and 5. This doubt is once again question number 8. Once again doubtful only. Let us read the question. The company has sold certain item to a customer with after sale service for a period of 2 years from the date of such sale. The company has sold certain item with after sale service for a period of 2 years. So sale warranty services or sale services, after sale service means warranty services, was after 2 years from which date? Date of such sale, that is 1st October 2017, without any additional charges. The total amount payable by the customer is agreed as follows: 8 lakh if paid by 31st Jan 2018, 8 lakh 10,000 if paid on 28 Feb 2018, and 8 lakh 20,000 if paid by 31st March 2018. Based on the past experience, it is highly probable that customer make payment before 28 Feb. Means, can I say, as per the past experience, this will be the transaction price. The standalone selling price of the product is 7 lakh and 2 year service offered to the customer is 1 lakh 40,000. Means 8 lakh 10,000 will be allocated to product and service in which ratio? In 7 lakh and 1 lakh 40,000. So how much it is coming? 8 lakh 10,000 into 7 divided by 8.4 is equal to how much? 6 lakh 75,000 minus 8 lakh 10,000, how much? That is 1 lakh 35,000. Correct. How many transactions are included? So there are two transactions included. Means two performance obligation they asking. Correct now. So two performance obligation. Now sometimes they ask give brief reasoning for your choice. So of course you can say that these are two separate performance obligations because the goods and services provided are distinct. Correct now. You can add on that reasoning sale of item include. They have not given that much reasoning, but okay, chalega. Now what is the amount of revenue? The amount of revenue to be considered for revenue recognition will be what? It will be what? Amount of revenue means they actually this should not be amount of revenue, amount of transaction price should be, because revenue should be depend upon the two performance obligation. Correct now. So it should be what? Transaction price. What is the amount of transaction price? The transaction price should be 8,10,000. 8,10,000. Okay, sir? Yes, sir. Then what is the amount of revenue to be recognized under IND AS towards the sale of product? So what we have calculated? 6,75,000. This is simple. Now doubt came in point number 4. What is the amount of revenue to be recognized under IND AS towards the sale of service as per the terms of contract with the customer? Give brief reasoning of your working and your choice. Now the question is that, of course, from the question it is understood that control was transferred on which date? On 1st October only, because it is not given, anything is not given here. So control was transferred on 1st October. Correct now, because from the date of such sale. So from 1st October will count 2 years. From 1st October will count to date 2 years. So 1st October, it is October, November, December, January, February, March, 6 months. This 6 months. It means, can I say, if the amount allocated 2 year service is 1,35,000, we will recognize how much revenue in the first year? 6 months. So 1,35,000 into what? 6 by 12 is equal to coming how much? 67,500. So I think the answer should be this. But they have calculated revenue from 28/5. They have calculated from 28/5. So of course, from my point of view, 2 year warranty services or after sales services will be started from 1st October, not from 28/5, not from 28/5, but they have calculated from what? 1 month. So if you calculate 1 month, what is the answer coming? 1,35,000 into 1 divided by 24. Now 5625. Acha, we have also done 1,35,000 into 6 divided by 24. As per my answer, it should be what? 33750. But this is the question I have taken from GFRS material. Means there was in old scheme there was one GFRS. So this question I have taken from ICAI resource only. So this is not my question. This is not my solution. Okay, got this point? What I am saying. So what answer they have given? Their answer is what? What is their answer? 5625. So they have taken 1 by 24. But from my point of view, it should be 6 by 24. And that is same doubt came. The student is also saying it should be what? 6 by 24. I think one of the students already asked me doubt in face-to-face class. He was also saying, sir, it will be 6 by 12. So from my point of view also it is 6 by 12. So let me go through the once again the case study. This question is a part of a case study. It is quite possible in that case there is some more point was given that I have not mentioned. So I'll go to the case study once again. If there is some changes, I will make it. Okay. But as per this question, means if I read this question, answer should be what? 6 by 24. Correct now. But this question I have taken from where? Understood what I am saying? So they are working, what they working? They are working, we see, they have done what? They have done what? 12 months. This is what? 5625. Means they have done 1 by 24. Okay, chalo theek hai, but chhod do. Will not fight for this. Will not fight for this. So what is the deferred revenue? As per this solution, what is the deferred revenue? 1,35,000 minus, as per this solution, minus 5625. So what is the deferred revenue? 1,21,375. Can you say out of this 11 by 24 will be current? Sorry, because it is 24 minus 1 means 12 by 20, 12 by, because this will be for how many months now? 23. So 12 by 23 will be what? Current, because that will be adjusted within 12 months, and balance will be what? Non-current. So they have asked what is the current and non-current portion. So what is coming? 1,21,375 into 12 by 23, how much? 67,500. And what is 11 by 23? 61,875. Correct now. So this is the B is the correct option. So good question. It was a good question, but doubt came because of what? Understood? 1 by 12 and 6 by 1 by 24 and 6 by 24. So it is quite possible if the control was transferred on this date. Means if the control was transferred on this date, then the answer is what? If the control was transferred on this date, then the answer should be 1 by 24. But by reading this question, it is given date of such sale. Nothing is given. So of course, we'll assume control is transferred on which date? On the date of delivery only, not on the date of payment. Chalega. So that doubt came, genuine doubt. Will not fight for this doubt, because that, and now smart work is what? That option is not given. Check karo, but none of the above is given. Understood? तो थोड़ा सा confusion होगा. It is not sale on return basis ना. Sale on return basis totally different. Where it is given sale on return basis. Sale on return basis is totally different now. Then to we recognize revenue only to the extent of what? The amount we are expected to not to be returned. So if that is the point, then to will not recognize only what? That is totally different. You have understood the emotions? Okay, will not fight for this. I am saying will not discuss on this. Okay, na? But of course there is something lacking in this question. So of course in exam when they will ask you this question, they will modify it or apply your common sense. We have discussed now. The same to same question will come. So just highlight it now. That on MRQ. Must revise this question. Because this question is of ICAI resource only. Can be asked in exam. Okay. MRQ. We always follow ICAI solution. Okay. We always give respect to ICAI solution. But doubt is there. Okay. Chalo. Now. Come to question number 13. One more doubt is there. Gamma Limited sold a machinery for rupees 9 lakh to a new customer. To get into the long-term relationship with the customer, the terms of sale also include after-sale service to be provided for the next 3 years free of cost. The company also sells the sales service contract separately, where the customer buys it after the initial warranty period at rupees 1 lakh. How should the revenue be recognized in the books of account for the sale of machinery? Correct. It means, can I say what is the transaction price? 9 lakh. What is the standalone selling price of product Z? 9 lakh. What is the standalone selling price of warranty services? 1 lakh. So this 9 lakh will be allocated into this ratio. That will come 8 lakh 10,000 and 90,000. So 8 lakh 10,000 will be recognized in the year of sale when the control is transferred, and 90,000 will be spread over next 3 years. This, I think there is no doubt in this. In this is no doubt now. I think no doubt. It is simple only. Chalo theek hai. Then one more doubt came in days 1 and 5. Question 13 already I have done. Means what they are thinking now, 9 lakh minus 1 lakh they have done, I think so. They are doing 8 lakh and 1 lakh, but that option is not there. Chalo theek hai. But this is only correct. We'll allocate in the ratio of standalone selling prices. Okay. Question number 15. Please explain with an example. Question 15 में आ जाओ. Where the penalty is inherent in determination of transaction price of the contract. When the penalty is inherent in the determination of transaction price of a contract, itself part of what? Itself part of variable consideration only. Correct now. Means penalty is normally what happens? Penalty arises when some condition is what? There. Suppose you are not able to complete in time. Suppose we have done one contract, and as per the contract, I need to pay penalty to you if I am not completing the syllabus on time. So that is contingent, means that is fixed or variable. That is variable only if nothing is given. It can be fixed also, but penalty normally does not remain fixed. Amount is fixed, but it is dependent on some outcome, future outcome. Therefore, it will be variable consideration. Chalega. Answer number 2. Example also I have given. Say thank you to me. No, you not. I am asking to Asoria. Question number Ind AS 116 question number 12. First let me complete Ind AS 115. Ind AS 115 question number 1. This all doubts are common doubt, huh? Question number 1. M is eligible to a zero interest rate loan of 96 lakh corresponding to 11,000 shares. Zero interest loan of rupees 96 lakh corresponding to 11,000 shares. Loan वाला question क्यों आया? M can avail the loan at any time during the period of 1 year from the date of agreement that was signed on 1 June 2023, subject to being in employment of the said term. As required by the term, M makes an upfront payment of a commitment fee of rupees 1.65 lakh. The loan will be provided under a separate agreement. It is not possible to obtain the fair valuation for this loan commitment. I think this question is actually based, it is actually my mistake. It is a question of what? Ind AS 109. So today I will do financial instrument chapter, then you do this. So question number shift from what? 115 to what? Ind AS 109. This is what? Okay, understood? Copy paste mistake. So this question is a question of what? Financial instrument chapter. Therefore you have that doubt. So we'll do this question where? In you again ask me this question when I will complete what? Financial instrument chapter. Okay. You should also understand that this is not a question of Ind AS 115. Then coming to Ind AS 115. Any doubt in Ind AS 115? You have? Yes, question number 18. So come to question number 18. Entity shall account for a contract modification as a separate contract when both the conditions are satisfied, both A and B. The scope of the contract increases, okay, and the price of contract increases by an amount. So both the conditions are satisfied. Both A or B. No, either A or B. Both. This is type. 1 second. This is what? You need to understand the emotions of the question. Both A and B should be there. So this is what I will say. There is some typo mistake. It should be either A or B, so not correct. Only A is not correct. Only B is not correct. So what is the answer correct? Both A and B. It should be A and B. You are good in English, but they are not good in English now. What can I do? You need to understand what? The emotions of the question. I always say in my class, understand the emotions and don't fight with the question. There are two things. Understand the emotions of the question and don't fight with the question. Respect the information given the question. If you'll fight, you'll be wasting your time now. You'll be wasting your time. There is no none of the above. So best option is what? Both. So don't fight with the question. Chalo. Any more doubt in Ind AS 115? Any more doubt? No doubt? Chalo. Intensely, because when I was also thinking, the same doubt came to me, but that time I have not changed the question. I don't want to change the question given by ICAI. I just want that question only, because if you do that type of question with some wrong information, then you will understand the emotions of the question. If I will change, but in exam the same question come A or B, then so I don't change the question. I don't change the solution also. Are you getting what I am saying? I could have changed the question now, but I don't change the question. Then Ind AS 116 में आ जाओ. Ind AS 116 I have done yesterday only. Doubt came. Good, right? Ind AS 116. Question number 12. Achha, answer is not given because of that reason doubt. Question number 12. SA Limited has taken a building on lease from RA Limited for 10 years to operate a restaurant. As per the contract, SA Limited has a decision making right regarding all the operations and usage of the restaurant. So SA Limited has a decision making right. Decision making right means for how and for what purpose the asset will be used. Yes, no, decision making right means what? How and for what purpose the asset will be used. That right is with customer or supplier. However, as per the contract, RA Limited has the right to restrict SA Limited from selling any kind of non-vegetarian item in the restaurant. Okay. So there can be some clause like this. The restriction right of RA Limited will become exercisable only after 6 years. The restriction right of RA Limited will be exercisable only after 6 years. Means what they want to say. Whether the contract contain a lease means they can restrict only after what? After 6 years means before 6 years they cannot restrict. Correct now. But can I say this is from my point of view, this restriction right is only a protective right, and we should not consider any protective right for determination of what? Lease. I think that point I have informed or not informed, but that is mentioned in India's Saaransh book. Okay, if we do not consider any protective right, protective right should be ignored. So this is I think only a protective right, which is not a substantive right. Correct now. So therefore it should not be considered whether any information is given like that. The contract contains lease of 10 years and the right of the lessor are. Option number 1 I think is correct. Contract contains lease for 6 years and the lessee has a right to control the use of asset for a portion of period. No, this is not correct. This is not correct. No, I think option number 1 is best option. So from my point of view, the answer option number 1 is correct. Okay. Contract contains lease for 10 years as the right of the lessor are protective in nature. It is only a protective right. Understood? Chalega? Because even though this restriction right is there, but then also can I say the customer will obtain substantially all the economic benefit of that asset. Substantially all the economic benefit of the asset. So this is only a protective right which should not be considered. Chalega? So option number 1 is correct. Okay, sir. Any more doubt? You have any doubt in India's 116? India's 116. So come to India's 116. Second question. Second question. On 1st April 2018, Buildwell Limited has also leased a machine from Donovan Limited on a 3-year lease. The expected future economic life of the machine is on 1st April 2018 was 8 years. If the machine breaks down, then under the terms of lease, Donovan Limited would be required to repair the machine or provide a replacement. Correct? Donovan Limited agreed to allow Buildwell Limited to use the machine for the first 6 months of the lease without the payment of any rental as an incentive to Buildwell Limited to sign the lease agreement. So first 6 months it was rent free period. After this initial period, the lease rent is 2,10,000 payable 6 monthly in arrears. So payable 6 monthly means 2,10,000 is for 6 months. The first payment is falling due on 31st March 2019. Calculate the current liability of the lease. So you can see means there are how many years? 3 years. So first 6 months 0, next 6 months 2,10,000, then 2,10,000, then 2,10,000. So for how many 6 months? It is 5-6 months 2,10,000. Correct now. So total lease payment become how much? 11 lakh 10,50,000 divided by what? They have asked what? Calculate current liability. So divide by 3 will do. So what is the leasing? What is the? They have asked from which point of view? Lessee or lessor? They have asked from. They have asked from current liability. Now, so current liability means from the point of view of what? Lessee. So divide by 3 how much? 3,50,000. So 3,50,000. So this become lease income of the first year. So what journal entry you will do? Batao. Lease expense will be how much? 3,50,000. To bank how much? Batao. How much paid? 2,10,000. So to lease payable how much? Bolo. 1,40,000. 1,40,000 is the lease payable. Now what they have asked? Calculate the current liability of lease machine to be shown in the statement of financial position as on 31st March 2019. Chalo. It means we need to go to second year. So what will be journal entry for second year? Batao. Lease expense account debit how much? 3,50,000. Payment how much done? To bank how much? Now 2,10,000 into what? 2 na? 4,20,000 means 2. यहाँ पर lease means lease payable will be adjusted how much? 70,000 will be adjusted. 70,000 will be adjusted ना? बोलना रे means out of 1,40,000 how much adjusted in within 12 months? 70,000. And how much will be adjusted after 12 months? 70,000. How much is the current liability? 70,000. So 70,000 become the current liability. Option number A is correct. Option number A is correct. Understood? Have you understood? Good question. I will say good question. So this type of question now they will ask in MCQ format, and for this conceptual understanding is required. So I will always say do journal entry and don't do directly. Normally what happens in MCQs we do directly. So if you are doing directly, so there is high chances you will take wrong option. Means I think you have a doubt about 1,40,000. Correct ना? I was also थोड़ा सा confused. थोड़ा सा I also become confused. अरे ये क्या हुआ? Because I have seen the option ना. Because answer is given ना. If answer is not given, I would have not been confused. But answer was given. अरे ये कैसे हो गया? Are you getting? So then I process myself. Then I got the answer. Understood? Yes sir. Then what? Any more doubt? Have you written? Just write down the explanation also. Justification तो was given. You have not understood with justification also. चलो ठीक है. Now understood? चलो. Then what? Any more doubt in Ind AS 116? No doubt. चलो. Now we can start what? Financial instrument chapter. Let me check any more doubt is there. अरे वो doubt आ गया. In respect of the entity which is first time adoption of Ind AS, does Ind AS 102 necessarily required to apply to equity instrument? Then like Ind AS 101 till now I have not done. So when I will do Ind AS 101, your doubt will be over. Okay. I think you are joining for the first time. ठीक है ना? Ind AS 101 chapter I have not done. So when that point will be done, you will automatically understand your doubt. Okay, sir. Now let us come to financial instrument chapter. Now about this financial instrument chapter, what I want to say, always I am starting with some what about the brief description of the chapter. From examination point of view, what you should be careful. I said about Ind AS 105. You think about the content of that chapter. Then I came to lease. I said calculation. Calculation is more important. Ind AS 102. I said calculation is more important. Be careful about calculation. Conceptually, you are strong in that chapter. In this chapter, normally what happens? The chapter is very vast. Chapter is very vast, and we don't know what type of question they are going to ask. Correct now? So till now, so we know, means from examination point of view, we know that these are the important topic, but suddenly they may ask some other topic question. So normally what happens when a student revise this chapter, when they are coming to the end, they will surrender this chapter. Correct now? Because they are taking more time in initial topic. Suppose you have fixed 12 hours in this chapter. Suppose I am just taking example, 10 hours for this chapter, and in 10 hours you have completed only 50%. So you will surrender now. So 50% you have not revised, and 50% if you have not revised, and the question may ask from that topic only. So the last 4 days and 5 days is very important. If the last 5 days you are not revising the entire topic and the question is coming from that topic, so you will surrender. Therefore, you need to identify which question need to be revised before exam. In this chapter, you are not supposed to do all the questions before exam. So just identify which questions are that type of question which require revision, and that question if you do just before exam, so believe me, this chapter is very easy from examination point of view. This chapter is very easy because in this both concept is also important, calculation is also important. It means you need to retain the concept also. If you forget the concept, even though you are good in calculation, you will not be able to do correct calculation. Correct. So I know what are the area where you need to be careful. So that area I will identify in this revision classes. So we all know that this chapter is based on 3 Ind AS. One is Ind AS 32, one is Ind AS 109, and one is Ind AS 107. IND AS 107 is totally for disclosure purpose, not so much important from examination point of view. We will focus on IND AS 32 and IND AS 109. Now in this chapter we'll not do IND AS wise, we'll do from chapter wise, correct now, from chapter wise. But IND AS 32 deals with this particular point. So this may be important from MCQ's point of view. They will say ki offsetting is as per IND AS 32, ki IND AS 109. So you need to remember, acha, offsetting is as per IND AS 32, not as per IND AS 109. So just revise this, ki IND AS 109 discuss this point and IND AS 32 discuss this point. Correct? Understood? Now, first meaning of what? First we'll come to meaning. Meaning is given what in this topic number 1 is based on IND AS 32. What I have done, I have divided this entire chapter topic wise. Topic 1 to topic, I think topic 9. There are 9 topics. So topic 1 to topic 9. I always say in my regular class, ki always revise this chapter topic wise. Don't revise this chapter full wise, because what will happen if you revise entire chapter full, you will be out of the what? Some zone. So what I am saying that two topic wise. Topic number 1 completed, 1 chapter completed. Topic number 2 completed, 1 chapter completed. So it will give you confidence. It will give you confidence. So always revise topic wise. Don't revise chapter wise. So topic 1 is very simple. Meaning is there. So meaning we know that. Meaning no much discussion required. But this meaning all are important now from MCQ's point of view. They may ask whether it is a financial asset, financial liability, non-financial asset, non-financial liability, equity, this type of question they may ask. So what do you mean by financial instrument? This chapter also start with a contract. If there is no contract, it is not covered in this chapter. For example, can you say income tax payable? Income tax payable is paid in cash, correct? So it will meet somehow the definition of what? Financial asset, because financial asset are those assets, yeah fine, sorry, it will meet a definition of financial liability, my mistake. Financial liability are those liability where there is an obligation to pay cash. But can you say this income tax payable does not arise through contract? It is because of act, and therefore it is outside the scope of this chapter. Therefore income tax payable, GST payable, TDS payable are not financial liability, correct? So what do you mean by financial instrument? It is a contract which gives rise to sorry, financial asset for one entity and financial liability or equity instrument of another entity. Means can I say, of course in a transaction there are two entities, one entity, second entity. So it will give rise to financial asset for one entity and financial liability or equity instrument for another entity. So any such contract will become financial instrument contract. A simple example is what? Sale of goods on credit. Sale of goods on credit. In one books it will be receivable, in one books it will be payable. The second simple example is issue of equity shares. In one books it will be financial asset, in one books it will be equity instrument. Sorry. So financial asset means what? Financial asset means what? It includes cash. It includes cash. It includes equity instrument of other entity. Equity instrument of other entity means for me it is investment in equity shares. It also includes contractual right to receive cash. Contractual right to receive cash or any other financial asset from another entity. Means any right to receive cash will become what? Any right to receive cash will become what? No. Contractual right. Contractual right. Done mistake na? I said any right to receive cash. You said it is a financial asset. No, the definition is not correct. Contractual right. Contractual right. Understood? Statutory right is not financial asset. It should be contractual right to receive cash or any other financial asset from another entity. Then it will become what? Financial asset. Then once again, contractual right to exchange. Contractual right to exchange any financial asset or any financial liability with another entity under conditions which are potentially favorable to the entity. Now I hope you all know about derivative instrument. So this point number D discuss with what? Derivative instrument. Correct? Means can I say this point number E I will discuss at the end specifically. You know point number E now, but I will not discuss right now. Means majorly from examination point of view or simple point of view, there are four. One is cash, one is equity instrument of other entity. Can you say one is debt instrument of other entity and one is derivative instrument, derivative instrument. So this we call equity instrument, this we call debt instrument, this we call derivative instrument. Correct? So this we call what? Equity bolo, equity instrument, debt instrument and derivative instrument. Understood this point? Cash, cash is cash. कैश को क्या बोलना, कैश इज कैश, चलेगा. ओके. नाउ फाइनेंशियल लायबिलिटी इंक्लूड, कैन यू से फाइनेंशियल लायबिलिटी ए विल नॉट कम बिकॉज देयर इज नो नेगेटिव कैश, A will not come. B, can you see equity instrument of other entity will become equity of other, and the former entity means if it is equity instrument, it is a financial asset for me. So for other entity it is equity instrument now. So that is not a financial liability. So you can see A and B will not come in this definition. In financial liability A and B will not come. It will start from C, D, E. So C become A, D become B, and E become C in this definition. So it include contractual obligation to exchange cash, contractual obligation to deliver cash or any other financial asset to another entity, and contractual obligation to exchange any financial asset or financial liability with another entity under conditions that are potentially unfavorable to the entity. Means this is derivative liability. So we have what? One is what? Contractual obligation to deliver cash. One, there is a contractual obligation to exchange financial asset and financial asset or financial liability. I hope definition is very simple. Correct? Now this point number C I will discuss at the end. Okay sir? Means I will come to this point. No, nothing to worry. Now equity instrument means what? It is a residual interest. It is a contract that entitle residual interest. It is a contract that entitle residual interest in the asset of the entity after deducting all the liability of the entity. Means in bachpan se we are doing equity is equal to what? Asset minus liability. Equity means asset minus liability. So here asset is financial asset ki all asset? Here asset is financial asset ki all asset? Liability is financial liability ki all liability? So it is all asset, all liability. All asset minus all liability. That residual interest is known as equity instrument. So equity instrument entitle residual interest to whom? Entitle to the holder of the equity instrument. So any contract that entitle the holder of that instrument the residual interest in the asset of the entity after deducting all the liability, that become equity instrument for the entity. The best example is ordinary equity shares. The best example is ordinary equity shares. There are many other examples. For example, irredeemable preference shares which has been classified as equity. Irredeemable preference shares which has been classified as equity. There are many examples. We'll discuss about this example in our later discussion. Now, I have given some example about whether it is a financial asset or financial liability or not a financial asset or not a financial liability. Can you read fast? Any doubt you ask me? Read fast. Any doubt you ask me? Doubt will not come. Any doubt? 30? 30? 1-3. 1-3. Promissory note to receive government bond or promissory note payable in government bond. First, do you know about promissory note? In foundation, you have done one chapter, bills of exchange and promissory note. It is similar to bills of exchange but not bills of exchange. Okay, correct now. So you have given a promise to some other party, correct now, that you will pay in government bond. So this is a contractual obligation to deliver what? Cash or financial asset. Government bond become what? Financial asset. So it will be the definition of what? Financial liability. So any contractual obligation to deliver cash or any other financial asset. So you have done a promise to pay in what? Financial asset, which is not a cash, that will be also what? Your financial liability. And if you have a contractual right to receive not cash but any other financial asset, that will be what? Financial asset. Understood? Any more doubt? Means I am assuming that you know definitions. So if I am not discussing this all examples, if any doubt I will discuss. Bolo. Can I proceed? Yes sir, I can proceed. Okay. I am assuming that you have understood, huh? If you are not asking doubt. Okay sir? देखो इतना बोलने के बाद डाउट आता है. राइट ROU एसेट, अभी तो IND AS 127 you ask ना. ROU asset, it is a financial asset, not a financial asset. Whether whenever you have some right to use asset, whether there is a contractual right to receive cash. अरे बोलना नहीं. Whether there is a contractual right to receive any other financial asset? No, nothing. So right to use that asset. So this is not a financial asset. This is not a financial asset. Correct? Apply definition. Apply definition. Any other point? Can I move? Okay, sir. Now that was then when there was no IND AS 116. Then I used to give that example. Now after IND AS 116, that example become invalid. Now in the books of lessee there is no operating lease. Okay, चलेगा. So I think you have done when there was. So ठीक है, will not discuss that example is not now available because of introduction of what? IND AS 116. Okay. Now coming to the next point. The next point is what? This is very important. Whenever we say in the books of what? In the books of what? There are two parties. In a financial instrument contract, there are two parties. The party in which we have financial asset and the party in which they can be financial liability or equity instrument. So can you see, in this we have a doubt whether it will be a financial liability or equity instrument. In this book, so there is no doubt. Always it will be financial asset. Always it will be a financial asset. But doubt will come in this book about the classification, whether it will be classified as what? Financial liability or equity instrument. Therefore, they have given rules. What the rule is what? What they said, every instrument has two components. One is principal and one is interest or dividend component. And if every instrument has how many components? Two components, principal and dividend component. If there is an obligation to pay both, and it cannot be refused, so it becomes what? Financial liability. Correct? If there is an obligation to pay only one principal amount, but there is no obligation to pay what? Interest or dividend amount, then one doubt will come. If there is no obligation to pay both amount, then it become what? Equity instrument. Are you getting what I am saying? And if this is the case, then one doubt will come. Understood? So what they are saying, if there is no obligation to pay either principal amount and interest or dividend amount, it become what? Equity instrument. If there is an obligation to pay both principal amount and interest or dividend amount, it is a financial liability. Doubt will come in these two. So what they are saying, it is a compound financial instrument, and this compound financial instrument requires splitting in financial liability and equity instrument. Correct? Understood? So what the rules they have given, let us read. If the issuer of the instrument can be forced to redeem both principal amount and to pay interest or dividend amount, so there is an obligation to pay both amount and they cannot refuse it, and therefore it is a financial liability. But if the issuer has an unconditional right to refuse both principal amount and payment of interest or dividend amount, then it is an equity instrument. Understood? So this is the main rules for the classification of financial liability and equity instrument. Then one more point they have given, if the settlement of the financial instrument is contingent on the outcome, contingent on future outcome. outcome of circumstance which is beyond the control of either party, means the settlement is right now contingent, means we don't know whether it will be settled in cash, whether it will be settled in equity. Always initially it will be classified as what? Financial liability. It will be classified as financial liability. So whenever the settlement is contingent, the always it will be initially classified as financial liability. For example, I'll just give example. If I'll say compulsory convertible debenture, compulsory convertible debenture. So you need to identify two component, principal and interest. Now, if there is a fixed interest, so interest there is an obligation to pay. So this will be financial liability. But principal, you can see compulsory convertible. So compulsory convertible, no obligation, therefore it become equity. So it become what? A compound financial instrument. But if I say optionally convertible debenture, so can is a principal amount. Now one doubt will come whether it will be redeeming cash or whether it will be converted into equity share. One doubt is there. So option has been given. So always initially this principal amount will be classified as what? Always this principal amount initially classified as what? Financial liability. Financial liability. Understood this point? Correct. Have you understood? Yes. Now, accounting treatment of interest, dividend, gain or loss and transaction cost. So they have given very simple rule. If for financial liability, any interest, any dividend, any gain, any loss will be transferred to what? PL. Correct. Now, if it is financial liability, so everything will be transferred to PL. But if it is equity instrument, then any distribution will not be transferred to what? Any distribution will not be transferred to PL. It will be debited to what? Retained earning. Correct. So for equity instrument, nothing will be transferred to PL. It will remain in what? Equity. It will remain in equity. Then they given about transaction cost. Transaction cost for financial liability will be deducted from the proceed of financial liability, and transaction cost of any equity instrument will be deducted from the proceed of equity instrument. Correct. Understood. Transaction cost of an equity instrument of financial liability shall be deducted from the respective amount whatever we have received, from the respective amount whatever the entity has received. But any transaction costs that are related to compound financial instrument. So suppose there is a transaction cost for issuing any compound financial instrument. So that transaction cost will be allocated to both the component in the ratio of fair value of each component. Fair value of equity component and fair value of liability component. This I will discuss again. But a simple point you have understood? Correct. Understood this point? Means it is very simple, no discussion required. Now let us come to topic number 2. This is thoda sa important from exam point of view about compound financial instrument. About compound financial instrument. So what they want to say, any component means any financial instrument which have two elements in a single contract. Means two element means equity element and liability element, that will become compound financial instrument. Already rules I have given. Keep the principal, there is an obligation to pay, and interest and dividend there is no obligation to pay. It become what? Compound financial instrument. So whenever any example is given, just find out principal and interest or dividend. Correct. If one there is an obligation and other there is no obligation, it become what? Compound financial instrument. If both there is an obligation to pay, it is what? If there is no obligation to pay, then what? So I have taken how many examples? 16 example. I will take only 2 example, then you do all the points right now only. Correct. So redeemable preference share with fixed dividend per annum. But the redeemable preference share, principal there is an obligation to pay, but fixed dividend there is an obligation to pay also what? Dividend. So it become what? Financial liability. Simple. Correct. Then non-redeemable preference shares. So there is no obligation to pay what? Principal component with cumulative or non-cumulative dividend at the discretion of what? Means the issuer has a discretion to pay, means at any point of time they can refuse. So there is no obligation to pay what? Principal, dividend as well as interest amount, whatever. So it become equity instrument. One more example. Redeemable preference share with redeemable means there is an obligation to pay principal amount. Redeemable with cumulative or non-cumulative dividend at the discretion of what? Issuer. It means dividend there is no obligation to pay. No obligation to pay. It means it become compound financial instrument. Can you do by your own 4 to 16 right now? because this type of question can be asked in MCQs right now. Any doubt you can ask me. If you are not asking doubt, means I will assume you have understood. Done? Any doubt? (16) 15 you have understood? 15 also doubt na? 15, 16 doubt. And apart from 15, 16, I was expecting doubt in 15, 16. Any other doubt? Zero coupon bond. Chalo. Then, any other doubt? So, I will explain 14, 15, 16. Chalo. But before that, some doubt came for this. So first, let me explain this. Doubt came for financial guarantee received and financial guarantee given. This I will explain you when I will do what. There is one concept about financial guarantee. So doubt is coming because it might happen you have not understood that financial guarantee wala concept before. Correct now. Therefore the doubt is coming. So I will explain this financial guarantee received and financial guarantee given. This will be last point of this chapter. Okay. Last topic will be this topic only. Now coming to one more doubt came, perpetual debt. कहाँ पर है? Perpetual debt instrument held. Held means from the point of a holder or issuer. Holder. So in the books of holder it will be always financial asset. Doubt will come in the books of what? The entity which has issued such an instrument. So it can be a compound financial instrument in that case. So in the books of holder, so it is a financial asset. In the books of holder it will be always financial asset. So I think doubt should not come. But chalo, I have given clarification regarding this. Now coming to first zero coupon bond. I think now with AFM classes you know about deep discount bond. Deep discount bond means what? Any instrument which have been issued at some higher discount. So let me take one example. Suppose the nominal value is 10 lakh but you have issued at what? 50% discount and 5 lakh is the discount. So what is the amount payable at after some year? The amount payable is what? 10 lakh. So this consists of two components. Principal component how much? 5 lakh. And interest component how much? 5 lakh only. So there is an obligation to pay both component now. There is an obligation to pay both component. Principal how much? 5 lakh effectively. And interest how much? 5 lakh effectively. Therefore it is what? Financial liability. Now coming to optionally convertible debenture. This was point number 15. Optionally convertible debenture. So can you say here principal is there, here interest is there. So it was fixed interest now. If nothing is given, we will assume what? Fixed interest. So there is an obligation to pay what? Interest amount. Now principal, it is an option. So I said it will be initially classified as what? Financial liability. So initially classified as financial liability. Now one doubt will come. So why you have mentioned what? Compound financial instrument? Because there is one more point, option also. There is one more point, option. Can you say one right was given by whom to whom? A right was given by entity to the holder. But anything is free in India? Nothing is free in India. So some consideration has been received for that right also, and for this there is nothing, there is no obligation to pay that amount to what? Holder. So some consideration we have received for that right also. Some consideration we have received for that right also, and there is no obligation to return that amount. So it become what? Compound financial instrument. So whenever any right is attached, so right, some consideration will be received, and therefore it will become what? A compound financial instrument. So next example, I hope you have understood by your own. It is a participating preference dividend. So it means some right has been given to the preference shareholder to participate in surplus profit or surplus fund at the time of liquidation. So right is nothing. The right is not free of cost. So some consideration has received for that right, and therefore it become a compound financial instrument. So what concept you understood? Whenever there is a right, so it will be what? Always a compound financial instrument. Understood this point? Have you understood this point? Chalo, correct. Now coming to how to split compound financial instrument. The splitting is super easy. Correct now. So they have given one formula. If first find out proceed receive. First find out proceed receive. From this deduct what? Less fair value of what? Liability component. Deduct the residual figure will be what? Fair value of equity component. It is not vice versa. Means can you do it like this? First find out proceed, then find out fair value of what? Equity component, and balance is what? Can you do in this way? No. This question can be asked in MCQ format. Huh? So this is not correct. This is only correct. So first find out fair value of liability component. The residual figure will be what? Equity component. Now what do you mean proceed? Proceed means what? Proceed means what? Proceed means what? Nominal value minus discount plus premium. Whether will include transaction cost यहाँ पर? Yes or no? Transaction cost. So transaction cost do not include. So proceed means what? Nominal value minus discount plus premium. अच्छा, discount at the time of issue or redemption, and premium at the time of issue or redemption. One second. Doubt आ रहा है ना? देखो, I know where you do mistake. Correct now. Therefore, I'm asking this point. So wherever I'm asking, that is a control point. So that you need to control in exam. Correct. So proceed means what? Nominal value minus discount plus premium. To discount at a time of what? And premium at a time of? Pakka. So this is correct. So both are at a time of issue only. That is only proceed receive na. So proceed receive at a time of issue. Correct. So nominal value minus discount plus premium. Correct. What do you mean by fair value of liability component? Batao. It is the present value of contractual cash outflow discounted at three rate of interest: market rate of interest, effective rate of interest, or contractual rate of interest. Market rate of interest or effective rate of interest? Market rate of interest or effective rate of interest? Doubt आ गया ना? Doubt आ गया? Correct. You know, small point, one simple concept in exam. Gone case. Last exam this only happened. Everyone was confused. Correct na? थोड़ा सा lengthy question with rate of interest, they are confused. Means they know every point, but in exam hall you need to control. Means I am not saying you don't know. When somebody asks you repeatedly one question, change kar lo. In exam what happen? You know the point, but you think much, and you go to wrong answer. Control your emotions. If you can control your emotions, believe me, exam questions are very easy. Correct now. And calculation, nothing to worry, because you have calculator. If there is no calculator, then only we should worry about calculation. Na? Are bolna re? In class 12, whether you were in class 12 exam, whether you were used to carry calculator, then also you score what? In accounts, how much you score? More than 80 to pakka. Everyone. Bola yes or no? more than 80 तो पक्का ना, without calculator you have scored. अभी my cousin, correct ना, my cousin son is in class 12. So he was asking, because I am accounts faculty, that I was teaching him depreciation. Correct ना, he was doing without calculator. रुक जा, means he was faster than me and he was not using calculator and he was doing all calculation without calculator. And believe me, if that is not given, calculator is not given to you, you will die. चलो ठीक है, calculator is with us. बोलना है ऐसा नो, तो it means calculation mistake. So if you are doing, this is the worst part of your life. Yes or no? So avoid calculation mistake. ठीक है ना. तो this is at market rate of interest. At market rate of interest means I am giving you three formula. इसको दिमाग में रखो. Whenever they say contractual cash outflow, बताओ which rate of interest? Contractual rate of interest. Whenever, because you need to calculate contractual cash outflow also na. So by using which rate of interest? Contractual rate of interest. Now whenever they ask fair value in any concept, whenever we calculate fair value by using what? Market rate of interest. Fair value means what? Market rate of interest. Fair value means what? Market rate of interest. Correct. And whenever we calculate interest, income or expense, either income or expense, then it is what? EIR. Understood? Then it is EIR. Have you understood this point? Correct. So these three rate of interest that we need to understand. Correct. Now if in exam they have given all these three, now a lot of doubt will come. If they have given all these three rate of interest, lot of doubt will come. Only there are few questions, I think 1 or 2 questions in which all these three rate of interest are given, and therefore we don't practice much that type of question, and therefore in exam suddenly this type of questions come, we are confused which rate of interest should be taken. So कसम खाओ, बताओ contractual cash outflow which rate of interest? Fair value and interest effective rate of interest. चलेगा? Yes sir. So this is by using what? Market rate of interest. Then difference will be what? Fair value of equity component, fair value of equity component. Understood? Now just try to understand. Now if transaction cost is given, then you find out, is transaction cost given? If not given, then EIR will be equal to what? Market rate of interest. Then EIR will be equal to what? Market rate of interest. But if transaction cost is given yes, then it means EIR is not equal to what? Market rate of interest. This you need to understand. Means 95% question of ICAI study matter is like this, and therefore we assume both are same. Actually both are not same, both are different. So if there is a transaction cost, practically so there will be always transaction cost. Practically it cannot be without transaction cost. Are you getting? So both are different only. Both are different. Understood what I am saying? But in exam 90% whatever question is given ICAI study matter, most of the question are of this nature where the transaction cost is missing. So they give simple question. Are you getting? So then in that case EIR will be always equal to market rate of interest. But whenever transaction cost is given, so EIR is not equal to what? Market rate of interest. My question to you, now I am asking you one second. But the transaction cost is given. But the contractual cash outflow by using which rate of interest? Contractual rate of interest. Fair value and EIR, interest effective rate of interest. चलेगा? Now if transaction cost is not given, think and say, हाँ बताओ, contractual cash outflow by using which rate? Fair value, interest? No, say EIR only. Don't say market rate of interest. पाप, this is पाप. यहीं पे होता है rectification. Correct ना? MCQ question you will die. You will say EIR, and EIR is equal to what? Market rate of interest. EIR is equal to what? Market rate of interest. Understood what I am saying? बोलना रे. Are you able to understand what I am saying? You will say EIR only. Just find out ER and there is no transaction cost. ER is equal to what? Market rate of interest. So kasam khao, you'll say what? You'll say what? You'll say what? Understood. Now one more point. One more point. Where student do mistake. If contract are at market terms. So yes or no? Yes or no? So if contract is at market terms, बताओ market rate of interest will be equal to what? Contractual rate of interest. Market rate of interest will be equal to contractual rate of interest. Bolo yes or no? But in this case, market rate of interest will not be equal to what? Contractual rate of interest. Bolo yes or no? Are you getting what I am saying? So in this case, market rate of interest is not equal to contractual rate of interest. Now, suppose in exam they have not given market rate of interest, what will you do? Are you getting what I am saying? Suppose they have given one question, not a compound financial instrument, because compound financial instrument cannot be done without market rate of interest. Correct? One simple question. They have not given market rate of interest. It means contract is at what? Market term. It means contract is at market term. Contract is at market term. Understood what I am saying? See, whenever market rate of interest is not given, we can't calculate market rate of interest, because for that we need to go to market. In exam, can we go to market? We can't go to market. Don't calculate what? Don't calculate what? Because we can't go to market. So whenever market rate of interest is not given, assume contract is at market term. Assume contract is at market term. Now just try to understand. If the contract is not at market term, it is given the question. It is given the question. Contract is not at market term. Means it is off market term and market rate of interest is not given. What will do? Market rate of interest is not given, then what will do? Then question is wrong. They will always give. Then apply your common sense and do it. Correct now. If market rate of interest is not given, means question is wrong, because you can't calculate what? Market rate of interest. I hope you are understanding. Then question is wrong. Then in that situation, whatever you have understood, whatever you have done, apply that and do it. Don't leave any question, because whenever question is wrong, if you attempt, then only they will give marks. If you do not attempt, no marks. So whenever question is wrong, enjoy it and write whatever you know. They will give you full marks. They will give you full marks. Whenever question is wrong, are you getting what I am saying? But that chances are rare, huh? Understood what I am saying? So I hope you have understood whatever I want to say. So this is very simple. So my focus was not on this. My focus was not on this. This calculation you can do because you have calculator. I will take only one question which I found interesting, which will cover all the point. Only one question which already asked in exam, but I like that question personally. I like that question personally. So only one question. There are many MCQs in this chapter, na? Many MCQs. Because high chances out of 30 questions, 5 question MCQ will be from this chapter only. 5 MCQs from this chapter. So I have given how many MCQs? 41, 42. 42 MCQs are there. ठीक है, practice के जाता. 42 is more than enough ना? बोलना रे? ठीक. Now this question I like personally. ABC company issued 10,000 compulsory cumulative convertible preference shares as on 1st April 2001. Correct now. Now at the end they will say calculate value of liability and equity component. Means it is a question of what? तो दिमाग लगाना कि whether it is an equity, financial liability or compound financial instrument. When they have given this, it means what? It is a compound financial instrument. It is a compound financial instrument. But my question to you, compulsory cumulative convertible preference shares, compulsory cumulative convertible preference shares. But it is now apply your concept. It is a equity, financial liability or compound financial instrument. Huh? How explain? But the principal amount, whether obligation to pay, no obligation to pay. Dividend? How? Cumulative means obligation to pay. देखो अभी apply मैंने बोला apply concept. Then now you are applying what? This. I said exam point okay, but I am asking you something na. When I am asking, you will apply concept na. whether cumulative dividend means obligation to pay. अभी we have done this much question, इतना question किया, तो there तो you have not asked me that doubt. I have the cumulative and non-cumulative dividend at the discretion of issuer. So you said it is what? No obligation to pay. So question is silent ना. Question is silent. अभी तक तो first sentence when you have read, the question becomes silent ना. It can be at discretion, it can be without discretion also. But normally cumulative dividend is normally, because you know about preferences from bachpan se you are doing preferences. The dividend is at a discretion of entity. It is not at a discretion of entity. Always it will be at a discretion of entity. They can always deny. They can always deny. घर जा नहीं देते. बोले yes or no? So it means there is no obligation to pay. Correct. But whenever this type of questions come, so we'll always assume it is a mandatory dividend, and that will be understood from this point. The rate of dividend is 10% payable what? So it means it has been assumed that even though cumulative, there is an obligation to pay what? Dividend every year. Understood? Now more conceptually strong student will die. If you are more conceptually strong now, so you will die sometime in exam, because they have written cumulative and question is silent. So normally as per basic principle we should assume that it is at the discretion of what? Discretion of entity. But for this type of question, apply your common sense. We'll assume this is mandatory dividend, which is likha हुआ, so payable every year. So from this point we have taken assumption that this is mandatory dividend. Mandatory means this is not as per the discretion of issuer or entity. Chalega? Yes sir. Now the preference shares are convertible into 5,000 equity shares of the company at the end of 5th year from the date of allotment. When CCCPS are issued, the prevailing market rate of interest is what? 15%. Transaction cost. Transaction cost. Yeah. Now whenever transaction cost, बताओ ER will be equal to or not equal to market rate of interest? Not equal to. It means they will give, or if not given, we need to calculate. 99.9% they will give EIR, because EIR calculation is AFM subject. Correct? You calculate effective rate of interest where? In AFM, not in FR. So 99.9% they will give EIR. But if not given, you know how to calculate EIR. Calculate EIR by using the concept of IRR. Calculate EIR by using the concept of IRR. Correct. Now last question, what last exam what happened? Means I don't know what happened. It was correct question only. Correct question. But what happened now? When the student started using EIR, correct now? So answer was not matching. Some difference was coming. Use difference 3,000, 4,000 difference was coming. बचपन में क्या समझा है? Interest balancing figure ना. So in exam, leave it. Difference coming, leave it. Understood ना? Many students wasted 15 to 20 minutes in that question. अरे कैसे हो गया? Emotional हो गया. We have done our entire question and we are not getting answer. Difference coming, emotionally surrendered. And 15 to 20 minutes they wasted. 15 to 20 minutes they can do what? Some other question of 10 marks. Don't become so full in exam hall. You have done that much. Thora galti हुआ ना. Leave it if you are not able to get it and go to some other question. And at the end you are getting time. Come back again. Come back again. Why to only think about one question when there is balance 4 questions left? The time management is very important. Time management is very important. देखो in that question the 50% आ गया ना. What is the passing mark? 50% ना. If you are thinking it is wrong, the 50% you will get ना, because you have done. You will get some step marking. They will not cut entire mark. 50% will get. And if suppose chalo actual difference coming, leave it now, because that you are not supposed to fight with the information given the question in exam. However, that was nothing but balancing figure. Some approximation was done in EIR. The student started calculating what? EIR. Champion, they are champion. Recalculating what? EIR. Whether that is important? Whether that recalculation was required? Anything given, that information need to be accepted. You can't change the information given in the question. Can we change the EIR? Can we change the EIR given the question? अरे बोलना रे. So why you are doing recalculation? चलो मान गए गलत था. Let us understand गलत था EIR. So why you are fighting with the question? This you need to understand. Don't fight with the question. Go to other question. Go to other question. I think some of you have written the exam. You have also done that only. कौन किया ऐसा? How many done recalculation? No one has done. चलो ठीक है. Okay. So this was the point. Now in this question very easy. First we'll find out what contractual cash outflow. So because dividend is what? There is an obligation to pay. It was what percentage? 10% of what amount? 10,000 into 150 means 15 lakh. So it become 1,50,000. It is the compulsory convertible. So principal amount, any obligation to pay? No. Therefore principal amount become 0. So can you say whenever optionally convertible, the principal amount will come. Whenever compulsory convertible, the principal amount will not come. Correct now. So whenever optionally convertible, principal amount will be considered initially as what? Financial liability. But compulsory convertible, so don't take principal amount, only take what? Interest or dividend amount. Then you will use discounting factor by using which rate of interest? Discounting factor. You are calculating fair value of liability component. Which rate of interest? Market rate of interest. So whether they have given market rate of interest? Yes, they have given how much? 15%. So discounting factor by using market rate of interest. This you are champion. This become fair value of liability component minus proceed received. This become fair value of equity component. Splitting done. Splitting done. But after this they will go to IND AS 109 and they will ask you calculate interest or dividend expense also. Correct. So for that we need to, because you know amortized cost, we need to prepare our amortized cost table. But there is a transaction cost. Transaction cost need to be allocated to what? Both the component in the ratio of their fair value. In the ratio of their fair value. Acha. Can we deduct transaction cost from this? No, because proceed means what? Nominal value plus discount, minus discount plus premium. Transaction cost should not be considered. Transaction cost should not be considered. Then transaction cost, that transaction cost was how much? How much? 2% of issue price. So 2% of 15 lakh means 30,000. 30,000 has been allocated in this ratio. So this become net amount. This become net amount means initial journal entry what? Bank account to financial liability how much? This amount. To equity instrument how much? This amount. So can you say because the amount of recognition has changed, so interest rate will change. If this is the amount, so can you say ER and market rate of interest will be same. But now this amount become what? This amount. So ER will change. Therefore you need to calculate what? ER. But in this question what is given? ER is given. So you need to calculate interest expense by using what? EIR. Interest expense by using EIR. Understood? Means my question to you all, if suppose this transaction cost was not given, so interest expense you will calculate by using which rate of interest? EIR only. But in this case EIR will be equal to what? Market rate of interest. Very good. If you have said EIR, so you have understood my emotions. My emotions. So same thing they have given opening liability interest by using which rate of interest? Then contractual cash outflow, this become amortized cost. You can do it. Simple question, but I like this question. Why? Because it covers all the points. All the points. Chalega? Yes, sir. Okay, sir. So I have done my job by giving you the entire concept of compound financial instrument. Correct. One question which is important from examination point of view is this compound financial instrument. But if they ask the exam question, so they will ask splitting as well as what? Calculation of interest and amortized cost table with journal entry. They will ask. So it will be a 10 marks question. So then you need to be very fast in calculation. Very fast in calculation. Chalega? Journal entry you can do. Journal entry don't require my help. Yes or no? Journal entry is very simple. Yes, sir. Then there is one concept of early settlement. This is also important. Normally they can ask a question of this. Means I will explain this point what they want to see. Suppose there is one compound financial instrument, correct, and suppose this is optionally converted debenture and it will be converted after 10 years. Option is being given. So can you see, you can whatever proceed is given, you can split into two parts: liability component and equity component. Now liability component, suppose this is the 5-year expired, so you can find out amortized cost. An equity component, but the carrying amount will be equal to what? Same amount only. So this become carrying amount of what? Liability component. This is the carrying amount of equity component. Okay, this amortized cost, either you do compounding Or can you say we can calculate in this way also? This is nothing but present value of remaining contractual cash flow discounted at sunna. Discounted at, but I will give you 3 rate of interest. 1 second. 3 rate of interest. But are discounted at contractual rate of interest, market rate of interest, or EIR. I am giving you 30 seconds. Think, process. I was not expecting wrong answer, but you have given wrong answer. It means when somebody asks you, then only you think. I am asking. Till now nobody asked you. Yes or no? These are the conceptual point. These are the conceptual point. And I know student do mistake here, but student know everything, but I know in exam confused and they will take wrong rate of interest. Batao. Present value of remaining contractual cash outflow discounted by using what? How many are saying EIR? How many are saying market rate of interest? EIR is correct. Minority wins in CA. In CA, minority wins. It does not mean correct na. Everyone can become C. Only we need to rectify the mistake. I will give you hint. We have done amortized cost table, but of this amortized cost table, you have calculated interest by using EIR or market rate of interest. So if you will do, samjhe? If you are compounding by using which rate of interest? So you will discount by using which rate of interest? EIR only na. Correct. So it means it is the present value. This is conceptual mistake I am saying. Conceptual mistake. Present value of remaining contractual cash flow discounted by using original EIR. Original EIR. It means, can I say, if somebody asks you find out a carrying amount at this point of time, so can I say you can use this formula also? Instead of preparing amortization cost table, can I say you can use this formula also? Same answer will come. Same answer will come. Am I right or not? Are bola re? Are you getting what I am saying? Are you getting or not? Correct. Means either you prepare amortized cost table, which is easy from examination point of view. I will say that is easy, less chance of mistake. But sometimes they have given 20 years, 30 years, then the amortization cost table will die. Correct now. If they have given 20 years, so you'll die now. So in that case, this become easy from examination point of view because you need to use only what annuity factor. Correct. Understood. So you can also calculate in this way. Am I right or not? This become carrying amount. Now what they will say? Now I am coming to this concept. This must be understood. Now what they are saying? Key entity has given some offer to the holder for early settlement. Means either they will redeem on this date or they will do conversion on this date. Means sorry, not conversion. Buyback on this date. Buyback on this date. Means early redemption. Early redemption. So in that case, what will be the accounting treatment that we are going to understand? Means before maturity, it was redeemed. This is known as early redemption or early settlement. So in that case, can you see they will give you the amount of consideration paid. So this become fair value of equity, fair value of compound financial instrument on this date. Understood? Now they have said, suppose they have given they will buy back at rupees 10 lakh. They will buy back at rupees 10 lakh. So this become the fair value of compound finance instrument. Again we need to split it into two parts. We need to find out fair value of what? Liability component, and the balancing figure will be what? Fair value of equity component. One second, my question, think and say. If you are calculating fair value of fair value of liability component on this date. On which date? After 5 years. But that you will calculate by using contractual rate of interest, original EIR, market rate of interest. Correct. Next question. You will use which market rate of interest? Market rate of interest at the beginning on repurchase date. Common sense. Repurchase date because you are calculating fair value on that date. So of course that will be given. That will be given the question. So by using current market rate of interest, that will be given. You can easily calculate. So can you say you got for for liability component and equity component, you got what? Fair value. You got fair value. Then you have also calculated carrying amount on this date. So this will become gain or loss on buyback. So what India says that gain or loss on buyback of liability component will be transferred to what? PL. But any gain or loss on equity component will remain in equity. This only you need to understand. This only you need to understand. Correct? Have you understood? Correct. Means there are 3 steps for this question. First, step number 1, calculate fair value of liability component and equity component on initial recognition date. This you can do by applying the concept. Then second step is what? Calculate carrying amount of liability component and equity component on repurchase date. Yeah, early settlement date. Understood? Then point number 3, calculate once again fair value of liability component and equity component on early settlement date. This is nothing but consideration, fair value of consideration paid, from this minus fair value of liability component. The difference will become fair value of equity component. Correct. Then find out gain or loss on settlement. So this question also can be asked in exam. I think one time they have asked, but if they ask this question, so it will be 12 to 14 marks question with journal entry. Chalega. Okay. So this one question is also expected. Then there is one more point about amendment of terms. Till now this point has not been asked, but from my point to be important, because recently they have given one question is RTP. About this point, to this question can be asked in MCQ. Amendment of terms of a convertible instrument to induce early conversion. Now suppose you are debenture holders and you are holding some convertible instrument. Now entity want to convert on early basis, means conversion on early basis. So can you say I need to give some advantage to you, then only you will be ready. So in that case it is quite possible the conversion terms might be amended, and as per the amendment terms we might need to pay you some more consideration. Means either you will give me more number of equity shares or will pay you some cash consideration, more amount. Yes or no? So it means some additional consideration will be given either in the form of equity shares or in the form of cash. So what India says that whatever additional consideration has been given for the early conversion of convertible instrument, that additional consideration, the fair value of additional consideration will be transferred to PL. So only you need to remember this point. Fair value means the difference between the fair value of consideration the holder received on conversion of the instrument under revised term, and the fair value of consideration the holder would have been received under the original term, means additional consideration is nothing but fair value of additional consideration will be transferred to PL. But this is a convertible instrument. When I am saying convertible instrument, it will become compound financial instrument. Correct? It will be transferred to PL. My question to you all: suppose there is one equity instrument. Suppose there is one irredeemable preference share which has been classified as equity. Irredeemable preference classified as equity is not compound. There is no obligation to pay any amount. There is an irredeemable preference share, and for that there is some additional consideration given for early conversion. But the fair value of additional consideration will be transferred to PL की equity. Not able to understand. This topic I am doing for amendment of terms of what? Convertible instrument, means compound financial instrument. This you have understood. Now my question to you: suppose you have some irredeemable preference shares, so that is non-redeemable, but there may be some modification. So after a certain period of time, some modified terms was there. Now it will be converted it will be converted in equity shares and some additional consideration was given. So that additional fair value of consideration will be transferred to PL equity. Equity will always remain in equity. Equity will always remain in equity. Chalega? Yes sir. Yes sir. Done. Done. So topic number 2 is also done. Topic number 2 is important from examination point of view. Now coming to topic number 3. Now topic number 1 was IND AS 32. Topic number 2 was also IND AS 32. Splitting part. Splitting part was as per IND AS 32. Now topic number 3 we now move to IND AS 109. This is what? As per IND AS 109. So IND AS 109 deals with the recognition and measurement of financial asset and financial liability. Recognition and measurement of financial asset and financial liability. Why not equity instrument? Because for equity instrument there is no subsequent measurement. So equity instrument is always recognized initially as per the fair value of consideration received. At fair value of consideration received and then no subsequent measurement. No subsequent measurement. So for the purpose of recognition and measurement, you all know that all the financial assets are classified in 3 categories. First is what? AC. Second is what? FBTPL. Third is what? FBTOCI. Correct. Now this classification is done for which purpose? For recognition and measurement purpose. For recognition and measurement purpose. Understood? Now how to classify? That depends upon 2 characteristics. One is known as contractual cash flow characteristic. Second is known as business model. Entity's business model. So it is based on 2 tests. One is known as CCFC. CCFC means contractual cash flow characteristics test. Second is known as business model. BM test. BM test means what? Business model test. Now when I say business model means what? There can be 3 business model of an entity. Either they may hold to collect that contractual cash flow till maturity, or they may hold to collect contractual cash flow for some time and then after that they may decide to sell it. So sale whenever required, or they may hold any financial instrument for the purpose of trading, So either hold to collect till maturity, or hold to collect and sell financial assets whenever required, or hold for the purpose of trading. So what do you mean by hold for the purpose of trading? What do you mean by hold for the purpose of trading? So what do you mean by held for the purpose of trading? It means that financial instrument has been acquired principally for the purpose of sale. Principally acquired for the purpose of sale in the near future. In the near term, this has not been defined. What is the near term? In the near term, for making short-term profit. So making short-term profit, then it becomes what? Held for the purpose of trading. Means suppose you purchase one equity share. Debt instrument. Suppose you have purchased one debenture. Correct now. Now it will be held for the purpose of trading, or it will not be held for the purpose of trading. If you have purchased some debentures, so it will be held for the purpose of trading or not held for the purpose of trading. Well, ask management, रे. Why you are giving answer? बताओ कैसे कैसे बात करते? Whether you know about this fact. देखो, this is what emotionally affected. You need to ask management, means go to the other facts of the information given the question. If question is silent, then take some assumption. Abhi I asked only one point. You purchase one debenture, which category? You are saying not held for the purpose of trading. Why? It can be for this purpose also. It can be means it can be for this purpose. Means classification is totally based on business model. Means ask management and based on that discussion classify. Based on that discussion means in exam it will totally depend upon the information given the question. Normally this type of question they don't ask, but now with MCQ this become all important. Means when there was a practical question, so they will say give journal entry, and they will say what? Give amortized cost. So it means what? Amortized cost now. And normally all the question, I will say only leaving one question or two question apart, all question is based on amortized cost. So normally from examination point of view thing means as per previous scheme, we used to see only amortized cost. If you know amortized cost, examination done. Means till now they have not given any good question based on these two. Are you getting what I am saying? So classification is based on these two characteristics. I hope you have understood what is the hold for the purpose trading. Now, how to apply these two tests? So that depend upon whether the instrument, means whether that financial asset is equity instrument or debt instrument or derivative instrument. Understand what I am saying? Now, when I started the definition, I said that financial asset can be what? Can be what? Equity instrument or debt instrument or derivative instrument. So classification is based on whether that financial asset is point number B or point number C or point number D. Understood? So first let us do debt instrument. Debt instrument means receivable. कमजोर है भाई. Understood? Very kamjor. After marriage it become weak. Understood? Correct na? You will understand after marriage only this thing. Chalo. Classification of debt instrument. Classification of debt. When I say debt instrument, means can I say it is receivable in cash or any other financial asset. So whenever I say debt instrument, means in your mind what will come? Receivable. In your mind receivable either in cash or in any other financial asset. Any other financial asset means it will include what? It will include any receivable, loan receivable, trade receivable, falana receivable, dhikra receivable, or receivable in cash or in any other financial asset. So whenever the debt instrument, first you apply CCFC test. CC means contractual cash flow characteristics test. If not satisfied, not fulfilled, it means it is held for the purpose of trading. Because can I say when you principally acquired for the purpose of sale, there is no intention to collect any amount. It is only for sale purpose. It means it is held for the purpose of trading, and always it will be FBTPL. FBTPL means if it is fulfilled, CCFC test is satisfied, means it represents some contractual cash outflow of principal amount and interest amount. Contractual cash inflow of principal amount and interest amount, then it means CCFC test is fulfilled. Then we need to apply BM test. BM test means business model test. So ask two questions. First, whether it is hold to collect contractual cash flow till maturity, then it is amortized cost. But if suppose this condition is not satisfied, management says no, we don't want to hold it till maturity. Means everything depend upon the question and answer. You will ask question to management, they will give some reply. Suppose they say no, we don't want to hold it till maturity. Then second question will ask, sir, then whether you want to hold for some time and sell whenever required. Yes, then it become what? FBTOCI. Then it become FBTOCI. But no, this also we don't want. They will ask then what? For what purpose? They will ask me then what purpose? Because can I say this is also no, this is also no, and this is also no? So what IND AS 109 says that in that situation when the entity does not know the purpose, means that become what? Entity does not know the purpose only. Whether it is hold for the purpose of holding till maturity or hold for the purpose of holding and sale whenever required or hold for the purpose of trading, no condition satisfied, then it means they don't know the purpose only. It is quite possible in that case what they are saying, an option has been given. Means in that case I will say, means in that case when neither condition 1 or no condition 2 is satisfied, it will be always classified as FBTPL. Means we'll assume that it is held for the purpose of trading. So we'll assume that it is held for the purpose of trading. Understood? Have you understood it? So neither condition 1 nor condition 2 is satisfied, then it is what? FBTPL. Chalega? Yes sir? Correct. Now equity instrument, can I say for equity instrument so there is no contractual cash flow? Because equity instrument there is no contractual cash flow now. Are you getting what I am saying? Means come to definition. Definition of means when I am saying debt instrument there is a contract. When I am saying derivative, there is a contract, but for equity, there is no contractual. Means equity instrument of other entity, I do not have any contractual right to receive cash. Then also it is a financial asset. Because there was a contract, but I have no contractual right to receive cash. Then also what IND AS says that it is a financial asset only. So whenever there is an equity instrument, so CCFC test cannot be applied. CCFC test cannot be applied. It means it is what? Normally held for the purpose of trading. Normally I am saying. We will ask one question to the management, sir, whether it is held for the purpose of trading. They say yes, it is held for the purpose of trading. Then your answer is what? FVTPL. But no. No आ गया. So no आ गया means can I say it can be of two types. Whether you have done investment in equity shares of what? Subsidiary, associate or joint venture, or you have done investment in what? Equity shares of other entity which is not a subsidiary, associate or joint venture. So what Ind AS 109 says that this is outside the scope of what? Ind AS 109. Means this is not covered what under Ind AS 109. For that you go to what? Ind AS 27. Means can I say right now we are not discussing about investment in equity shares of associate, subsidiaries or joint venture. It means we are discussing about those investment in equity shares which are into other entity which is not a subsidiary, associate or joint venture. For that purpose, entity means Ind AS has given two options. Ind AS has given two options. You can apply FVTOCI option. FVTOCI option. If selected by management, so then it will measure what? FVTOCI. If not selected, then what? FVTPL. Means this is totally based on the information given the question. Means can I say from exam point of view, if they have given investment in equity shares and nothing is mentioned, but you will apply FVTOCI or FVTPL. FVTPL, because this is totally based on the information given the question whether FVTOCI option has been selected or not selected. Understood is fine. Correct. Now you can see here what we have done amortized cost FVTOCI FVTPL means can I say that instrument can be AC FVTOCI or FVTPL, but equity instrument cannot be. It can be only FVTPL or FVTOCI. Derivative instruments are always held for the purpose of trading. Derivative instruments are always held for the purpose of trading. I hope I missed that point. If financial assets which are held for the purpose of trading will be A and B which are derivative. Derivative means what? Held for the purpose of trading means always what? FVTPL. Always what? FVTPL. Understood? Correct. Understood. Now if you have gone through, so can you see it is FVTOCI with recycling? And this is what? FVTOCI without recycling. Now OCI are of two types. OCI are of two types. Ind AS 1, this is a point of Ind AS 1. The OCI are of two types, which can be reclassified to PL, which cannot be reclassified to PL. Which can be reclassified to PL means on derecognition of asset liability it will be transferred to what? PL from what? OCI. But when I am saying it is not reclassified to PL, so it will be directly transferred from equity, one equity to what? Another equity. That is from the from that specific reserve to what? Retained earning. As simple example, what I can say revaluation gain. Revaluation gain was transferred to what? PL or retained earning. So it means it was not reclassified to PL. But this FVTOCI can be of two types, with recycling or without recycling. But a debt instrument with or without? With or without? An equity instrument without. So debt instrument always with recycling means any accumulated gain or loss in this category will be reclassified to PL on derecognition of that asset. Correct. But if it is equity instrument, then any accumulated gain or loss will not be reclassified to PL. It will be directly transferred to retained earning. Directly transferred to retained earning. So this is what with recycling. This is without. This you need to memorize. It means can I say effectively there are four categories. Effectively there are four categories. First is what? AC. Second is FVTOCI with recycling. FVTOCI without recycling and held for the purpose of trading. So your initial and subsequent measurement is based on these all categories. Understood is fine. So initial recognition is done at fair value plus transaction cost. Fair value plus transaction cost. Fair value plus transaction cost. You can see fair value plus transaction cost, fair value plus transaction cost. But if for FVTPL, they say at what? Fair value, and transaction cost will be charged to PL as an expense immediately. Be careful. So it is at fair value plus transaction cost, fair value plus transaction cost, fair value plus transaction cost. But here only what? And transaction cost will be charged to PL. Correct. Subsequent recognition means at each reporting date. For AC it will be at amortized cost by applying EIR. Amortized cost by applying EIR or market rate of interest. EIR or market rate of interest. Amortized cost means what? EIR. Amortized cost means what? EIR. Now that you have understood, if there is a transaction cost, EIR and market rate of interest are different. But if there is no transaction cost, then EIR and market rate of interest are same. Then also amortized cost by applying what? EIR only. Correct? These all are MCQ based question. Got this point? Correct. Now FBTOCI, FBTOCI, FBTPL subsequent, because the name is only fair value, so it will be at fair value, at fair value, fair value, fair value, fair value. So can you say whenever you are recognizing at cost means amortized cost, means for PP we say depreciable cost. Written down value is depreciable cost now. Is after depreciation whatever left, this is known as amortized cost. So cost means no fair value gain or loss. There is no gain or loss when it is at recognized at cost. So there is no gain or loss on subsequent recognition. But here there will be gain or loss. Here there will be some gain or loss. Here there will be gain or loss. So this gain or loss will be transferred to what? OCI. This gain or loss will be transferred to what? OCI. This gain or loss will be transferred to what? PL. Can you see when gain or loss is transferred to PL, ultimately it is transferred to which account? In balance sheet? Retained earning. So ultimately it is transferred to retained earning. My question to you all, when gain or loss is transferred to OCI, ultimately it is transferred where? Other equity. Who said? Other equity. Other component of equity. As simple as revaluation gain is transferred where? From OCI to revaluation surplus. That is also other equity only. So this gain, this fair value gain loss will be transferred to OCI. OCI, can I say, will be accumulated where? Accumulated where? In some reserve. Separate common equity. The name of that reserve is not given under Ind AS. So whenever name you don't know, you need to give the name na. Means for revaluation surplus, so Ind AS has given the name na. For this they have said transferred OCI and accumulated in a separate component equity. So if you don't know the name, suppose I don't know your name, so I will give some name na. Correct na? Correct? Understood what I am saying? So it will be known as FBOCI reserve. कैसा लगा नाम? FBOCI reserve. Correct na? Don't misunderstood me if ICAI has given some other name. ICAI sometimes say FB reserve, FBOCI reserve or some other name. Means once you become CA, you can give any other name. That is your choice. That is your choice. But no name has been given. So we'll say it will be FBOCI reserve. So it will be transferred from OCI to which reserve? FBOCI reserve in statement of changes in equity. In statement of changes in equity. Chalega? Yes sir. Then interest, this is interest and dividend. But in this case, amortized cost, interest and dividend will be calculated by applying which rate of interest? EIR. Correct? EIR. And transfer to PL. Interest and dividend will be always transferred to PL. Interest and dividend will be always transferred to PL. But when it is FBOCI with recycling and FBOCI without recycling, so here doubt will come. Can you see this is the debt instrument? This is what? Equity instrument. Can this represent contractual cash inflow? But this does not represent contractual cash inflow. Whenever there is a contractual cash inflow, it means we can calculate EIR. And can I say it was for which purpose? To hold for some year, means to collect contractual cash inflow and then sell whenever required. So what they want to say that in this case also interest will be calculated by applying EIR. So interest will be calculated by applying EIR. But can you see here so no contractual cash inflow? If there is no contractual cash inflow, can you calculate interest by applying EIR? You can't calculate interest by applying EIR. So in that case what they are saying, whenever it is received, means because it is equity instrument, we receive dividend. So whenever dividend received, it will become income. So it will be transferred to PL when received. When received. Understood this point? Correct. But here interest will be calculated by applying. Here interest will be calculated by applying. Here interest will be calculated when received. Can you see when it is held for the purpose of trading? So there is no intention to collect interest only because it is held for the purpose of trading. Therefore, from my point of view, in this case we don't calculate interest. But there are two viewpoints. Because ICAI has not given any question of this nature, so I can't take ICAI viewpoint. I can't take ICAI viewpoint. Means as per my understanding of Ind AS, in this case interest will not be calculated. Correct now? Correct. So there are two viewpoints. As per my viewpoint, not applicable, but as per some other viewpoint, you can say, because I have referred some other books also. They say interest will be calculated when received. When received. But in any both of means any one case, in any one of the case, the impact on SOP will remain same. Impact on SOP will remain same. I'll just prove it. Prove it right now. Suppose you purchase one 9% debenture of rupees 10 lakh. And interest is receivable on 31st March. And you purchase on 1 Feb. The due date is what? 31st March. Due date is 31st March. Understood? Correct? चलो 1/4 कर दो बाबा, नहीं तो 1/4 बताओ. And it is held for the purpose of trading. And the fair value on 31st March, so it remain unsold, it become 11 lakh. In 11 lakh. Understood what I am saying? Correct. बताओ. On 1/4 what is the cost? 10 lakh. On 31st March you have not sold it. Do you receive interest also by bank? So 10 lakh into 9% how much? 90,000. And on 31st March you will value at what? 11 lakh. So बताओ, if you go as per my view and you said to interest income is nil, so interest income is nil, so बताओ to fair value gain will be how much? 1 lakh. How much? 1 lakh 90,000. And this fair value gain will be transferred to what? PL. This fair value gain will be transferred to PL. Now if you take other viewpoint, but the interest income will be how much? And fair value gain will be how much? Both total will be transferred where? To PL only. So ultimate effect in SOP remains same. Ultimate effect in SOP remains same. But accounting will be different. So I don't want to fight on this, because ICAI has not given any question of this nature. Therefore from my point of view it will be not applicable. But from some other faculty point of view, because you may have done this chapter from some other faculty. What other faculty say? You have done from some other faculty, na? Huh? Chalo, understood. I know. So therefore I have given that clarification. Otherwise you think that Chiranjeev sir don't know anything. ठीक है ना? I am going as per IND AS. IND AS you will say intention of intention. We need to go as per the intention. Intention is what? It is held for the purpose of trading. There is no intention to collect interest. If there is no intention to collect interest, should you recognize interest income? No. It is fair value gain only, because you purchase that for principally for which purpose? For sale purpose, to make short-term profit. Short-term profit is nothing but fair value gain. Therefore, from my point of view, no interest. But I will not fight for this. Because I don't know what is ICAI viewpoint regarding this, because no question of this nature has been given in ICAI study material. Chalega? Understood? So whatever you want to follow as per your choice. Understood means you can change also. I don't want to fight for this. You may change also. कि सर PL ही ठीक है तो PL ही कर दो. ठीक है? Okay, चलेगा. Then coming to gain or loss on derecognition. So can you say when you derecognize, the gain or loss will be transferred to what? Either PL or OCI. So in this case, so this will not be applicable, because can I say on derecognition the entire amount will be collected, and entire amount collected, so there is no gain or loss. If some amount is not collected, that become impairment loss. Impairment loss is some other topic. Can I say for FBTPL the gain or loss will be transferred to PL? Now for FBTOCI, debt instrument, the gain or loss will be transferred to PL. And for FBTOCI equity instrument, gain or loss will be transferred to OCI, because can I say it is without recycling, this gain or loss cannot be transferred to what? PL. But is it with recycling, can I say it should be transferred to PL only? I hope you have understood. So their gain or loss will be transferred to PL, and this gain or loss will be transferred to OCI. And once derecognition done, can I say entire cumulative gain or loss will be also closed. That FBOCI reserve account will be closed. So for FBTOCI with recycling, the cumulative gain or loss in equity will be recycled from OCI to PL. But in this case, cumulative gain or loss will not be recycled. It will be directly transferred to retained earning. Understood? Now, when I am saying recycling, what is the journal entry? Journal entry means if there is a gain. Suppose there is a cumulative gain. So what journal entry will do? OCI, FBOCI, FBOCI reserve. Correct now? That will be also closed now. Account debit to gain, and this gain is transferred to what? Yes. But if it is equity instrument, then what journal entry will do? Bolo? Means this is debt instrument. If this is equity instrument, then? Huh? No. Now no OCI. Directly FBOCI reserve will be closed and transferred to what? Retained earning. What journal entry I have done for revaluation gain? Whether I have said OCI, I have said revaluation surplus account debit to what? Retained earning. I was knowing you will say me wrong, and therefore I have asked you. I know where you don't know the concept. Correct now? So this will be FBOCI reserve account debit to what? Retained earning. Difference understood? Here it is recycled. There are two impact. Here SOPL is also impact. Ultimate effect in balance sheet remains same. Ultimate impact in balance sheet remains same. Impact in balance sheet remains same, but the presentation is SOPL will change, because this will affect SOPL. This will not affect what? SOPL. Are you getting what I am saying? So this journal entry will affect SOPL, but this journal entry will not affect SOPL. Are you getting? Have you understood what I am saying? But ultimate effect in balance sheet remain same, because you have debited one component of PL and you have credited one component of PL, SOPL. So can you say PL also remains same? Not able to understand. If this is SOPL, this is PL, this is OCI. So can you say OCI you have debited now? OCI you have debited by 10,000, let us assume, and this you have credited now. So ultimate effect is what? Zero na? Zero effect. Total comprehensive becomes zero. So balance sheet remain, means balance sheet effect remain same. So whether you have done this journal entry, whether you have done this journal entry, balance sheet effect remains same. But this journal entry will affect what? Your net profit, your profit or loss for the period. Means SOPL में थोड़ा changes आएगा, but ultimate effect in total comprehensive income remain same. Therefore this is known as reclassification adjustment. Reclassification adjustment. चलेगा? ठीक है. अभी I have done this much only. In regular class तो detail में पढ़ाता हूँ, but I hope you have understood. I hope you understood, because you know the chapter that you have understood. Only I just want to give the journal entry. Journal entry you understood? Journal entry. So this journal entry for reclassification. This journal entry for no reclassification. Reclassification means it is transferred to PL. Here it is not transferred to PL. Done. Now, in this, just try to understand. Suppose financial instruments are at market terms and not at market terms. Not at market terms. Right? Now, because they said initial recognition is done at fair value or cost price. Initial recognition will be done at fair value or cost price? Fair value. Fair value means present value of contracts or cash inflow discounted at market rate of interest. Understand what I am saying? Okay? Are you getting? So, if it is a market terms, it means, can I say contractual rate of interest will be equal to what? Market rate of interest. But here contractual rate of interest will not be equal to what? Market rate of interest. So in this case, can I say fair value will be equal to transaction price paid or not? Whatever you are paid is the acquisition price, means cost price paid. So in this case, can I say fair value and transaction price paid will be same and there is no difference? Are you able to understand what I am saying? So whenever financial instruments are market terms, whenever financial instruments are at market terms, then fair value will be equal to transaction price paid. Therefore, no calculation required. Whatever you are paid, that become fair value. So, journal entry will be done with that amount only. If there is a transaction cost, then calculate EIR for interest computation. Understood? Correct. Now after this you'll ask, is there any transaction cost? Are you getting what I am saying? Is there any transaction cost? Yes, no. So yes, then EIR require calculation, calculate EIR. If no, then EIR will be equal to what? Batao? Market rate of interest, which is nothing but contractual rate of interest. Understood this point? Have you understood this point? Correct. Now when this is not equal to, so can I say fair value will not be equal to what? Transaction price paid. Are you able to understand this all point? Correct. It means you need to calculate fair value. So fair value will be equal to present value of what? Contractual cash inflow discounted at what? Discounted at what? Batao. Discounted at? Discounted at? That confidence is not coming. Everyone is not saying. Don't be silent. Don't be silent. Market rate of interest. Correct. Understood. So this you can calculate or not? Correct. Then compare with what? Transaction price. Transaction price, and there will be some difference. There will be some difference. Means of course this amount will be more than this amount. Whatever you have paid will be more than what fair value. Means you have paid some extra amount. You have paid some extra amount. So what IND says that this extra amount will be accounted as per respective IND. Respective IND. Means in simple word I will say, if there can be actually three situations from exam point of view. First, if such means, just try to understand. If the contractual rate of is 10% and market rate of is 12%, means you have given some benefit to the person. You have given some benefit to the other person now. Suppose you have given loan at 10%, but the market rate of interest is 12%. You have given some benefit. Nothing is free of cost. Nothing is free of cost. Means you will demand something from that person now. Suppose right now the fees is, my fees is, suppose the FR fees is 10,500. You ask me some discount. So I will ask something from you now. Normally we don't ask. But I have asked, means there are many faculty, they will give discount and they will say start promoting for me. As if a teacher होते हैं. They will say start promoting and they will say what? They will make one video and they will say something good. Correct. ऐसे भी होता है. चलो ठीक है. But I will not say anything. But can I say that is why? Because you want a discount. So they will ask you what? He make a video for me. So nothing is free. Nothing is free. Are you getting what I am? Nothing is free. Correct? Yes, sir. So what I am saying, respective IND. So if it is compensated by origination fee, we call it what? Origination fee. So this is very rare question. It may or may not be asked in exam. A rare question. Till now not asked. Means suppose A Limited has given a loan to B Limited or employee. A Limited has given loan to employee. Correct. The contractual rate of interest is 10%. Market rate of interest is 12%. And as per 12%, it is coming, the loan is what? 12 lakh. And as per 12% is coming 10 lakh. So how much extra amount paid? So what A Limited will say, right now you give me, on the date of contract you pay me 2 lakh. Means they will receive initially how much? Origination fee of how much? 2 lakh. Means that will be compensated by that origination fee. So ultimately the net amount how much paid? 12 minus 2 only na, that is 10 lakh only. Means you paid how much? 12 lakh and you receive how much? So it means ultimately it is 10 lakh only na. Are you getting what I am saying? So if it is compensated by origination fee, can I say fair value is equal to transaction price minus origination fee? Yes or no? So in that case, fair value will be equal to transaction price minus origination fee, and the loan will be accounted at fair value only, at net amount, at net amount. Understood? But if it is not compensated by origination fee, normally this type of question they will ask. If it is not compensated by origination fee, means this question also has been given in ICAI study matter, huh? But I know they will not ask this type of question, but can be asked, huh? Sometimes I say they will not ask them, that question is already asked. गड़बड़ हो जाता है. Now, if it is not compensated, so this is very simple. If suppose there is some future economic benefit of that extra payment, means they will ask the employee to remain in the employment till the tenure of the loan. So it means they will retain the employee. If there is some future economic benefit, then it will be recognized as an asset. It can be prepaid expenses, means this will be prepaid employee benefit expense. Prepaid employee benefit expense. So it is one type of asset. And if there is no future economic benefit, means question is totally silent, and you are not able to understand why this is given. So it means no future economic benefit, then it will be recognized as an expense immediately. But this is also rare situation because nothing is free. Nothing is free. Means you need to identify why it has been given. So normally in exam question it will be an asset. Normally I am saying, but if suppose nothing is given, you are totally confused, then charge it to profit and loss account as an expense immediately. This is the entire point. I hope you have understood. Now in this case also, once you have calculated fair value, but initial recognition done at fair value plus what? Transaction cost. So if there is some transaction cost given, then EIR require calculation, and interest will be calculated by applying EIR. So whenever there is no transaction cost, EIR will be equal to what? Market rate of interest. All the question in ICAI study matter has been given without transaction cost, and normally students think that we are calculating at what? Market rate of interest. But in exam they may give what? Some loan processing fee, etc. That is given, means what? Calculate EIR, or EIR will be given, but interest will be calculated by applying EIR, but fair value by using what? So this you need to this difference you need to understand. Understood this point? I think I am doing my job. You are able to understand. Chalega. So one question I have taken for this also. India's. There are 3-4, I will say 3-4 questions has been given of this nature. All questions are important. All good question has been given. Correct now. So that question so you must do. Okay. Normally they have asking that type of question only in exam. This employee wala question to favorite question of institute. I don't know why. There is one question of security deposit also. That is also good question. I have taken, I think, one question. Let me discuss that question. Okay, that staff wala question. This is easy. You can do it by your own. This does not require my help. This question I have taken. A Limited is also asked in exam. A Limited issued redeemable preference share to a holding company, Jain Limited. The terms of instrument have been summarized below. Account for this in the nature of Jain Limited. Jain Limited means in the books of parent company. So who is the issuer? Subsidiary company. So who is the holder? Parent company. So in the books of holder, financial asset. So we are doing from financial asset point of view. In the books of issuer, it will be a compound financial instrument. So if suppose same question they ask for what A Limited, it will become a compound financial instrument. Are you getting what I am saying? Nature. Non-cumulative redeemable preference here. So redeemable, non-cumulative. Repayment redeemable after 5 years. Date of allotment, date of repayment, total period 5 years. Value of preference issued 1 crore. Dividend rate is 0.0001. It is so immaterial. 100 rupees will come. Means there is no obligation to pay what? Dividend. But one thing is clear that it is off market terms. It is off market terms. Correct now? Off market terms. And the present value factor is also given. It means in this case, what is the transaction price paid? What is the transaction price paid? 1 crore? 1 crore ki 10 crore? 10 crore ki 1 crore? 10 crore, I think so. 10 crore. Then you'll find out the fair value of loan given. Means parent company has given some amount to what? Subsidiary company. That is what? Fair value of financial asset. So fair value of financial asset. This will be present value of what? Contractual cash inflow. So contractual cash inflow means interest or dividend component and principal component. But can you say interest or dividend component? There was no subsidiary company, there was no obligation to pay. So there is no right to receive. So this will be 0. So only you will take principal component. Principal component is 10 crore multiplied by rate. Discount factor given. Now if they give 5 decimal, can you take 4 decimal? Can you take 3 decimal? देना मजा आएगा. To take 3 decimal, 2 decimal मजा आएगा. Correct ना? Don't take. If you say no sir, don't take. Then also I have seen student को पता नहीं क्या होता है in exam. What they do in exam. Believe me. Means they will not read the question carefully, or even though they have read it, they will forget that this information has been given. That is the point. If we are habituated of calculating na. Not actually in FR to not, but in AFM to you are calculating that only na. So you are habituated of calculating. And normally you are taking 3 or 4 decimal. Normally 3 or 4. I think either 4 or 3. Either 3 or 4. Some teacher will say 3, some teacher will say 4. Correct ना. अब बताओ. गड़बड़ हो गया. ना जितना फाइट करना फाइट करो. They will not give mark. You are correct only. If I am checking, I will give. But I am not checking your paper na. The point is that. So that is what I will say. Rules and rules are for everyone same. For everyone we are following same rules. ठीक है ना. So it is 5.56743. So 0.56743 na. It becomes 56 lakh 74,300 na. The difference coming how much? 40. Actually 5 crore, sorry. 5 crore 67 lakh 43,000. So this will be what? 4 crore 57,000. So can you say this is what? As per 109, this will be 109. But is the extra amount paid by parent company to what? Subsidiary company, which is not receivable. So it is one type of permanent investment, and therefore this will be what? Investment in equity instrument of what? Subsidiary company. But my question to you all, whether it is a financial asset, yes or no? One second. In this to 109 will be applicable. This is what? Loan given. This component is loan given. This is the amount receivable from whom? Subsidiary company. So any amount receivable from subsidiary company in cash or any other financial asset, it is a financial asset. 109 will be applicable and will apply amortized cost. But this amount is not receivable. This is one type of permanent investment, and if you remember, it is a compounding financial instrument for which company? Subsidiary company. So this become equity instrument for that. So any equity instrument of other party is also what? Financial asset. So my question that whether it is a financial asset or it is not a financial asset? Huh? It is a financial asset, but outside the scope of IND AS 27 will be applicable. Because there are two questions in exam. They will ask whether it is a financial asset. Yes, means covered under IND AS 32, but outside the scope of IND AS 109. What is point? Definition to lag gaya na. It is a financial asset, but covered under IND AS 27. Now IND AS 27 says either at cost price or at fair value. We'll discuss when I will do IND AS 27. If nothing is given, we'll recognize that what? Cost price. Means now journal entry will be what? Batao. Loan receivable. One clarification. My handwriting is not so bad, huh? It's good handwriting, but I'm writing fast now. Okay, so not so bad. So if you have done from me regular class, you know my handwriting is good. Correct now? It's not so bad. So don't assume that in regular class also I write them. Regular class देखो कितना अच्छा लिखता हूँ. So join regular class, huh? If you want to join. इतना प्यार से लिखता है, कितना प्यार. ठीक है? My handwriting is good, huh? Someone saying, "अरे कैसा पढ़ाता है नलायक." No, loan receivable. Then what? Investment in equity shares of subsidiary company account debit to what? Bank. How much? Amount you know. Amount you know. Now on this you will apply amortized cost. On this you will apply amortized cost by applying EIR, because what is not given? Transaction cost is not given. So EIR will be equal to what? Market rate of interest, which is equal to how much? 12%. No? 12%. This is the concept. That amortized cost table, so you can do it. Understood? Have you understood? Yes, sir. Done. So one question only I have done in that way. Now let us come to concept. Concept may initial recognition, this you have understood. Amortized cost you have understood. Fair value already I have explained. Transaction cost also you have understood. This also I have explained. It is at market terms, not at market terms. All thing I have explained. Summary. Summary I can read from exam. This summary has been given from examination point of view. Means whenever a question of investment equity share is given, means if questions come for investment equity shares, and it is subsidiary joint venture associate outside the scope of this chapter, go to Ind AS 27. But if it is other entity and is given held for the purpose of trading, then what? FVTPL. If question specifically mentioned that FVTOCI without recycling, then only apply what? FVTOCI without recycling. This is totally from examination point of view. Then investment debenture, question has given for debenture. If it is held for the purpose of trading, then what? FVTPL. If it is not held for the purpose of trading, then either it can be hold to collect till maturity, then amortized cost by applying EIR. It is not hold to collect hold to collect contracts or cash flow and sale whenever required, then this will be FVTOCI with or without? With recycling. FVTOCI with recycling. There is no question of this nature. This nature they have not given any question in ICAI study material. Correct? Yes, sir. Then concessional loan given or any security deposit. So whenever this type of questions come, first find out transaction price, and always this type of question in exam will be off market terms, because market terms will become easy now. So they will always give off market terms. Normally in exam that will be off market terms. How you will understand? Contractual rate of interest and market rate of interest will be different. Contractual rate of interest and market rate of interest will be different. Means it is at off market terms. It is off market terms. Are you getting what I am saying? So transaction price less fair value loan. What do you mean by fair value loan? Present value of contractual cash inflow discounted at market rate of interest. Difference will be what? Either treated as expense or any asset as per the nature of the contract. One question has been given about lease contract in the ICAI study material. So whenever you have given some deposit to lesser for lease contract, correct now? Understood? So whatever portion this left, that will become ROU asset. That will become what? ROU asset, and apply IND AS 116 on that. I think that question you have done. So that depends upon the nature of contract. Then modification in cash flow, I will come to this point. Then concessional loan to subsidiary company. Abhi we have done one question, concessional loan to subsidiary company. In that case, first find out transaction price, then find out fair value loan. Same thing. The difference will be investment in the equity instrument of subsidiary company. Means in the books of parent company, what journal entry will do? Loan account debit, investment account debit to bank. In the books of subsidiary company, means in this splitting will be required. Then it will be bank account debit to loan payable to equity instrument. Equity instrument means capital contribution from which company? From parent company. Now it can be reverse also. In one of the exams they have asked reverse. The concessional loan given by subsidiary to parent company. In one exam they ask this question. However, similar question we do in class also. So transaction price less fair value loan, similar point. The first find of fair value of loan. The difference in this will be what? Deemed dividend. It will be deemed dividend. The difference will be known as deemed dividend. So what journal entry in the books of subsidiary company? Loan receivable account debit, dividend. Dividend will be debited to what? Retained earning. To what? Cash or bank. In the books of parent company, bank account debit to loan payable to dividend income, and this dividend income will be transferred to PL. Understood this much? Now modification in cash flow, this can be also asked in exam. modification in cash flow. Now, normally what happens, sometime we need to estimate cash flow. We need to estimate cash flow, correct? Means we need to estimate contractual cash flow as per the information given in the question, correct? So when we estimate contractual cash flow, can you say it might happen estimation may change? Estimation may change, correct? Yes, sir. Now just try to understand. Or there can be some modification also in the cash flow, correct? So initially suppose Y1, Y2, Y3, Y4, Y5. It was 5 lakh, 5 lakh, 5 lakh, 5 lakh, 5 lakh, correct? I'm just giving one example. So can you see you have done accounting based on this? Means you will first calculate fair value, transaction price, and this will be difference. Difference you will do accounting as the case may be. You have done. Then on this, because this will become your financial asset, you will apply amortized cost and you will find out a carrying amount. You will find out a carrying amount. Here this amortized cost at the end of second year, will be present value of remaining contractual cash inflow discounted at what? Discounted at original EIR, correct? Now what happened for the remaining Y3, Y4, Y5? There were some changes in the cash flow. Let us assume it become 4 lakh, 4 lakh, 4 lakh. Quite possible. Understood? Now if it changes, so can you see this will change? Because this is based on what? 5 lakh, 5 lakh, 5 lakh. Now it become what? 4 lakh, 4 lakh, 4 lakh. So this is known as modification in cash flow. This is known as what? Modification in cash flow. Are you getting what I am saying? This is not impairment. Means if it is an indicator of impairment, then we need to go to what? Impairment wala concept. So this is not impairment. If it is impairment, then go to impairment wala point. I hope you are understanding. So this is not impairment. This is modification. Modification ho gaya. Yeah, there was some estimated cash flow. Now estimation change, and because of that reason there is some new revised cash flow. Understood what I am saying? So in that case, can you see now you need to find out present value of modified cash flow, modified contractual cash inflow discounted at what? Batao. Discounted at what? Means there are original EIR ki market rate of interest. Batao. Present value of modified contractual cash inflow discounted at what? Original EIR ki market rate of interest. Original EIR or market rate of interest. But are you calculating fair value? What you are calculating? You are calculating revised amortized cost. Revised amortized cost means what? Original EIR. However, in this type of question, they will not give market rate of interest. Then always you will take what? Original EIR only. But suppose they have given market rate of interest, then doubt will come. So, batao, you are calculating amortized cost or you are calculating fair value. So think like that. Understood? So you will never give me wrong answer. So this will be by using original EIR, and this difference will be adjusted. This difference will be adjusted to this difference. Means if suppose this was asset, so adjust with that asset. If this was expense, so transfer to PL. Understood? So this difference, whatever happened, this will be adjusted to this account. Understood? I think only one question of that nature has been given, and that question has been asked 2 times in exam. Very good question. Will company limited wala question hai. Will company limited. Only one question they have given, and that question have been asked 2 times. Means they don't have new question only. They don't want to create new question, because they will create new question. So who will create solution? Solution bhi banana padta na. Believe me, solution, question creation and solution making is a difficult job. It's not an easy job. It is a difficult job. That can be done by only those persons who are totally good in what? In theirs, and they will not take our help. They will never take our help, and therefore in theirs normally they are not creating new question. Now whenever they want new question, they go to what? International market. Now international market they will go. They will change the question. Thoda. Who will change that question also? So therefore till now they are giving that question only. Thoda sa modification they will do and they will ask. ठीक है? चलो. I hope you have understood. Correct. So that is only given what they have given. If there is changes in the timing or amount of estimated future cash flow, this is not impairment wala point. Once again, impairment to impairment will be covered. Other than देखो लिखा हुआ other than due to impairment, the carrying amount of financial asset will be recomputed at present value of remaining contracts or cash inflow discounted by using original EIR, and any difference due to such prepayment will be prepayment means due to estimation. Any difference due to such estimation, due to such re-estimation will be adjusted to PL or any prepayment account as the case may be. Prepayment account means prepaid EV expense or any other account, whatever was the difference. Chalega? Yes, sir. Got this point also. Understood? Correct. With this we covered all the points of financial asset. I am not taking those points which I know that is not important from exam point of view. Okay, na? So I am not doing that point. Up to this any doubt? Up to this any doubt? You want break or should I continue? बहुत हो गया. I know financial instrument है. You want break? Huh? Can I do this last point? Then financial asset, one topic means I'll go to topic number. So the one topic will be covered. This is very easy also. Reclassification of financial asset. Reclassification of financial asset. Now, when I am saying reclassification of financial asset, the financial asset are of three types. One is what? Equity instrument, debt instrument, then equity instrument, and then what? Derivative instrument. Can derivative instrument to only FBTPL? No reclassification. This will be FBTPL or FBTOCI, and this only when option has been given. Option, only option, and this option is irrevocable. Irrevocable means, can I say this option is irrevocable? Once you exercise, you need to exercise forever. Means reclassification is not permitted यहाँ पर. Reclassification is not permitted. Means reclassification was only, the reclassification concept is only applicable for what? Debt instrument, which can be AC, FBTOCI and FBTPL. So it can be reclassified from one category to another category when the business model changes. If the entity's business model changes, so reclassification required. Reclassification is always done on prospective basis. Always on prospective basis. Now, whenever reclassification happen for debt instrument, there are 3 points we need to understand. First, at what value it will be reclassified. Second, what will be the treatment of fair value gain or loss, whether it will be transferred to PL or OCI. And the last, what about EIR? What about EIR? These three discussion is required. If you have understood these three, all questions you can do by row. However, no question of good nature has been given in ICAI study matter, but with MCQs now it becomes important. MCQ question can be of this type. Okay. So no good question have been given, but now with MCQ I can say it can be asked. What will be the impact in PL, OCI? This type of question can be asked. So reclassification. If an entity reclassify the financial asset, now we have understood this is only what? Debt instrument. It shall apply reclassification prospectively from reclassification date. So first reclassification of AC either to FBTPL or FBTOCI. AC can be reclassified either to FBTPL or FBTOCI. So this is FBTOCI with or without? With or without? It is with na. Understood now what I am saying? It cannot be without in this concept. It is always with recycling. Chalega? Yes, sir. Now first, measurement. Measurement will be always done at, means it will be measured at fair value on reclassification date. So for all reclassification, always measurement at what? Fair value, fair value, fair value, fair value, fair value, fair value. So one point is so very easy. Now what do you mean fair value? Either fair value will be given the question or you need to calculate it. So fair value means what? Present value of remaining contracts or cash inflow discounted at Understood now? If you are conceptually good, you can calculate now. Which market rate of interest? On initial recognition date or on reclassification date? On reclassification date, any rectification required? No rectification required, only concept required. Only concept. So if you know all the concept, any question you can do in exam without much thinking. Then gain or loss on reclassification, it will be transferred to what? PL. It will be transferred to OCI. Understood? And ER, can you see for FBTPL to ER not required? And for FBTUCI, what they say, because AC become now FBTUCI and for both ER is required, so no adjustment in ER, use original ER. Use original ER. So no adjustment required, use original ER for subsequent accounting. Chalega. Now, if FBTPL now become AC or FBTUCI, so measurement at what? Fair value. Gain or loss will be transferred to what? PL. Understood? Now doubt will come. Doubt came. कि this is a PL OCI चलेगा, but this PL okay, but this is PL. Doubt came or not? अरे बोलना रे. Are you able to understand what I am saying? Not able to understand. Correct. This to your PL OCI you understood ना? Now doubt came for this. चलो इसको रट लो PL. This what PL OCI? Now written PL, but doubt will come or not? In exam you will be confused. Don't think about PL, think about why PL. You think about PL, but in exam can you retain all these points? Till you understood, you can't retain. So I need to explain. So actually what happened, let me explain you this point. Then only you will be able to understand why it is PL. Initially it was what? Initially it was FBTPL. Now it become what? FBTOCI. Correct. But we do accounting for reclassification on prospective basis, retrospective basis. So from this date it become what? OCI. So this gain or loss will be transferred to OCI. Now but this, suppose the fair value was 100 and now it become 120. So now we are measuring at what? 120. But this gain become what? 20. This gain belong to which period? This period or this period? So this will be transferred to PL ki OCI? PL. Understood why PL? So this is PL okay. This is okay. Now doubt will come for this. Now doubt, this is actually no doubt. Doubt is this. Yes or no? Are you understood what I am saying? So now I need to explain what? This. So let me explain this. AC. When I am saying AC become what? Either FBTPL or OCI. Correct? So abhi to this to, suppose this was amortized cost 100 was the amortized cost, and let us assume contractual rate of interest and ER are same. Let us assume if that is same, so this will be only amortized cost. But now we are doing accounting on what? Fair value become 120. So now this gain belong to what? This period 20. But when it was amortized cost, whether there was any fair value gain or loss? There was no fair value gain or loss. So this 20 will be accounted as per this now. As per this, because this gain happened on this date, and on this date it become a PL or OCI. Understood? Therefore it is PL or OCI. I hope you have understood now. This is PL, this is OCI. Chalega. Now next you will say, acha yahan par, if it become AC, if it become FBTUCI, so initially it was FBTPL, so there was no ER. It means now we need to recompute what? ER on the basis of fair value on reclassification date. Means you need to recalculate what? ER. So what will be ER? Batao? It will be rate of interest at which present value of remaining contractual cash inflow will be equal to what? Fair value on reclassification date. Fair value on reclassification date. However, in exam they will give you new ER. If not given, so you need to calculate in this way. Chalega. But can you say calculate ER based on what? Fair value on reclassification date. Now last point. FBTOCI become AC and FBTPL. So measure fair value. Gain or loss will be transferred to what? OCI. And ER, can you say once FBTOCI become AC, No adjustment to due to reclassification. Use original EIR. But in this case, EIR is not applicable. But one new point will come. Can you see, because it was FBTOCR, there was some cumulative gain or loss in FBOCR reserve that we need to close now. But you will say, if it become FBTPL, what you will do? FBTOCR now become FBTPL. So that cumulative gain or loss, what will do? Reclassify to PL, reclassified to PL. So entirely recycle from equity to PL as reclassification adjustment. But if it become FBT AC, so we can't transfer it to PL because now it become AC. So can you say for AC, so there should not be any gain or loss. So it will be adjusted with what? Financial asset account. Means it will be added or deducted from financial asset account, and after that adjustment, OCI will become AC from the beginning. OCI means FBT OCI will become AC from the beginning. So what they are saying, remove from equity and adjusted against fair value on reclassification date. Due to such adjustment, financial asset is measured at AC on reclassification date as if it has always been measured at AC. Correct? However, no question has been given in ICAI study material, but now this type of question can be asked where? In MCQ, therefore I have done it. If they have created a new question, so can you see, if you know this, you can do it. It is not difficult, not at all difficult, not at all difficult. Correct. We'll take a break. After break, we'll do topic number 4, then topic number 5. How many topics are there, you know? Sure. Sorry. We'll take a break of 30 minutes. Hello. Now, can we start once again, everyone? So before break, we completed up to topic number 3. Now come to recognition and measurement of financial liability. Financial liability will be easy to understand. No, I think no problem in financial liability. For the purpose of financial liability, recognition and measurement, what they say that there are of two types. One is FBTPL, one is amortized cost. FBTPL or amortized cost. Chalega? Now, if it is held for the purpose of trading, then FBTPL, otherwise it will be amortized cost. Means there is no FBTOCI for financial liability. So, only FBTPL and amortized cost. If it is held for the purpose of trading, then FBTPL, otherwise amortized cost. Means from exam point of view, nothing is given, always what? Amortized cost, because that will represent contractual cash outflow. So, if I am saying initial and subsequent measurement of financial liability, so for amortized cost and FBTPL, initial recognition will be done at fair value minus transaction cost, fair value minus transaction cost, and in this case it is what? Only at fair value, and transaction cost will be charged to profit and loss account as a expense immediately on balance sheet date by applying at amortized cost by applying EIR, once again by applying EIR, and it is what? At fair value only. Now, any fair value gain or loss, in this case not applicable. In this case it will be what? Transfer to profit and loss. Interest, in this case it will be transferred to PL and calculated by using EIR. Once again for FBTPL, once again there are two viewpoints. As per my viewpoint, it is not applicable. As per some other viewpoint, it can be interest will be recognized in PL when paid. Understood? That can be also one viewpoint. But from my point of view, it is not applicable. So we will not fight for this. Chalega? Yes, sir. Understood? Any doubt? Simple. I think in this to no discussion required. Question will come. You need to only calculate EIR and do amortized cost table. Okay. So in financial liability, I think no difficulty. Now, what one option has been given for both financial asset and financial liability? One option has been given for financial asset and financial liability for initial recognition. So entity has some irrevocable option initially. Means initially any financial asset or financial liability can be classified as FBTPL. If by doing so, the management can eliminate the accounting inconsistency. Means sometime what happened, by following different bases, there may be some mismatch in accounting. So to avoid that mismatch in accounting, we can follow FBTPL accounting initially both for FBTPL and both for financial asset and financial liability. So what I want to say, I'll just give one example. Suppose you have taken loan. I'm just giving one example. Suppose you have taken a loan correct, at a market rate of 10% of rupees 10 lakh, and you have invested this in what? Debenture. For simplicity, let us assume this is also at 10%, 10 lakh. Simplicity, of course this will be at higher rate of interest, but let us assume 10%. Correct. Now for this you are following amortized cost, and for this you are following FBTPL accounting. So can you see now there will be some mismatch in accounting because of this reason? There may be some mismatch in accounting. Are you getting what I am saying? Because here though you are transferring any gain or loss to PL, but in this case you are not transferring any gain or loss to PL. You are only recording interest expense by applying EIR. So to avoid here, to eliminate some mismatch in accounting, you can also measure these two what? FBTPL. Means both had what? FBTPL initially. So this option once applied, this is irrevocable option. Once applied, it need to be applied forever. Means this cannot be reclassified on a subsequent date. Understood? For that purpose, one para has been given. This key at initial recognition, any financial liability as well as financial asset can be irrevocably designated and measured at FBTPL. When doing so, result in more relevant information because it eliminates or significantly reduces a measurement or recognition inconsistency, sometimes referred to as accounting mismatch, that would otherwise arise from measuring asset or liability or recognizing the gain or loss on some different basis. So this can be important for MCQ's point of view. Chalega? Yes, sir. Now, reclassification of financial liability is not permitted. Why? Because can you say FBTPL option was irrevocable? So once again, reclassification of financial liability is not permitted. Once it is classified to FBTPL or AC, it cannot be reclassified to some other category. Chalega? So it means reclassification is only available for financial asset, that to only debt instrument, not equity instrument and derivative instrument. Okay, sir? Yes, sir. So this topic is over. Now come to topic number 5, derecognition of financial asset and financial liability. Derecognition of financial asset and financial liability. In this, from my point of view, derecognition of financial liability is more important from exam point of view. Correct? Because they have not given any good question for derecognition of financial asset. So from exam point of view, derecognition of financial liability is more important. But we need to do both. So when I am saying derecognition of financial asset, so when it can be derecognized, so what they said, if any one of the following conditions satisfied, then financial asset will be derecognized. The first condition is what? Any one, not all, any one condition satisfied to derecognize the financial asset. First, when contractual right to receive when the contractual right to receive cash flow has been expired, means you receive entire amount, then it will be automatically expired. So on maturity, automatically it will be derecognized. Suppose it is held to collect contractual cash flow till maturity. So on maturity, automatically it will be derecognized. Second, entity has transferred contractual right to receive cash flow from financial asset, means we have transferred contractual right to receive cash flow to some other party, and with that also transfer substantially all the risk and reward of ownership of such financial asset. Correct? For example, suppose we have a receivable, we have a right to receive cash flow, that right has been transferred to some other person, and with that right we have also transferred all the risk and reward arising from the ownership of such asset to that party. If risk and reward is also transferred, then derecognized. But suppose the agreement has been done in such a way that in case of bad debt, the bad debt will be borne by me only, then it means risk and reward has not been transferred, then we cannot derecognize the financial asset, even though you have transferred the right to collect, but we can't derecognize such financial asset. Chalega? Similarly, point number C says what? Entity may retain the contractual right to receive cash flow but assume contractual obligation to pay cash flow arising from such financial assets. Sometimes what happens? Suppose we want to transfer our debtor to some other party, but can you see that the debtor does not know you? Means suppose I want to transfer my debtor right to collect to you, but if you ask debtor to give that amount, that my debtor will not pay you now. It is quite possible in that case what I will do, I will retain the right to collect. But I will, once the amount is collected, the entire amount collected, I will have a contractual obligation to pay the amount to you. So it means I have retained the right to collect, but once the amount collected, I will transfer that amount to you, and all the risk and reward of such financial asset has been also transferred to you. Means in case of bad debt, all the loss will be borne by you. So in that case, we should derecognize the financial asset, even though we have a right to collect. Understood? Yes, sir. So entity retain the contractual right to receive cash flow, but assume contractual obligation to pay cash flow arising from such asset, and also transfer substantially all the risk and reward of ownership of such financial asset. Correct? Last point what they said is sometimes what happen, the financial asset may not represent contractual cash outflow. For example, in case of investment in equity shares, there is no contractual cash flow. In that case, what they are saying, the entity has not retained control of the financial asset. Means if the control of that financial asset has been transferred, so will de-recognize the financial asset. Understood all this point? So any one condition satisfied, it will be de-recognized from our books of account. No, the contract. Suppose I have a loan, which suppose I have a loan receivable. So I will receive interest amount and principal amount during the 5 year or 10 year. So I have retained the right to collect. But we have done one agreement that once the amount is collected, so I will have an obligation to transfer that cash to you. So automatically I have transferred the amount to you only. But why I am retaining? Because that person will not pay you. So the contract has been designed in such a way that ultimately the entire cash flow has been transferred to you only now. Only I am retaining the right to collect. Once collected, that amount will be transferred to you. So that contract has been designed in such a way. Understood? This is based on contract only. Got this point? Yes, sir. Now these examples are given when risk and reward is transferred or not, that you can read by your own. Now in this case, for the purpose of accounting treatment, there are two things. First, when the transfer qualify for de-recognition. Second, when the transfer do not qualify for de-recognition. Can you say whenever transfer do not qualify for de-recognition, means risk and reward has not been transferred. In that case, we will not de-recognize the financial asset, but we receive the consideration. So whatever consideration received, that will be accounted as financial liability. We will pass one journal entry bank account debit to financial liability, and that financial liability will be subsequently measured at amortized cost by applying EIR. It means, can I say, we will not de-recognize the financial asset, and whatever consideration we have received, that will become financial liability. For this we will apply amortized cost. For this it can be either AC or PL or OCI as the case may be. Correct. And then we'll follow what subsequent accounting as per the classification criteria. What is point? So in simple word, what I want to say, continue to recognize the transferred asset in its entirety. Correct. Recognize the financial liability for the consideration received. The liability is subsequently measured at amortized cost using effective interest method. And in subsequent period, recognize any income on the transferred asset and any expense incurred on financial liability. Means on this, do you recognize interest expense? On this, whatever income as per the nature of classification that you recognize. Understood? Yes, sir. So this can be also asked in MCQ now. Whenever it do not qualify for de-recognition, then what will be the accounting treatment? But whenever it qualify for de-recognition, there can be two situations. Either it can be a complete de-recognition, it can be partial de-recognition. So whenever complete de-recognition, to de-recognize the entire asset, what journal entry will do? Bank account debit to financial asset, and any difference will be what? Gain. Any difference will be transferred to PL or OCI as the case may be, depending upon the classification of that financial asset. So any difference will be transferred to PL or OCI. Correct. And can you see if this is financial asset is FVTOCI? So it can be either with recycling or without recycling. In that case, the cumulative gain or loss will be either transferred to PL, reclassified to PL, or transferred to retained earning, depending upon debt instrument or equity instrument. So if this is a debt instrument, it will be reclassified from OCI to PL. If it is equity instrument, then it will be directly transferred to retained earning. Got this point? Chalo, that is only given. Now whenever partial de-recognition, so what they want to say, just try to understand. I will explain you. Suppose we have a loan, 10 lakh is the carrying amount, and let us assume EIR is equal to 10% and contractual rate of interest is also 10%. Correct. And the remaining life is 5 years. So can you say year 1, year 2, year 3, year 4, year 5. So what is the contractual cash inflow? 1 lakh. 1 lakh plus what? 10 lakh, 10 lakh. Understood? Have you understood? It is quite possible that out of this contractual cash inflow, we have transferred this, but we have not transferred this. Correct now. Or it is quite possible 50% of interest we have transferred and 50% of principal amount has been transferred and the balance portion has been retained. So this is known as what? Partial derecognition. So in that case, what they want to say, if first find out fair value of transferred portion and fair value of retained portion. Fair value of retained portion. Here is it, that is based on what? If you are calculating present value, suppose this interest has been transferred. So this become transferred portion and this has been retained. This become retained portion. So how to calculate fair value? Batao. By using what? By using what? This will be present value. The transferred portion will be what? Present value of this portion discounted by using what? Market rate of interest on that date. That will be given in the question. That rate of interest will be given in the question. So guys, you can easily calculate. You can easily calculate. So first we'll find out what fair value of transferred portion as well as fair value of retained portion based on the rate of interest given on that date. Normally they say expected yield rate. Expected yield rate is nothing but market rate of interest. Nothing but market rate of interest. Yield rate means what? I think in AFM you use this word yield rate. Yield rate is what? Whatever you are expecting from the market, whatever you are expecting from that financial asset, that become yield rate. So that is nothing but market rate of interest. Understood what I am saying? This yield rate you have done in AFM now. That is nothing but market rate of interest. Okay, correct. So this will be given the question, you can calculate. Now, so this become fair value. Now, the carrying amount of this was 10 lakh. So what they want to say, this 10 lakh will be allocated to transfer portion and retained portion in the ratio of their fair value. In the ratio of their fair value. Understood? So this you need to allocate in the ratio of their fair value. So that allocation you can do. Once you have allocated, so you have transferred this portion. So what journal entry you do? But the bank account debit to what? Financial asset. Correct. So bank account will be with fair value and financial asset will be with carrying amount, and the difference will be transferred to PL or OCI as the case may be. Correct. And we need to recognize this portion also. So retained portion will come in the balance sheet at fair value or carrying amount. Carrying amount. So what they want to say, this can be either principal portion or it can be interest portion. So we need to disclose how much principal portion retained, how much interest portion retained. We need to pass one journal entry principal strip account debit or interest strip account debit to what? Financial asset. So this will be with allocated carrying amount. Allocated carrying amount, and in this will not recognize any gain or loss. Will not recognize any gain or loss. Understood? So some portion of interest might be retained, some portion of principal might be retained. So this amount will be what? Can be allocated to interest portion and what? Principal portion. So this become what? Interest portion. This become principal portion. So what journal entry we are doing? Principal strip account debit, interest strip account debit to what? Financial asset. Understood? So this become one journal entry. However, I have seen this type of question they have not given in ICAI study material, but can be asked. Can be asked. Correct now. So already I said this financial asset is not so much important from exam point of view. What is important? Financial liability is more important from exam point of view. Chalega? Yes sir. So I have just informed you what to do to what they have given. First we should calculate what? Fair value of transferred portion and retained portion by applying expected yield rate. That will be given in the question. So fair value of transferred portion, fair value retained portion, so this become fair value of financial asset. Then allocate the carrying amount of financial asset in the ratio of fair value. So this we know we can allocate. Then accounting treatment for transferred portion, bank account debit to financial asset. Any difference will be transferred to PL or OCI depending upon the nature of financial asset. For retained portion, it is principal strip account debit, interest strip account debit, or servicing asset. Servicing asset I need to explain to financial asset. Servicing asset I need to explain. Correct now. But this show you have understood? Correct. Now servicing asset means what? Sometime what happen? If I am collecting on behalf of you, this when I explain point number C I explain now this one. So in that actually the asset has been transferred, but now I am collecting on behalf of you. So I am providing some services to you. So I will not do free of cost now. So some portion of interest might be retained as a servicing fee. Some portion of interest might be retained as servicing fee. For example, the total rate of interest is contractual rate of interest 10%, but I said 2% I will retain because I am providing some services to you. So that is recognized as servicing asset. Servicing asset. Understood? Correct. Are you getting what I am saying? So fair value of that servicing asset might be given the question, or you can calculate it for 2%. You can calculate it. Correct now. So that if given, so can you see, you can find out a carrying amount with this allocation criteria. So that servicing asset will also come at allocated carrying amount. So what journal entry हुआ? Principal strip account debit, interest strip account debit, servicing asset account debit to financial asset with allocated carrying amount. Allocated carrying amount. चलेगा. Understood. Now in this case, can I say if this financial asset is FBTOCI, so we'll have what? Some cumulative gain or loss. So that cumulative gain or loss will be also allocated to both transferred and retained portion in the ratio of their fair value. In the ratio of their fair value. So that cumulative gain or loss of that financial asset will be allocated to transferred portion and retained portion in the ratio of their fair value. For the transferred portion, can I say for the transfer portion, it will be either recycled to PL or transfer to retained earning depending upon it is a debt instrument or equity instrument, and for retained portion it will remain in the balance sheet. That point is given here. A cumulative gain or loss that has been recognized in equity account is allocated between the part that continues to be recognized and the part which is de-recognized based on the relative fair value of those parts. Any cumulative gain or loss allocated to transfer portion will be either reclassified to PL if what? Debt instrument, or transfer retained earning if what? Equity instrument. This all may be what important for MCQ. All points. No question of this nature has been given ICAI study material. Correct now. So it means they are not going to this extent. They are not asking this type of question in exam. However, I will say these are more interesting questions. These are more interesting questions. Correct? Okay, sir. Done. Now there is one concept of continuing involvement of entities in transferred asset. For this one question has been given in ICAI study material. Continuing involvement of the entity in transferred asset. So I will just explain that concept. What I want to is, suppose you have a financial asset of rupees 10 lakh, 10%. Correct? And you have transferred it, and you have given a guarantee that you reimburse a loss to the extent of 2 lakh. To the extent of 2 lakh. Understood? Means in case of bad debt, only a loss to the extent of 2 lakh will be reimbursed. Means if suppose bad debt is 5 lakh, so it means only 2 lakh will be reimbursed, 5 lakh will not be reimbursed. So this is known as continuing involvement in the asset. Continuing involvement in the asset. Means if I say I will reimburse the entire loss, then can I say then the risk and reward is not transferred, then it will not be de-recognized. But in this case what happens? Only to the extent of 2 lakh there is some involvement. Only to the extent of 2 lakh there is some involvement now. For 8 lakh so there is no involvement. Are you able to understand? So this is known as continuing involvement of the asset, continuing involvement of the entity in the asset transferred. Got this point? Correct. So in this case what they want to say? Suppose you have transferred this at let us assume you have transferred at rupees 8 lakh, let us assume, correct, and the guarantee fair value is given, fair value of guarantee is given is 50,000, fair value of guarantee is given 50,000, means can you say out of this 8 lakh you are receiving how much for guarantee? 50,000, means 7 lakh 50,000 you have received for what? For the transfer of asset. Means suppose if I am giving guarantee to you that you will pakka pass in exam. If I have given a guarantee to you that you will pakka pass in the exam, if you do not pass I will refund the amount. So my fees will be 10,000 ki more than 10,000? More than 10,000. Yes, because I am giving guarantee. So 10,000 is for teaching. Whatever extra I am receiving, that is for what? Guarantee given. So similarly, if I receive 8 lakh, so out of this 8 lakh, some amount I am receiving for what? Guarantee given. So the fair value of guarantee given is given how much? 50,000. So how much you have received for the transfer of asset? How much you have received for transfer of asset? 7 lakh. 7 lakh 50,000. Understood? So what they want to say? Ki first pass one journal entry. Just try to understand this journal entry. Bank account debit to financial asset. How much you have received for financial asset? 7 lakh 50,000. What is the carrying amount? 10 lakh. So what is the loss? Loss is equal to how much? 2 lakh 50,000. This journal entry you have understood? Because there is only one question can be asked in exam. If you have understood this now, that journal entry you can understand by your own. Second, but how much you have received for guarantee? How much you have received for guarantee? To what? This will be known as associated liability. We call it what? Associated liability. Means it is as simple as pre-received income. Pre-received income. Pre-received income. And this income will be transferred to PL over the period of guarantee. It will be transferred to PL over the period of guarantee. Understood what I am saying? Correct. Now, the guarantee is given for how much amount? 2 lakh. So it means we have an involvement in how much component? 2 lakh. So what they are saying, for 2 lakh you recognize one asset, continuing involvement asset, continuing involvement asset, continuing involvement asset. Account debit how much? 2 lakh, because that portion so you have already given guarantee. It means that portion should not be de-recognized, but here to you have de-recognized the entire asset. Now you will also recognize an asset to the extent of continuing involvement of the entity to the extent of 2 lakh. Correct. It means now if that amount is not collected, so that become your loss. Your loss. So it means this should be your asset. Are bola re? If that amount 2 lakh is not collected, if this 2 lakh is not collected, it is your loss. Means right now it is your asset. Therefore you can't de-recognize it. But if the amount is collected, then what you will do? You need to repay this amount to whom? To the other party. So with this you will also recognize one associated liability of what amount? 2 lakh. So this become 3 journal entry. Have you noticed this 3 journal entry? Now can you compound this? So in ICAI book they have given compound journal entry, but the bank account how much? 8 lakh. Continuing involvement asset how much? 2 lakh. Associated liability how much? 2 lakh 50,000 now. 2 lakh 50,000. To financial asset how much? 10 lakh. And loss how much? Loss how much? 2 lakh 50,000. So in your ICAI book they have given this journal entry. Now I hope you have understood this journal entry. This journal entry. So only one question has been given, that is not yet asked. Can be asked in exam. Have you understood this journal entry? So this journal entry you need to pass in exam. Don't pass these 3 journal entry. They will not understand. However, they are same na. You can pass, but on your risk. Now, but if you have understood this, so you can pass this journal entry na. Because I am going entirely from examination point of view. I don't know what is the knowledge of that person who is checking your paper. They will say, "Arey, one journal entry, you have done 3 journal entry, katta laga." Got na? I don't know the level of understanding of that CA. And if they are only checking on the basis of what? Solution. So sometime what happens, this type of marks ऐसा हो जाता है. Correct ना? When why to fight after exam? Fight before exam only na? Why to fight before after exam? Fight before exam. So we'll follow this. So once you have understood, you can do this now. Understood. And that is only mentioned. Now you'll be able to understand what they want to say. Ki whenever there is a continuing involvement of entities in the transferred asset, then entity continue to recognize the transferred asset to the extent of his continuing involvement, which is equal to lower of carrying amount of asset transferred. In our question, how much? 10 lakh. And the guaranteed amount, how much? 2 lakh. Whichever is lower. First point, have you understood? Second, the entity also recognize the associated liability which is initially measured at guaranteed amount. In our question, how much guaranteed amount? Guaranteed amount 2 lakh plus the fair value of guarantee, how much? So what is the associated liability we have done? 2 lakh 50,000. Correct. The guarantee liability means the fair value of guarantee shall be amortized to PL over the guarantee period. Means this 50,000 will be transferred to PL during which period? Over the period of guarantee. And they have given this compound journal entry in what? ICAI statement. So cash account debit. In our question, cash how much? 8 lakh. Continuing involvement asset, receivable 10 lakh. Asset liability 2 lakh 50. And the difference will be gain or loss. Understood? Correct. Read on MRQ. Must revise. Otherwise you'll forget. Only one question. That question is not yet asked. Can be asked same to same question. Sometimes झटका देता है in exam. This question not yet asked. Let us ask now this question. Correct? Understood? Now next point is what? De-recognition of financial liability. De-recognition of financial liability. This is important from examination point of view. Now can you see when to de-recognize financial liability? When the liability is extinguished. When the liability is extinguished. When it is extinguished, can you see when the obligation is discharged, or the obligation is cancelled, or the obligation is exchanged, or the obligation is modified. Understood? Now what is the journal entry for discharge? Financial liability account debit to bank. Any difference will be transferred to PL. What is journal entry for cancellation? Financial liability account debit to PL. Financial liability account debit to PL. Exchange. So exchange with equity. What journal entry? Financial liability account debit to equity. Modified. Can this thoda sa I need to explain? Modified. So this is only important from exam point of view. Modified. Modified. So what IND AS 109 says that modification of financial liability are of two types. Right. When modification is substantially different from original term, or modification is not substantially different from original term. So what they are saying? First find out whether modified terms are substantially different from original term. Then will follow extinguishment accounting. Then will follow what? Extinguishment accounting. But if modified terms are not substantially different from original term, when modified terms are not substantially different from original term, then will follow what? Modification accounting. Modification accounting. Correct. From example, this is more important. Extinguishment accounting. Correct. So now how we'll understand it is substantially different? For the first time in India, they have given a principle to identify substantial amount. Only for this particular word substantially, for the first time they have given some indicator. So they say कि if A minus B is greater than or equal to 10% of B, then it means if this equation is satisfied, then it means it is substantially different. Now I need to explain what is A and what is B. So A means what? A means what? Present value of modified contractual cash outflow plus any modification, legal fee paid, better write on legal fee paid plus legal fee paid discounted at original EIR, So A means what? Present value of, बोलो ना, A is equal to what? Present value of modified contractual cash outflow plus legal fee paid discounted by using original EIR. You can calculate. What do you mean by B? B means nothing but carrying amount of financial liability, on the date of modification. Okay, this is nothing but amortized cost, and amortized cost is nothing but present value of remaining contractual cash outflow as per original term, discounted by using what? Original EIR. Understood? So can you see, you have understood A, you have understood B, and if A minus B is greater than or equal to 10% of B, it means it is substantially different. Otherwise it is not substantially different. So if it is substantially different, we'll follow which accounting? Extinguishment accounting. Now extinguishment accounting means what? Will de-recognize old liability, correct? But that will de-recognize old liability at which amount? Carrying amount, correct? Now we recognize what? New liability at which amount? At fair value, correct? And can you see whatever legal expense paid, that will be bank to bank. The difference will be what? Gain or loss on de-recognition, which will be transferred to what? PL. Understood? Correct. So can you this carrying amount to understood? No explanation required. But what is this fair value? But the fair value what? Present value of modified contractual cash outflow discounted at what? Discounted at market rate of interest. Understood? Conceptually no ratification. I have not said, you only said market rate of interest. I have not said anything now. This is concept, correct? Now one doubt will come up here. So we are using what? Here same thing, a present value of what? Discounted by using what? Here we are taking what? So which one is correct? Both are correct. So this will be, comparison will be done at what? This we are comparing now. A we are comparing with B. So comparison we are doing at what? Original EIR. And fair value we are calculating by using what? Market rate of interest. Acha bata, why we have not taken market rate of interest? We could have taken market rate of interest also na. क्या फर्क पड़ता? हाँ? Very good. चलो ठीक है. I understood your emotion. Can I say whenever we do compare, comparison is done at what? Equal basis. Can I compare me with you if you become CA? Suppose in this atom you become CA. Whether we are comparable, either I need to come to your age or you need to come to my age. Then only it is comparable. Then we can decide who is earning more. Correct na? Right now once you become CA, both are CA, but that is not comparable. So can you say either you should make both at market rate of interest or both at what? Originally, yeah. Because carrying amount already calculated at what? Originally, yeah. Therefore they want to compare with what? Original, yeah. But fair value will be at what? Market rate of interest. Understood? Have you understood this point? I think understood. This is one important concept. Already asked in exam 2-3 times. Once again it will be repeated. Once again it will be asked in exam. But very simple or not? Simple. I like to take one question so that थोड़ा practice होता. Come to one question. This question only. On 1st Jan 2020, XYZ Limited issued 10-year bond for rupees 10 lakh, bearing at 10% payable annually on 31st December each year. The bonds are redeemable on 31st December 2009 for rupees 10 lakh. No cost of fee are incurred. No cost of fee are incurred means there is no what? No transaction cost. No transaction cost. It means EIR will be equal to market rate of interest. And but if nothing is given, this contract will be at market terms or off market terms. Market terms, off market terms. So can you say contractual rate of interest will be equal to what? Market rate of interest will be equal to what? EIR. All are same. In this question, all are same. Therefore, the effective interest rate is therefore what? 10%. Can you say we know this point? We know this point. Even though not given, we know this point now. On 1st Jan 2005, after 5 years, something happened between company and bondholder agreed to modification in accordance with what? The terms is extended to 31st December 2011. Means initially it was how many years? Up to 31st December 2009. So extended by 2 years. Interest payment are reduced to 5%. Initially it was 10%. Now become 5%. The bonds are redeemable at 15 lakh. Initially it was how much? 10 lakh. Now redeemable at what? 15 lakh. Legal fee and other fee are incurred 1 lakh. But this is what? This is what? I'm asking what is this? Whether this is a transaction cost? This is not this is not a transaction cost. Because transaction cost is incurred on initial transaction. This is what? A modification cost. It is a modification cost, not a transaction cost. There is a difference between transaction cost and modification cost. So the initially they gave no cost means there was no transaction cost. So this 1 lakh is not a transaction cost, it is a modification cost. Okay sir? Yes sir. XYZ Limited determined that market rate of interest was what? 11%. Understood why this is given? 11%. Correct. Record journal entry. Understood. Means can you say first we need to do analysis of what? Substantial term. Analysis of modified terms. First we'll find out A. A means what? Present value of modified contractual cash outflow plus legal fee paid. We need to first find out interest component. So what is the interest component? Modified interest. Now it becomes 5%. 5% of 10 lakh means 50,000 is payable for how many remaining year? Initially 10 year, now extended by 2 years. It become 12 year. How much expired? So how much remain? 7 years. You will find out present value factor at a rate of what? At what rate? 10%. For how many year? 7 year. Very good. So this is at what? Original EIR. Original EIR. This you can calculate. Can you give me fast? This is annuity factor, na? Annuity factor. You have given amount only. Very good, ba. Very good. How much? 2 lakh? 421. Then can you will do principal component? Principal component how much? 16 lakh, na? Is payable at what? 15 lakh. So now it is payable what? 15 lakh. So 15 lakh. Can you give me present value factor at a rate of 10%? 7 years. So 15 lakh multiplied by how much? 4 point. No, annuity factor not. Present value factor. 0.5132. How much it is coming? 800. Can you give me the total? 10 lakh to 21. Then we'll add what? Legal fee paid. How much paid? 50,000 na? 1 lakh. So 1 lakh add kar do. So this become how much? 11,30,221. This become A. We'll compare with B. So B is what? Carrying amount. Here is whenever contractual rate of interest and ER are same. In this question, contractual rate of interest and ER are same. Then interest expense and contractual cash outflow will be same. Then opening balance and closing balance will be same. Therefore, there is no need to find out carrying amount. Can I say opening balance was 10 lakh? So closing balance will be also 10 lakh. So can we write down directly if you permit me? Or calculate what? By using amortization cost table. But it is simple, understood now. Why to calculate? Carrying amount will be what? 10 lakh only. Understood now. So whenever contractual rate of interest and EIR are same. So opening balance and closing balance are same. So batao. A minus B is what? 1,13,222. Can you give me 10% of B? 1 lakh. So batao which one is greater? This is greater and therefore it is substantially different. Therefore we'll apply which accounting? Extinguisher accounting. So what journal entry will do on the date of modification? So I think 1/1/2005 na? Date of modification on 1/1/2005. But the what journal entry? Old liability how much? 10 lakh. New liability how much? And to bank how much? Bank will be 1 lakh. Can you give me new liability? Now you need to find out present value by using which rate of interest? New year. New year is different, huh? Market rate of interest. By using market rate of interest. Market rate of interest is given how much? 11%. So same thing, the contractual cash outflow remains same. So 50,000 multiplied by present value annuity factor for 11% for how many year? 7 year. Can you give me this? 610. And 15 lakh multiplied by what? Present value factor. Correct now. By using the same, can you give me this? 7 lakh 488. Can you give me the total of these two? Nine lakh 58,000. So difference will be what? Either gain or loss. I think there is a gain na. Loss. Loss how much? 58,098. Okay, subsequent accounting you can do. Subsequent accounting you can do. But my question to you, interest expense of the next year will be calculated by using which rate? EIR. What is that EIR? What is that market rate of interest? 11%. Very good. Understood the concept? You are saying EIR okay, but there is no transaction cost. So it will be equal to what? Market rate of interest. What is the market rate of interest? 11%. देखो कितना आसानी हो रहा है. We are getting everything now. So if you know the concept, everything will come with flow. All points will come with flow. Otherwise, an exam will stuck, and once stuck, I will take more time. Will do some wrong. So that flow is required in exam. This flow. So you can do in a very speed way. So now you can prepare an amortization cost table by using which rate of interest? 11%. That you can do. At 11% will be applied on which amount? On new liability. Chalega? Yes, sir. Done. This you have understood. The same thing is given. You can read this. Yahan tak pura we have done. Now for modification accounting, from my point of view, they will not ask modification accounting, but if they ask, then what to do? From my point, they should not ask, but if they ask. Now modification accounting in AS 109 is totally silent. Means they have not given accounting treatment. They have given only that we need to follow modification accounting. But what is that accounting? They have not given. Therefore, ICAI has given two accounting approach. ICAI has given two accounting approach. One is easy, one is fair. Whenever option is what? One will be easy, one will be fair accounting. So this suggestion has been given by whom? ICAI. This has not been given where? IND AS 109. It has not been given under IND AS 109, but of course we are giving which exam? ICAI exam, so we need to follow what? ICAI guidance, correct now? Practically, you can give your suggestion also, because this is not mandatory now. This is not mandatory. I hope you are understanding. So what they are saying, recognition first is what? He recognize entire gain or loss on the date of modification. First approach is what? Recognize entire gain or loss on the date of modification. So in this case, what we will do? Whatever modification cost was incurred, that will be charged to PL. So any fees or cost incurred will be recognized in PL. Will be recognized in PL. Correct. Then what we'll do? We restate the liability. So original liability means carrying amount will be restated at an amount equal to present value of modified cash flow. Present value of modified cash flow by using original EIR. By using original EIR means will not change the EIR. Will not change the EIR. We restate the liability at a discounted present value of remaining cash flow of the new financial liability by using original EIR. So that we can find out. So any difference due to restatement will be also transferred to PL. Any difference between revised liability and original liability, that will be also transferred to PL. So any difference will be transferred to PL. This is one approach. This is simple approach, but not fair. Correct. Second approach is what? He will not transfer gain or loss or modification immediately to PL. It will be amortized on some systematic basis. So in this case, what we'll do? Whatever amount has been paid, means whatever modification cost has been paid, that will be treated as reduction of liability. We will pass one journal entry bank account debit to financial liability. So financial liability will reduce with that amount of modification cost paid. That will be known as adjusted liability. And now we'll calculate a new EIR. We'll calculate new EIR. That will be the rate of interest at which present value of modified cash flow will be equal to that adjusted liability. Will be equal to that adjusted liability. In this we need to compute what? New EIR. And new EIR will be equal to what? Rate of interest at which present value of modified cash flow will be equal to adjusted liability. That we can calculate. And with that EIR, now we'll do subsequent accounting. Subsequent accounting. So these two approaches are given. I don't know whether it is important or not important. Correct now. But if they ask, you need to do. If suppose question is silent about approach, from my point of view, you should go for approach 2 in exam. Because ICAI, they have given one illustration with approach 2 only. So they also think approach 2 is more fair. I also think approach 2 is more fair. So from my point of view, question is silent. Go for what? Approach 2. Or if you have time, give both approach. Your choice. But time to hoga nahi. Correct? Yes, sir. Now the next last point in this might be important for MCQs. Ki whenever liability is exchanged with equity, so what journal entry will do? Debt account debit to equity. Equity na. But at what value? At what value? So once again, two preference has been given. First, we will take fair value of equity instrument issued. If it cannot be measured reliably, so or fair value of financial liability extinguished. Financial liability extinguished, whichever is reliably measurable. So first preference will be given to what? Fair value of equity instrument issued. Second preference will be given to what? Fair value of liability extinguished. Whichever is given in the question. If both are given, then fair value of equity instrument issued. Chalega? Yes, sir. That is only given. I think you can read, you will be able to understand. Only one question. Apply your common sense. Apply your common sense. This difference, gain or loss, will be transferred to PL equity. PL or equity? PL or equity? PL. It means now so you have understood now. So whenever in exam you are stuck, apply your common sense. Most of the time you will be correct. Don't think much. Apply your common sense and proceed. Now let examiner, evaluator decide they will give marks or not. In exam, do all the question 100 marks question. Na? Only one rule of passing. Means I used to say when I was student na, तो हम लोग यही बोलते थे. One rule of passing the exam is attempt 100 marks paper. if you want to pass in the coming attempt. इसको तो rule बनाओ. One rule of passing the exam is what? Attempt 100 marks paper. If you are attempting 80 marks, 70 marks, then probability is less because they will give average marks. They will give average marks 50%. कितना भी लिख लो, don't expect more than 50%. In theory paper तो never. In theory paper you are writing 80 and you are expecting 60, then to you are Paramatma. Then think about rank. Then don't think about pass, think about rank. Yes or no? If you are getting 60 out of 80, so this is how much percent, you know? 60 divided by 80 means 75%. Rank holder marks है तो. Then you should not worry only. Am I right or not? Are you getting what I am saying? देखो क्या होता है. I am saying question number 1, question number 2, question number 3, question 4, question 5. 5 questions. Can I say 1 or 2 question will be perfectly known to you? I am taking conservative. Out of these 2 questions you know perfectly. 3 questions you don't know perfectly. You don't know perfectly. You know but you don't know perfectly. Because when you have done the chapter, you know na, but you don't know perfectly. Am I right or not? It means in this you can score what? Suppose it is at 20 marks, 20 marks, 20 marks, 5 questions. Huh? So in this you can score perfectly, I am saying. So you can score what? More than 50? अरे बोलना रही. I am not saying 20. I am not saying 20. I am saying more than 50 तो बनेगा ना. 50 लो, 15, 50 लो, 30 तो हो गया. Only 20 marks required. This is only the game. Game is what? Calculation. Game is of calculation. Now, you don't know perfectly. तो मिनिमम से मिनिमम 8 मार्क्स तो आएगा ऑन एन एवरेज. तो 8, 8, 8 यू आर पास. और चलो ठीक है 6, 6, 6. हाउ मच देयर इट इज कमिंग? हाउ मच इज कमिंग? 48. 48 ना 48 आया. तो इट मीन्स थोड़ा सा यू विल डू एफर्ट, इट विल बी 60 प्लस. इट विल बी 60 प्लस. Scoring is very easy when you think about calculations. Correct now. But if you think we'll do only 4 questions and we want 50 marks, chances there is but that in that 4 questions it will be very much perfect. All chapters whatever you have done you should be super and then go to exam hall. And we know how much we are super. Correct now. Got this point? Because one information change, super question become difficult question. Super chapter means very good chapter will become difficult. Means I always say question paper is difficult only in exam hall. When we come out of exam hall now, that same question paper will be easy. Means if you read my question paper of November 2005 exam, you say, sir, तो ऐसे बन गए सीए. Because that is question na. Now it is out of exam hall. Same question paper I will give you in exam hall. That paper will become what? Difficult. So question paper is difficult only in exam hall. Outside exam hall now, you will feel, arey, this question itna easy. Correct? So that you need to understand how to score. And scoring is very easy if you think about calculation. Correct? Understood? And any chapter which you know, for example, suppose consolidation, business combination, 2 chapters are there. चलो ये तो एक ही चैप्टर है मान के चलो इन अकाउंटिंग में. फाइनेंशियल इंस्ट्रूमेंट देयर आर 2 चैप्टर. यू नो इससे भी 20 मार्क्स, इससे भी 20 मार्क्स. करेक्ट ना. बट यू नो दिस, यू आर मोर कंफर्टेबल इन दिस, यू आर नॉट कंफर्टेबल इन दिस, मान लेते हैं. तो कैन यू शुड डू दिस चैप्टर इन सच ए वे दैट यू शुड स्कोर 20 मार्क्स इन दिस. नाउ इन दिस आल्सो यू आर लिविंग सम कॉन्सेप्ट, यू आर लिविंग समथिंग. तो ये तो गोन कैसे है. दिस आल्सो गोन केस इन एग्जाम. So whatever you are doing, that should be on perfection basis. On perfection basis means the chapter you are thinking that this is my backbone of the question paper. So that you should do on a complete basis. You can't leave anything on that, because that you are going as per what? This is my scoring chapters na. In that also you are doing, no, this point I will not do this question, I will not do this question, I will not do. And same question will come then. Got it? So this you need to or calculate. Take risk, but calculated risk. Calculated risk. Then 50% is very easy to score. But what we do, we don't take calculated risk. We don't think about that. Understand what I'm saying? So if you want to take risk, take calculated risk. Be smart. Correct. Chalo. Now this also done. Now let us come to impairment. Impairment is also important from exam point of view. But from exam point of view now, this is theoretically, but this theoretically is not so much important. They have given 4 to 5 questions. If you have done that 5 questions with common sense understanding, so this topic done. However, in detail, though it is very lengthy. Impairment of financial asset. Are you getting what I am saying? So they have given only 5 questions. I will say do that 5 questions. Out of that 5 questions, 3 questions already asked in exam. It means they are asking question from that only. They are not creating new questions. Correct now. So out of that 5 or 6 questions, whatever, do all the question, go to exam, or similar question is going to be asked in exam. Practically. But let us understand what they want to say. Means when I am saying impairment of financial asset, so we have understood that we have what? AC, FVTOCI, debt instrument, FVTOCI, equity instrument, and what? FVTPL. Correct? Understood? And it will also include one more, lease receivable. Correct. IND AS 116 says that derecognition and impairment of lease receivable will be as per IND AS 109. As per IND AS 109. So entire accounting is as per IND AS 116. But for impairment, it is as per what? IND AS 109. So impairment of lease receivable is covered where? Under IND AS 109. Chalega. Now, whenever we do impairment testing, so impairment testing is based on what? Fair value and contractual cash flow. Means if you think recoverable amount, so recoverable amount under IND AS 36 was based on fair value less cost of disposal or value in use, whichever is higher. We compare on 2 bases. Now when I say fair value, so okay, this does not have any fair value. We don't do accounting on fair value. We do accounting of these on fair value. And can I say it has contractual cash flow? It has contractual cash flow, but it does not have any contractual cash flow. And it has what? Contractual cash flow, lease receivable. So what IND AS 109 want to say? Can I say this is already impaired based on what? This is already impaired based on what? Fair value. And they do not represent what? Contractual cash flow. Therefore, this will be outside the scope of impairment testing. This will be outside the scope of impairment testing. Means impairment testing may only this will be covered, this will be covered, and this will be covered. Understood? So what is the scope of impairment testing in this chapter? Scope is what? It will cover AC, debt instrument, FVTOCI debt instrument, and what? Lease receivable. These all are MCQ questions. Correct? So what is the scope? Scope given what? The entities shall recognize a loss allowance for expected credit loss for a financial asset that is measured at amortized cost. Of course, this is debt instrument. A financial asset that is measured at FVTOCI, this is also debt instrument. And a lease receivable. Means financial asset measured at FVTPL and financial asset measured at FVTOCI equity instrument are not required to be tested for impairment. Now, how to perform impairment testing? Correct. Well, like first find out present value of contractual cash flow, remaining contractual cash flow, discounted by using original EIR. This is nothing but carrying amount. Correct. From this minus present value of contractual cash flow which are expected to be received, using what? By using original EIR. Correct. This difference will be what? This difference will be known as ECL, expected credit loss. We call it ECL. Means first find out the present value of total remaining contractual cash flow means carrying amount discounted by using original EIR. Then find out present value of contractual cash flow which are expected to be recovered. Means simple word can I say ECL is nothing but present value of contractual cash flow which are not expected to be recovered. Discounted by using what? Original EIR. Discounted by using original EIR, that become ECL. Now once you calculated ECL, then we need to find out credit loss allowance. Now this credit loss allowance will be based on 12-month ECL or lifetime ECL. This lifetime ECL and 12-month ECL. 12-month ECL, so we'll do ECL multiply by probability of default in the next 12 months. Probability of default in the next 12 months. When I am saying lifetime ECL, it is ECL multiply by probability of default in over what? Lifetime. Because from exam point of view, when they give practical question, so they will give either this or this. So you are not supposed to think we should apply 12-month or lifetime. They will give based on the question only. So they will give either this or this. So you are not supposed to miss from practical question point of view. Okay, this point is not relevant. When to apply 12-month ECL, when to apply lifetime ECL. That will be as per the information given the question. But if they have given both, then you should think about that. So till now that type of question has not been given in ICAI study material. Are you getting what I am saying? Correct. But this too you have understood. Now we need to understand when to apply what? 12-month ECL, when to apply lifetime ECL. For that purpose, they have given two approaches. One is known as simplified approach. One is known as general approach. General approach. Simplified approach is applicable for trade receivable, and lease receivable, correct? Are you getting what I am saying? Simplified approach is applicable for what? Trade receivable and lease receivable. For lease receivable it is optional, but for trade receivable it is mandatory. Are you getting what I am saying? Means for trade receivable I apply always what? Simplified approach. Simplified approach means what? There is no need to measure 12-month ECL, lifetime ECL. Always apply what? Lifetime ECL. Lifetime ECL. A simplified approach has been given. Simplified approach has been given for trade receivable and for lease receivable. If the questions say about lease receivable, then apply what? Lifetime ECL. But general approach say that there are three stages. How many stages? Stage 1, stage 2, stage 3. Stage 1, stage 2, stage 3. Stage 1 may we apply 12-month ECL. Stage 2 may we apply lifetime ECL. Stage 3 may we apply lifetime ECL. So now we need to understand what is stage 1, what is stage 2, what is stage 3. Stage 1 means what? When the credit risk has not increased significantly since initial recognition. Means the risk has not increased. Means nothing has happened. It is a good debtor, I will say. Good person. So nothing has happened. So it is what? Stage 1. When the credit risk has not increased significantly since initial recognition. Okay. Stage 2 means what? Something happened, default happened, and the credit risk has increased significantly since initial recognition, but there is no objective evidence of impairment. Means if it become a doubtful debtor, but it does not mean he will not pay. So there is no evidence of impairment, but it become doubtful. It become doubtful debtor. So it become what? Life will apply what? Stage 2. In this will apply lifetime ECL. Lifetime ECL. Stage 3 means what? Now we got some evidence of impairment. Now we got some evidence of impairment from some information from the market about the financial condition of that person. Suppose he was declared insolvent, so it means what? Now evidence of impairment, so it becomes stage 3 and we call it what? We call it what? Impaired financial asset. Impaired financial asset. So stage 1, stage 2, 3 you have understood. So stage 1 means what? 12 months. Stage 1 means what? 12 months. Stage 2 means what? Lifetime. Stage 3 means what? Lifetime. Stage 1 means what? When the credit risk has not increased significantly since initial recognition. बोलो ना, credit risk has not increased significantly since initial recognition. Stage 2, when the credit risk has increased significantly since initial recognition. and there is no objective evidence of impairment. Stage 3 means what? There is an objective evidence of impairment and it become a impaired financial asset. Impaired financial asset. This much you understood. So now I hope you have understood when to apply 12 months, when to apply lifetime, when to apply lifetime. Chalega. So this is the basis of this chapter, but the formula remains same. From exam point, this is the formula. Formula, have you understood? This is the formula. This is one very good question. I think I have taken or not taken, which is not yet asked in exam. I think I have not taken, but you can understand by your own. Correct. So I will say there are 5-6 questions. Do it by your own. Okay. Chalega. Any doubt? This everything is given. Now if you have understood that whatever I have explained, you can understand everything. Okay? This is all point you can understand. Now there is one rebutable presumption for this. This may be important for MCQ for stage number 2. What they are saying? If any receivable become overdue, means 30 days pass, means it become overdue by more than 30 days. More than 30 days. So there is a rebutable presumption that will assume that risk has increased significantly since initial recognition. Correct? So what they want to say, suppose default happen yahan par. So on this date we don't come to stage 2. When it become overdue by how many days? 30 days. So on this date we come to what? Stage 2. So once it become overdue, past overdue by 30 days, it means we'll enter into which stage? Stage 2. Then we'll apply what? Lifetime ACL. Lifetime ACL. Chalega? Yes sir? Okay. So that is also important for MCQs. I think balance you read, you will be able to understand. Okay. Accounting treatment, very simple. When financial assets are measured amortized cost, then journal entry is what? Impairment loss account debit to financial asset. Impairment loss will be transferred to PL. Or you can say impairment loss to credit loss allowance also. But in exam I have seen they are using financial asset. Directly they are doing this journal entry. Means in exam question they are passing this journal entry. Impairment loss to financial asset. But it should be actually credit loss allowance. Credit loss allowance. बचपन में क्या ना? Bad debt account मतलब you have done PL account debit to provision for doubtful debt. He used to do PL account debit debtor. बचपन में what journal entry you have done for provision? PL account debit to provision for doubtful debt. So that only I have also done that journey. PL account debit to credit loss allowance. But in exam they are doing what? PL account debit to financial asset. What to say? They don't know anything. Okay. Chalo. But we'll not fight for this. And if the financial assets are measured FBTOCI, so can you say already the entire loss has been transferred to OCI. So out of that, some loss will be now recycled to PL to the extent of impairment loss. So what journal entry will do? Impairment loss account debit to OCI, FBTOCI reserve. Because can you say first we'll do fair value accounting? First we'll find out carrying amount na. So already the loss has been transferred to what? FBTOCI reserve. So out of that reserve, now some loss will be reclassified to what? PL to the extent of what? Which amount? Impairment loss amount. So what journal entry will do? Impairment loss account debit to OCI. Means this is nothing but reclassified from OCI to PL. Right. This also done. Now, topic number 7. Coming to derivative finance instrument. From exam, totally from exam point of view, only one question they have given. Only one question. Now from exam point of view, no discussion required because now you know about derivative finance instrument with AFM also. Okay. Suppose you started only with FR in regular class, then to that time you were not knowing about derivative. So for teaching it require more time because AFM you have not done, you come directly to FR. So we need to reach first derivative. Correct now? पहले वहाँ derivative पढ़ाते, but now you know everything. कि derivative means what? When I am saying derivative, when I am saying derivative, derivative. So can I say it can be either forward contract. Forward contract means we can say it is a future, or it can be in the form of option. Option can be call option or put option. Correct. In forward contract, it is also known as forward contract. Correct. Means forward contract are of two types, future and option. When I am saying future, so can I say any entity has right to buy or obligation to buy. So other entity will have what? Right to sell and obligation to sell. This is entity A, entity B. Am I right or not? Bolo yes or no? In this what happen? One entity will have right to buy and other entity will have what? Obligation to sell. Means only one entity has a right. In this, one entity will have a right to sell, another entity will have what? Obligation to buy. These are derivative instrument. Now whenever there is a derivative instrument, so from accounting point of view, it can be of two types. One is held for the purpose of trading, one is held for the purpose of hedging. Held for the purpose of hedging. So held for the purpose of trading and held for the purpose of hedging. Now held for the purpose of trading means FBTPL. FBTPL means the initial recognition will be done at what? Initial recognition will be done at what? Fair value. And subsequent recognition will be done at what? Fair value. Any difference will be transferred to what? PL. Correct. Can you see, you all know that in future, can you say, whenever we purchase any future contract, so we need to pay any consideration. Whenever we go for any future contract, whether we pay any consideration? No. But whenever we purchase any call option, put option, we need to pay what? Some consideration. That amount is what? Premium. So can you say, in this case, initial fair value, in case of future, it will be nil. And in case of option, it will be with an amount equal to what? Premium, with an amount equal to premium. This is the concept. I will take directly that question which have been given in ICAI study material. Only one question, this question they have given. Super easy. Super easy question. Already asked in exam for 8 marks or 10 marks. On 1st Jan 2001, Sam Company Limited agreed to purchase US dollar 20,000 from JT Bank in future. So they want to purchase what? 20,000 US dollar from JT Bank in future on 31st December 2001 at a rate equal to 68 per US dollar. But this 68 is what? What we call? We call it forward rate. We call it forward rate. This is not a spot rate. This is forward rate. Same company limited did not pay any amount upon entering into contract. It means it is a future contract. Correct now. Same company limited is a listed company in India and prepares financial statement on quarterly basis. Whenever they say in this way, so each quarter end will be recognition date. Each quarter end will be subsequent recognition date. Okay. Following the principle of Ind AS 109, you are required to record an entry for each quarter end date till the date of actual purchase. So they want to actually purchase dollar. For the purpose of accounting, please use the following information. As on first quarter end 25,000 negative means this is negative fair value. Negative fair value means it is favorable, unfavorable. Unfavorable means we have an obligation to pay. We have an obligation to pay. Then as on second quarter end become 15,000. This is also negative fair value. Correct. Then it become 30th September positive fair value. Then spot rate become what? 66. So you decided means you contract to purchase 68. But now the spot rate becomes 66, but the favorable, unfavorable. Unfavorable means you have an obligation to pay. How much amount? 2 rupees. So it is 20,000 into 2. So it means now what is the fair value? Fair value is 40,000 negative. 40,000 negative. Correct. Understood. Means can I say in this way? Initially what was the fair value? 0. Then it become what? So there is a loss of what? 25,000. Then again it become what? 10,000. 15,000. Then again it become 15,000. So your liability decreases from 25 to what? 15. So there is a gain of 10,000. Then it become what? 12,000 positive. So once again gain how much? 27,000. then it become what? 40,000 negative. So batao, loss become how much? 52,000. So you need to pass this journal entry. Right. But what is the journal entry on the date of contract? No entry. On first quarter end, what journal entry? It is a loss now. So fair value loss account debit to derivative financial liability. Fair value loss account debit to derivative financial liability. Then second quarter end, can say liability will decrease. So what journal entry? Derivative financial liability to fair value gain. Fair value gain will be transferred to PL. Then third quarter, can you say liability also decreases and asset increases? So what journal entry? Derivative financial liability account debit. Derivative financial asset account debit to what? Fair value gain. Then once again asset become liability. So what journal entry? Fair value loss account debit to derivative financial asset to derivative financial liability with 52,000 loss. Then can I say on this date we'll do settlement journal entry. So settlement journal entry, what will be there? But what we are purchasing. So our bank will increase. Which how much dollar? 20,000. But what is the spot rate? So it will come at current fair value. So this is nothing but underlying asset. Underlying asset we recognize at fair value. Correct. 2. How much we need to pay? So we'll pay what? Rupees. We'll pay in rupees now. So it is 20,000 into what? 68. And the difference will be what? Derivative financial liability. That will be now de-recognized. Sorry, debit hoga. Derivative financial liability will be de-recognized. Understood? This journal entry will do. Super. Correct. So I think only this question is there. So that is only given. You can read it. Everything is given that only. Now, coming to hedge accounting. Hedge accounting. Now, hedge accounting, previously there was no question. So we used to say it is not important from exam point of view, but now they have given one question and that is not it asked in exam. So that only one question become important from exam point of view. Correct? Are you getting what I am saying? So previously there was no question, so we used to say chal chhod. But now they have given that one question. So either they can ask that same question or similar question. Correct? Now to understand hedge accounting what they are saying? Ki normally we do hedging for either some recognized asset or liability. Recognized assets or liability. Or we do hedging for firm commitment. Firm commitment means what? You have done one contract, you have done commitment to purchase, but till now not purchased. So it is unrecognized now. We have not done any journal entry for this. Unrecognized firm commitment. Or there may be some highly probable forecasted transaction. Highly probable forecasted transaction but no commitment. For example, can I say it is known that I will announce new batch for FR. It is highly probable forecasted transaction, but I have not given any commitment to anyone. But if I committed to you that I am going to teach you FR after 2 months, that become what? Firm commitment. Correct? And if already batch started, that become what? Recognized asset liability, because in my book there will be some receivable. There will be some receivable. So these three situations may arise. Correct? Now for these two, actually there is a risk of fair value. Means can you see, if you have some recognized asset, so you have a risk that fair value of that asset might decline. If you have some liability, there is a risk that fair value of that liability may increase. Correct now? So you have that risk. Suppose you have done commitment to purchase one machinery, you have already done commitment, to a risk that value of machinery may decline. Or you have a, understand what I am saying? So in this you have a fair value risk. But when you are saying highly probable forecasted transaction, which is going to happen in future, so there is a risk of increase in cash outflow or decrease in cash inflow. For example, in my case, when I am saying that I am going to announce a batch, if the number of students will not come as I expected, so the decrease in what? Cash flow. So this is known as cash flow risk. So this type of hedging is known as fair value hedging. This type of hedging is known as what? Cash flow hedging. Understood? However, we have one question for what? Cash flow hedging. We do not have any question for what? Fair value hedging. Fair value hedging is very simple. Cash flow hedging is also simple but interesting. But have you understood what I am saying? This much? This much you understood? So now if I read, you will be able to understand. The hedging can be of two types. Understood? Correct. There are four aspects of hedge accounting. There must be hedge item. So hedge item means either it will be recognized asset or liability, or it can be unrecognized firm commitment, or it can be highly probable forecasted transaction. And there must be an hedging instrument. So normally this hedging instrument will be what? Derivative financial instrument. We will take a derivative contract to hedge what? The hedged item. Means gain or loss of this, gain or loss of hedging instrument, gain or loss of hedging instrument will offset a gain or loss of what? Hedge item. This is the objective. Objective is this. Correct? Got this point? Now, coming to fair value hedge. When I am saying fair value hedge, the accounting is very simple. Means now we have what? We have hedged item and hedging instrument. So we have a hedged item and hedging instrument. Now what hedging accounting is saying that whatever you have done till now, now you don't follow. Means don't follow any Ind AS. Follow hedge accounting. For example, you are hedging an inventory. Suppose you have an inventory and you are doing hedging for the risk of the inventory, that fair value of that inventory might decline. So for that inventory which is a hedge item, now you will not follow Ind AS 2. You follow hedge accounting. Are you getting? Suppose you have a machinery, so you will not follow Ind AS 16, you will follow what? Hedge accounting. Suppose you have a financial asset, so you will not follow Ind AS 109, whatever we have done till now, you will follow what? Hedge accounting. So what hedge accounting says that any gain or loss on both hedged item and hedging instrument should be transferred to PL or OCI. Either it will be transferred to PL or OCI. Correct? So if it is AC, FBTPL or FBTOC debt instrument, both gain or loss will be transferred to what? PL. And if it is FBTOC equity instrument, then both gain or loss will be transferred to OCI. Only this much you need to retain. Understood? Means I'll take one simple example. Suppose you have investment in equity shares, and this is FBTOCI you have already measured. Quite possible? Correct now? So you have purchased at rupees 10 lakh, and now you have a risk. Means you are thinking that fair value may decline. Means you have a risk that the fair value may decline. So can you see, you will go for some forward contract, and you will go for forward contract to sell at 10 lakh. Understood? So you will take one forward contract to sell the same asset at rupees 10 lakh. Now suppose after 6 months or whatever, the fair value become 12 lakh. Chalo, 8 lakh. Become 8 lakh. So how much loss is there? 2 lakh. 2 lakh is the loss now. But in derivative instrument, can you say you have a gain of what? 2 lakh, because you can sell at 10 lakh even the price is what? 8 lakh. So you have a gain of what? 2 lakh. So this gain will offset what? This loss. Now as per whatever we have done till now, this loss will be transferred to what? OCI. But derivative instrument, if it is FBT, this gains will be transferred to what? PL. So this will mismatch now. So this will mismatch. So either both will be transferred to what? PL, or both will be transferred to what? OCI. Understood? So what they are saying, if it is which instrument? Equity instrument FBTCI, then both will be transferred to what? OCI. Otherwise both will be transferred to what? PL. Only this much you need to retain. Suppose they ask some MCQ question, then you will be able to do it. Understood? Have you understood? Now let us come to cash flow hedge. Cash flow hedge. So cash flow hedge, they will give you some highly probable forecasted transaction. Highly probable forecasted transaction. So what this IND AS 109 says that for any highly probable forecast transaction, there is a cash flow hedging, and if the cash flow hedging is ineffective, then all the gain or loss will be transferred to what? PL immediately. So gain or loss on hedging will be always transferred to PL. Now what is ineffective? I will explain. But if the hedging is ineffective, the entire gain or loss will be transferred to what? PL. But if the hedging is effective, then this gain or loss will not be transferred to PL immediately. It will be accumulated in a separate component equity known as what? FBTOCI through OCI. So this gain or loss on hedging instrument shall be recognized in OCI and accumulated in a reserve known as what? Cash flow hedge reserve. Cash flow hedge reserve. Correct. Then we need to understand what is the subsequent accounting of this cash flow hedge reserve. Subsequent accounting of cash flow hedge reserve. So what they are saying, if this hedging transaction will result in any non-financial asset or non-financial liability. If this hedging transaction will result in a non-financial asset, non-financial liability, for example, machinery or any other non-financial liability, then this cash flow hedge reserve will be removed and will be adjusted with the carrying amount of that non-financial asset or non-financial liability, means it will not be transferred to PL. But in any other case, means when it will not result in any non-financial asset or non-financial liability, then this cash flow hedge reserve will be reclassified from OCI to PL. Then it will be reclassified from OCI to PL as reclassification adjustment. This is the concept given. Understood? So let me take one question, then only thoda you will understand. And that question is important also from exam point of view. Let me take that question only. This question, newly introduced, till now not asked. Beside construction activity, Building and Company Limited is also engaged in the trading of copper. In the trading of copper means copper is inventory. Correct. On 1st April 2001, it had 100 kg of copper, costing rupees 70,000, totaling rupees 7,000. This becomes the cost price of copper. The company has scheduled delivery of these 100 kg of copper to its customer on 30th September 2001 at a rate of $100 on that date. So it means from this it is understood that is an expected transaction. They have scheduled delivery. Correct. It is an expected transaction, highly probable transaction. To protect itself from a declining currency exchange rate, because they will get the price in dollar, so they have a risk that dollar rate might depreciate. Yes or no? So to protect itself from the declining currency exchange rate, the entity hedges its position by entering into currency future contract for equivalent currency at 76 per US dollar. This is a forward rate. Understood? Correct. So they will intend to buy dollar or to sell dollar? To buy dollar or to sell dollar? First we need to understand that. I think you know about this concept, huh? To buy dollar or sell dollar? Sell dollar. Why? Because this is declining. Whenever your expectation is rate will decline, always you go for what? Sale contract. Whenever you are expecting that price will increase, you will go for what? Buy contract. So you will enter into to sell what? $100 at rupees what? 76. The future contract mature on 30th September 2001. Then this para you read, this is all bakwas. On the same day means on 30th September, it also sell the inventory of the copper at $100 when the spot rate was 72. So spot rate on 30th September is what? 72. Then this also you read, not important. Assume the exchange rate is as follow, and yield rate is 6% per annum. But why they have given yield rate? Why they have given yield rate? For using the discounting. So they have given, so you need to find out some discounted amount. You can see now they have given future price for 30th September 2001 delivery. First April it was 76, then 30th June it becomes 74, 30th September it becomes 71. It means 30th June will be one quarterly. So you need to do, I think they have given also the, you need to do first quarter ending also. So it means we need to assume that they are following interim financial reporting. Okay, chalega. This is the entire question. What is the date of contract? Then what 38? Then what 38 September 2001. So there was a inventory whose cost price is what 7,000. Understood? Correct. And they decided to sell at what $100, and they have entered into a forward contract to sell $100 at what 76. So what is the forward rate? Here 76. Here how much? 74 and then 71. 74 and then 71. I think you all know because you have done AFM. So okay, this is 6-month forward rate. This is 3-month forward rate. And this is 0-month forward rate. 0-month forward rate. Correct now? This to all terminology you know na. So my question to you all, because you have done AFM, my question to you all, on settlement date, but the forward rate and spot rate should be different ki same? Same only na. It should be same, but they have given what? 72. Means they don't know how to create question. 1 second, there is some typo mistake I will say. But will not fight with the question. Don't fight with the question, huh? First thing to learn this thing. Because you have done AFM, so now you are conceptually strong in this chapter. Yes or no? Are bol de yes. So because of AFM, only if I am teaching FR, then you might not be knowing about this. Then chalo ratwa do. But once you have done AFM, you know this na. So in exam, you know FR, AFM both. You will stuck. Ye kaise ho gaya? Don't fight. Carry on. Carry on. Okay. Now, okay, first we need to find out fair value of forward contract. Normally in FR exam, they give fair value of forward contract. But this question, they have not given fair value of forward contract. Last question, they have given fair value, if you remember. In this question, they have not given fair value of forward contract. So first we need to find out fair value of forward contract, and therefore I like this question personally. In this thoda sa AFM concept also. Now with AFM, so you know everything. You have done this type of question AFM. I don't know whether you have this type of question. Huh? Where you find out fair value of forward contract, then find out gain or loss. ऐसा करते हो? You have done AFM or not? I'm asking whether this type of question you have or you don't have. Huh? Hai? This chapter you have. Foreign currency, forward contract, ऐसा कुछ chapter हुआ करता था. I तो forgotten. चलो ठीक है. Now, can you say, just try to understand. What is the fair value यहाँ पर? यहाँ पर तो नील है. On this date. यहाँ पर it becomes 76. Now it becomes 74. But it is favorable and unfavorable. We have entered into a forward contract sale at 76. Now it becomes 74. Favorable and unfavorable. Huh? Unfavorable. Favorable and unfavorable. Unfavorable. तब तो लोचा है. अब तो फिर मेरे को पढ़ाना पड़ेगा. I'm assuming that this you all know from AFM. अरे भाई, you have decided to sell at what? 76. Now the price becomes 74. So you will sell at 76 only, na? Favorable and unfavorable. Think in this way. थिंक इन दिस वे, थोड़ा सोचो, सोचो एंड करो. अंडरस्टूड ना. I will just say one simple way what I used to do when I was a student, because this chapter is थोड़ा सा confusion, कभी favorable कभी unfavorable, market price, exercise price, थोड़ा सा confusion. So what I have decided means, what I used to do, कि to sell contract means when the price is declining, so will if the price is declining means to sell contract. When the price is going high means my expectation price will go high, it is favorable, it is what, buy contract. So buy contract means favorable only when price is increasing, because we are seeing high now. So when the price is increasing means what? Favorable. When the for sale contract, if the price is decreasing means what? Favorable. So when I sell see नीचे, नीचे favorable. When I buy means what? ऊपर, ऊपर means what? Favorable. This was one when I was student, that time, not now. So it is sale contract, तो नीचे जाया ना, नीचे. It is favorable only. Understood? Correct? Yes, sir. तो बताओ, this become what? 100 into 2, it become 200, and here it become 100 into what? Once again favorable 5. How much? 500. But can they have given discount rate? Because can you see, this is the price, this is the price which is which is what? Receivable on this date. This is recoverable on this date. This is recoverable यहाँ पर. So this is 0 month. This is 3 month. This is 6 months. What is the discount rate they have given? 6% per annum. So what is per quarter? 6 by 4. How much? 1.5 per quarter. So can you give me the discount rate by using 1.1, 1.5? So this will be 1. This will be what? 0.985. This will be 0.971. Understood why I am doing 1 like this? Backward. Backward, understood why I am doing? Same question is going to come in exam. समझ ले? 1 second. 1, understood why I am doing? बोलो ना yes sir, then only I will proceed. How can I understand? This 0, this is what? 200 into 0.985. How much? 190. This is 500 into what? 1. 500. So this become fair value. So this become fair value gain. This become fair value gain. Are you getting? So 0, and what is the gain of this? 190. What is the gain of this? 3. 197. 197 कर दो. 500 minus 197 is equal to 303. So with this now you will do accounting. What is journal entry I am explaining? First journal entry, no journal entry. Then on 30th June, what journal entry? You will say derivative financial asset account debit to OCI cash flow has reserve. How much? 197. It will be transferred to OCI and accumulated in what? Cash flow has reserve. Then on 30th September, once again derivative financial asset to what? OCI cash flow has reserve. How much? 303. So now it becomes derivative financial asset. Now this contract will be settled separately and we receive how much cash? Now how much cash will be collected? Bank account debit to derivative financial asset. How much? 500 will be collected. Understood? And now we'll do sale also. Sale will be done at $100. So what journal entry of sale? Batao. Receivable or bank, whatever. Account debit to revenue. Account debit to revenue. So this is $100 into spot rate. This will be at a spot rate. So it will be 72. This becomes 7,200. 7,200. Understood? Now, batao, this transaction result in a non-financial asset or financial asset? This transaction resulted in a non-financial asset or financial asset? Non-financial asset. Where is non-financial? Receivable, nalayak. Where is the non-financial asset? Inventory has been sold, Ray. Inventory has been sold. The transaction is for sale, not for purchase of inventory. Purchase of inventory, then inventory is what? Non-financial asset. We are selling inventory. So what is accounted? Receivable is accounted ना. ये देखो ना यहाँ पर कि this transaction result in inventory or receivable? Receivable is what? Financial asset. Therefore, now cash flow has reserve will be reclassified to PL. So what is the last journal entry will do? Will do OCI cash flow has reserve which will be reclassified to revenue. You can say revenue means PL na. PL. How much? 500. And your revenue will be what? 7,700. 7,700. If suppose this transaction result is non-financial asset, suppose it is inventory or machinery or any other asset which is non-financial asset, then you need to adjust with the carrying amount of what? Non-financial asset. Then close cash flow has reserve account. Do not reclassify to PL. Adjust with the carrying amount of what? Non-financial asset or non-financial liability. Because they have given this question, so I am only explaining this point. Because same to same question will come in exam. Easy only na? Understood? Correct? Yes, sir. This also you have understood. Hedging also, I think this much only. When I am saying ineffective, ineffective means what? Just try to understand. This type of question can be asked in MCQs. Ineffective means what? Ineffective means what? Suppose we are expecting right now we will purchase. In this question we are expecting we will sell inventory. But after some point of time, after taking hedging instrument, derivative instrument for hedging purpose, we decided now we will not sell. So if you are not selling, so there is no risk only. There is no risk. Okay, there is no use of derivative instrument. If there is no use of derivative instrument, then hedging become ineffective. Then any gain or loss of derivative interest will transfer to what? PL. So once it become ineffective, all the gain or loss will not be transferred to OCI, it will be transferred to what? PL. So I have just given one point so that you can retain. Ineffective means what? Transfer to PL. Effective means transfer to OCI and accumulated where? Cash flow has reserve. Important for MCQs also. Done. Done. Only last point is left. Topic number 9. We'll take a break, and after break we'll discuss this. Topic number 9 is what? Small concept of this chapter. From this also question can be asked. It does not mean question cannot be asked. In one of the exam, the last concept of this chapter, one question was asked. That is financial guarantee. Financial guarantee. So all topics are important. We don't know from which they are creating question. Any question whatever coming exam, that is important topic. So this will do after break. 20-minute break. Okay. Brain become Hello. Sure. Sure. Can we start once again, everyone? Okay, sir. Now come to the last topic of this chapter, miscellaneous concept. In this we have how many subtopics? You can see I think 10 subtopics are there. How many subtopics? 9 subtopics are there. The first is embedded derivative. Embedded derivative. Now what Ind AS 32, sorry, Ind AS 32 says that whenever there is some derivative which is inserted, embedded in a non-derivative host contract, then such derivative require separation if three conditions are satisfied. Not always. If three conditions are satisfied, means there will be one hybrid contract and there will be two components. One is derivative, one is non-derivative. So whether to separate or not to separate, that depends upon how many conditions? Three conditions. But this separation will be done in the books where the host contract has been classified as financial liability or equity instrument. Means what they want to say? The first condition is that whether it is a financial asset. If it is a finance, means which contract? The host contract. If the host contract is a financial asset, then no separation required. No separation required. Normally can I say, whenever there is a financial asset, so in the books of holder we are not separating compound financial instrument also. So when there was a compound financial instrument, separation was required in the books of the entity who has issued that contract. So normally in the books where it is a financial liability or equity instrument, so we do separation only in that books. So what they are saying, it is not a financial asset, means it will be either financial liability or equity or compound financial instrument, then separation required. After that is one more condition, is the economic characteristics and the risk of the embedded derivative are closely related to those of the host contract. If the answer is yes, then separation is not required. Means if the answer is no, means if the risk of embedded derivative are not closely related with the host contract, then separation required. The last, which is more important, is the hybrid contract is measured at FBTPL. So if it is measured at FBTPL, then separation not required because derivative will be also FBTPL. Hybrid is also FBTPL. Then why to separate? Means if it is not measured FBTPL, then separation required. So these three conditions might be important from MCQ's point of view. First is what? It is not a financial asset. Correct? The host contract is not a financial asset. Second is what? Economic characteristics and risk of embedded derivative is not closely related with the host contract. Second condition understood. Third condition, the hybrid contract is not measured at FBTPL. Then all these three conditions satisfied, then separation required. The formula is very simple. Can I say normally the examples of this embedded derivative is hybrid contract are callable preferences, or we say callable debentures like this. When I am saying callable preferences, so can I say call option has been added? Call option has been added. Now the question is that should we separate it? Yes, we can separation required if all that three condition is satisfied. Because from exam point of view, whenever this is separate, so always that three condition is satisfied. So it will be assumed from examination point of view that three condition has been satisfied whenever they ask separation of embedded derivative from host contract. So simple the formula is what? Whatever proceed you have received. So proceed you have received for hybrid contract. So this become fair value of hybrid contract. Correct now. So this will be equal to fair value of what? Host contract plus minus fair value of what? Fair value of embedded derivative. Embedded derivative. Now just try to understand. If I am saying call option, if I am saying callable preference shares, the call option is right to buy. The right to buy will be held by entity or it will be held by the holder of that instrument. Means if I am saying callable preference here, so one is preference holders, one is entity. So that call option will be held by entity or preference holders. Entity, it means the holder of call option is entity. So entity will pay premium or receive premium. Holder will pay or receive? Holder will pay premium. It means, can you see, in that case they will pay premium to what? Preference holders. And for the host contract they are receiving some consideration. So for host contract they are receiving, and for call option they are paying. So both are will do plus ki minus? Will do minus. So if there is a call option, will do what? Minus. So this become one formula, because they will ask callable preferences only, therefore I have given this formula. So this become one formula for the examination perspective. Ki proceed is equal to fair value of host contract minus fair value of call option. Okay, fair value of call option will be given in the question. And suppose this is compound financial instrument, so this will be equal to fair value of liability component plus fair value of equity component minus fair value of call option. This become one formula. So you can apply this formula, because can fair value of liability component you can calculate. Fair value of liability component will be present value of all contractual cash outflow discounted by using market rate of interest. So this you can calculate, and then you can find out this. So this is one question. The question, I have taken one question also, because this question can be asked in exam. Till now I don't think so it has been asked in exam. So one question, this कि D Limited issued callable preference shares to G Limited for a consideration of 10 lakh. This become proceed. The holder has an option to convert these preference shares at a fixed number of equity instrument of the issuer any time up to a period of 3 years. If the option is not exercised by the holder, the preference shares are redeemable at the end of 3rd year. The preference shares carry a coupon RBI rate plus 1%. The prevailing market rate of interest without the conversion feature and redemption option, RBI base rate plus 4%. Now they have given RBI base rate is 9%. What is the contractual rate of interest? 10%. What is the market rate of interest? 13%. On the date of contract, RBI base rate is 9%. The value of call by using Black and Scholes model for option pricing is 29,165. The call option value they will give, because that is AFM subject, not FR subject. So we can't apply Black and Scholes model in our paper, correct now? So they will give fair value of call option. Okay, now you can do it. Okay, so you can apply this formula. Formula is very simple. This is 10 lakh. This you can calculate. This is the balancing figure, and this become 29,165 now. 29,165, correct. So you can calculate these. So this will be balancing figure. Simple. This type of question they will ask for 5 marks. In this there is one more point for which some question has been given in ICAI study material, but till now not asked in exam, about a contract to buy or sell in foreign currency with an entity having same functional currency. So I'll take that question. What I want to say, suppose there are two companies, A Limited, B Limited. Now their functional currency is INR and their functional currency is also INR, but they have done one transaction in foreign currency, correct now? Means they have done one transaction for sale or purchase of any equipment in foreign currency. So one doubt will come, why they have entered into foreign currency transaction when the functional currency of both entity are what? INR. So it means they want to make some short-term profit in what? Dollar. It means this become one embedded derivative. This become an embedded derivative. For example, A has done one contract to sell machinery at $10 lakh. $10 lakh. So what they want to see, there are two contracts from A's point of view. One is host contract to sell machinery in INR, and there is one derivative contract to buy To buy or to sell? To buy or sell foreign currency? To buy or sell? Now one second, just try to understand. Suppose, just try to understand. If I sell this mobile and I receive currency, suppose I receive some dollar from you. But I am selling what? Mobile, and I am purchasing what? Dollar. Nah. So if I am saying I want to sell what? Machinery. By receiving what? Dollar. So I am buying dollar, I am selling dollar. I am buying dollar, not selling dollar. Okay? Understood? Contract समझो. To sell machinery at 10 lakh dollar. So 10 lakh dollar you receive from whom? B Limited now. It means you have an intention to sell dollar, you have an intention to buy dollar. After buying, so you will sell it only. But first you are buying, first you are selling. Buying. Understood? It means there is a derivative contract to what? Buy. How much dollar? 10 lakh dollar. 10 lakh dollar at some forward rate. At some forward rate. That forward rate will be given the question. So there are two contracts. One is sale contract, one is embedded derivative. So that need to be separated. From, can I say, B's point of view. Suppose same question they ask from B's point of view. So there are two contracts. One is purchase of equipment in INR and to what? Buy or sell. To sell how much dollar? 10 lakh dollar at what? Forward rate. So be careful whether they have asked from A's point of view, B's point of view. Always give reverse. If this is sale, so this will buy. If this is buy, so this will be sell. Understood? So one question I like to take. You have understood the concept. You understood? This question. Company A, an Indian company whose functional currency is rupees, enter into a contract to purchase machinery from unrelated local supplier, Company B. The functional currency of Company B is also rupees. So both are rupees. However, the contract is denominated in US dollar. Since the machinery is sourced by Company B from US based supplier, payment is due to the Company B on delivery of machinery. Key terms of the contract. Contract date 9 September, delivery date 31st December, purchase price 10 lakh US dollar. Then they have given forward rate on 9 September for 31st December 2001 maturity 67.8. Then they give spot rate on 9 September. Then they give forward rate on 31st December. On 38th September. So 38th September will be what? Reporting date. Correct. 67.5. Then 31st December spot rate 67. Company is required to analyze the contract, give journal entries. So what they want to say? But what is the contract date? 9 September. Then there is one reporting date 30th September. Then this one 31st December. What is the spot rate on this date? 9 September. What is the spot rate? 66.4. What is the forward rate? 67.8. What is the forward rate यहाँ पर? 67.5. What is the spot rate यहाँ पर? On this date both will be same only. Correct. Now there are two contracts. One is host contract. But what is the host contract? To buy now. To buy or to sell? To purchase. To purchase machinery. To purchase machinery at INR. That is equal to 10 lakh dollar multiplied by what? बताओ. Multiplied by which rate? Multiplied by using forward rate 67.8. Sorry. So this become how much lakhs? 78 lakhs. Correct. Then there will be what? One forward contract to sell what? 10 lakh dollar at what? 67.8. But what journal entry will do on 9th September? No journal entry. What journal entry on 30th September? तो बताओ, this is favorable, unfavorable. Favorable, unfavorable. बताओ, to sell, to buy. बताओ, increasing, decreasing. तो favorable ना. फिर apply concept. Concept also I can give. सुनो ना, फिर देखो कुछ रूल बताया, फॉलो करो. आई नो हियर स्टूडेंट मिस्टेक इन एग्जाम तो पक्का एग्जाम हॉल नहीं चलता, यू नो ब्लैंक हो जाता, यू विल ब्लैंक. आई हैव ऑल्सो बिकम इन वन ऑफ द एग्जाम, आई ऑल्सो बिकम ब्लैंक इन लॉ एग्जाम. पूरा टोटली ब्लैंक हो गया था, टोटली ब्लैंक. इंटर में कॉस्टिंग एफएम टोटली ब्लैंक, इन फाइनल वाट लॉ ब्लैंक, स्विच ऑफ हो गया. अंडरस्टूड? इट हैपेंस विद एवरीवन. One exam will be totally blank. That time you need to only control your emotions. You need to once again come back in exam hall. It will happen. It will happen with you also. Out of 6 paper, 1 paper तो सब जाएगा. Correct. So at that time there should be some rules. So come back, think and then start. ठीक है ना? तो नहीं चलता एग्जाम में, नहीं चलता है ना? अरे बोलना रे. ठीक है, देखो देयर शुड बी सम स्मार्ट वर्क. ठीक है ना? तो 67.8 इट बिकम 67.5. तो हाउ मच डिफरेंस? 0.3. 0.3 into 10 lakh how much? 3 lakh. So what journal entry? Derivative financial asset account debit to fair value gain, and this gain will be transferred to PL. How much? 3 lakh. Understood? Then batao. Now no more journal entry. And then on 31st 12 बताओ, again there is a favorable, unfavorable, favorable. So it become what? 7 lakh. 7 lakh ना? Sorry, 8 lakh. It become 8 lakh. 8 lakh. So 3 lakh now become 8 lakh. How much gain again? So derivative financial asset account debit to fair value gain transfer to PL. How much? 5 lakh, 5 lakh. This to you understood? Correct. Now can I say on this date you will do actual purchase? Actual purchase, you will purchase what? Equipment. What was the? Machinery na? So machinery account debit to payable. To payable. Batao, this will be done at what? Forward rate. So 10 lakh into 67.8. How much? 678 lakh. 678 lakh. Understood? Now, can I say in derivative you are receiving some amount. In this derivative contract you are receiving or paying, and in this host contract you are receiving or paying to the same party, and therefore one net amount is payable. Therefore, what India is saying that this will be adjusted with this amount. So, batao, what next entry will do? Payable will decrease na. Payable will decrease by what? 5 lakh. To what? Derivative financial asset 5 lakh, and sorry 8 lakh, my mistake. 8 lakh. 8 lakh, and ultimately you are paying how much? 670 lakh, which is nothing but based on spot rate only, which is based on spot rate. So this become what? I will say beautiful accounting. Accounting understood? Accounting substance of the contract. This is what substance of the entire arrangement. Understood? So actually you are paying what? 670 only, but out of that some is accounted on derivative, some is accounted on purchase of machinery. Got this point? The same journal entry is given. So from my point of view, this question not yet asked. Anytime can be asked in exam. Anytime. Chalega? Yes sir. Done. In derivative also done. This all I have given. Then executory contract. Now in this only one point. When I say executory contract, just try to understand. Suppose there are two companies, A Limited, B Limited. A Limited, B Limited. They have entered into a forward contract to buy or sell equity shares of Reliance Industry Limited. To buy or sell equity shares of Reliance Industry Limited on future date. So this become a forward contract. Either it will be cash settled or it will be physically settled. Physically settled means what? Either you will do settlement net in cash with only fair value, or you will do actual purchase of shares. So both are covered under IND AS 109, and can you see this will be also a derivative instrument. And IND AS 109 is applicable. I think in this no doubt. Why? Because this equity shares of Reliance Industry Limited is a financial asset. But one doubt will come, if A and B has entered into forward contract to buy or sell a PP, property plant and equipment, which is a non-financial asset, correct? To buy or sell in a forward contract after 6 months. Okay, this can be also settled in cash, or it can be physically settled. So what IND AS is saying, that this is a derivative contract and IND AS 109 will be applicable. But this is not covered under IND AS 109, because this is what? Receipt of non-financial asset. So whenever there is a contract to receive or exchange non-financial asset, this is outside the scope of this chapter. For this, IND AS 37 will be applicable, and when this will become onerous, if you remember, when the executory contract become onerous, then IND AS 37 is applicable. So for this, IND AS 37 is applicable once it becomes onerous contract. So we'll do IND AS 37 also, then this point will be automatically covered. Chalega? Yes, sir. This is done. Now the next point is the point relative definition. One point we left in definition. Remember, point number E of financial asset and point number C of financial liability. So that is nothing but this point: instrument that will or may be settled in entity's own equity instrument. So what they want to say? If means this has divided into two parts: non-derivative contract and derivative contract. So what they are saying, if it is a non-derivative contract for which entity is or may be obliged to receive, correct? Entity is or may be obliged to receive variable number of entities own equity instrument, or is obliged to deliver a variable number of entities own equity instrument. Then if they are receiving their own equity instrument, it will be financial asset. But if they are delivering their own equity instrument in variable number, it will be a financial liability. Let me explain in this way. Let me explain this way. Suppose there is one optionally convertible debenture. Correct? Optionally भी हटा दो, compulsory कर दो. Compulsory convertible debenture. Correct? Understood? So can I say it will be converted in future? Now it can be converted either into fixed number of entities equity shares, or it can be converted into what? Variable number of entities own equity shares. For example, when the contract was done, the proceed was 10 lakh. It was already mentioned that we will going to issue 1 lakh equity shares of rupees 10 each. This can be one contract. Or it is mentioned that we will give you equity shares worth rupees 10 lakh based on the market price of equity shares on the date of settlement. So this become what? Fixed number. This become what? Variable number. So what IND AS 32 says that this will be considered as what? Equity instrument. And this will be considered as what? Financial liability. So whenever settlement is done in variable number of entities own equity instrument, whenever settlement is done on what? Variable number of entities own equity instrument, it will be classified as what? Financial liability. Otherwise it will be classified as what? Equity instrument. This is the rule. Rule you have understood? So rule is what? Whenever a question comes, till now this type of with variable number they have not given any question for compound financial instrument. Means they may give this type of question also. Correct now. So whenever question comes, so always think about 2 points: consideration and number of equity shares. If both are fixed, so it will be equity. We call it what? F2F test. So when fixed to fixed test is satisfied, it is what? Equity. Or if both are variable, or one is variable and other is what? Fixed. If this is the case, so in this case, the instrument will be initially classified as what? Financial liability. When I am saying instrument means principal component. We are discussing about principal component. Principal component will be initially classified as what? Financial liability. Understood? Correct. So this is the entire thing, means the rule which you need to follow in exam. Correct. So whenever F2F test is satisfied, is equity. When F2F test is not satisfied, is what? Financial liability. Got this point? Simple. Have you understood? Correct. Even though it is a derivative contract, in derivative contract, if also, can I say, if this condition is not satisfied, means F2F test is not satisfied, then that will be initially classified as what? Financial liability. Financial liability. Otherwise, it will be what? Equity. Chalega? Yes, sir. This is the concept. However, I don't think so this is so important from exam point, but with MCQ they may ask this table. This table which I have given. See, they will give one circumstances, they will say you whether it is a financial liability or equity instrument. So this will based on these circumstances. Chalega? This is all given the explanation of this. Putable instrument. Putable instrument. Putable instrument. Now, when I say putable instrument, what do you mean by putable instrument? Putable instrument means what? Where the holder has a right to put back the instrument, and can I say writer will have an obligation to pay the amount. Writer will have an obligation to pay the amount. Means when I am saying putable instrument, the put option will be with holder, and issuer will be the writer of that put option. So in that case, writer will have an obligation to redeem the instrument whenever who demanded? Holder demanded to. It means, can I say, in that case, it will be always classified as what? Financial liability. So putable instrument normally it is classified as what? Putable instrument normally it is classified as financial liability in the books of entity who has issued such instrument. Correct now. So putable instrument is normally classified as what? Financial liability in the books of entity who has issued such instrument. But what Ind AS 32 says that if three conditions satisfied, how many conditions? The putable instrument will be also classified as equity instrument. So what are that three conditions? Means once again, I don't know whether these are important or not important. They have given three conditions. Well, if these three conditions satisfied, then putable instrument will become equity instrument. Correct? Means this condition is nothing but a characteristic similar to equity. Means whenever putable instrument holder has a characteristic similar to equity shareholders, then it will become equity. Then it will become equity. Correct. Now what are that three conditions? Let us read. The entities, it entitles the holder a pro rata share of entity's net asset in the event of entity's liquidation. Means in the event of liquidation, they will get only proportionate amount of net asset similar to equity shareholders. Means if the net asset is zero, they will not get anything now. The proportionate amount of net asset. Are we getting proportionate amount of net asset? So it means it is similar to equity only. First condition. Second, it is in the class of instrument that is subordinate to all other class of instruments. Subordinate means they will be standing last for repayment. For the equity shareholders also stand last for the repayment. So they will be subordinate to all the class of instrument. So it is similar to equity instrument. And the last, in case of putable instrument, all financial instrument in the most subordinate class have identical features. Means can I say all putable instrument which are in subordinate class have identical features. Means they have same dividend right, same voting right. It means can I say similar to equity instrument. So if all these three conditions satisfied, so putable instrument will not be a financial liability. It will be what? equity instrument. So once again can be important for MCQs. Correct. This though is related to compound financial instrument, already I discussed. Now treasury shares. What do you mean by treasury shares? Treasury shares means what? Buyback of equity shares, and that equity share which has been bought back will not be cancelled. Means India, can we hold equity shares which has been bought back? No. As per Companies Act, we need to destroy it. We need to cancel it. It means this concept is not applicable in India. But India has been drafted from overall point of view. Means when there is an amendment in Companies Act, then so what they are saying, if you are holding the equity share which has been bought back, that is known as what? Treasury shares. Whenever you hold the equity share which have been bought back, correct, now for the purpose of reissue in future, that is known as treasury shares. So what will be the accounting treatment of that treasury shares? Well, like it is similar to what normal buyback, reduce whatever consideration you have paid for buyback from equity. In the simple general entry, bank account debit to equity, and any gain or loss on that buyback will remain in equity only. Correct. So what is journal entry? Bank account debit to equity. Bank account debit to equity. Sorry. Equity account debit to bank. Equity account debit to bank. Means अब हो गया. Means I am tired. Equity account debit to bank. Understood this point? Correct. So simple journal entry. Equity account debit to bank. Because just when I am saying equity account debit to bank, now it is as per Ind AS. But because of Companies Act, we all know the Companies Act says equity should come at nominal value. So as per Companies Act, journal entry will be equity share capital account debit at nominal value to bank, and difference will be adjusted with reserve and surplus. Correct now. So this journal entry, when I say equity account debit to bank, this is as per what? Ind AS. Because Ind AS does not deal with the nominal value of equity shares. But as per Companies Act, there is a concept of what? Nominal value of equity share capital. Correct now. So as per Company Act, journal entry will be equity share capital to bank, difference will what? Adjusted with reserve and surplus. Correct. This is for the obligation to buy this. I just want to come to last concept, financial guarantee, which is thoda sa important. Already one question have been asked, again one question can be asked, financial guarantee. Now, financial guarantee means what? See, whenever there is a parent company, means I am explaining from examination point of view, parent company and subsidiary company, and subsidiary company has taken a loan from bank. So what journal entry will do in the books of subsidiary company? Bolo? Bank account debit to financial liability. Suppose loan is 10 lakh. 10 lakh. Correct. Now for this loan, parent company has given guarantee to whom? Guarantee to whom? So whenever a guarantee is given of financial nature to offset the financial loss of this subsidiary company, this is known as financial guarantee. Understood? Correct. So they have given a financial guarantee to bank on behalf of what? Subsidiary company. Correct? Understood? So can you say for this financial guarantee given to bank on behalf of subsidiary company, can you say subsidiary company should compensate parent company? Yes or no? But because they are related to each other, so of course parent will not demand and subsidiary will not pay. Suppose for me, if my father has given guarantee, so whether he will demand some money. But if you have given guarantee, nothing is free now. Even though we are emotionally connected, but can I say we are not related now? We are related or not related? We are unrelated now. So you will demand some fair value of guarantee or not? Correct? Then it means some amount is payable by me to you. So normally what happens? They give a question of related party. If they have given question of what? Unrelated party, then of course can I say this party will compensate this party. Which amount? Amount will be what? Fair value of guarantee. Fair value of guarantee. Are you getting? But suppose it is related, means of course it is related in my example. Now the question is that what would be the fair value of guarantee? So it means we need to calculate the fair value of guarantee. We need to calculate the fair value of guarantee. So what Ind AS 109 says that in this case, the fair value of guarantee will be what? If suppose the loan would have not been, if the guarantee would have not been given to us, then the rate of interest might be 12%. And because the guarantee has been given, so the rate of interest will be 12% or more than 12% or less than 12%. Less than 12%, it will be less than 12%. Suppose they have received loan at what? 8%. So 8%, the rate of interest is what? 8%. So it will be 80,000, 80,000, 80,000. And if the loan would have been received at 12%, it would be what? 1,20,000, 1,20,000. The difference is what? 30,000, sorry, 40,000, 40,000, 40,000. So the present value of this will become what? Fair value of guarantee. Present value of this will become what? Fair value of guarantee. Understood? Discounted by which rate? This we need to understand. Apply common sense. Discounted by which rate of interest? Batao. 12%, 8%. Why 12%? Why 8% is not market rate of interest? You are correct only. Can you say, because as per subsidiary company credit risk, the rate of interest is what? 12%. Correct now. So by giving guarantee, that risk has been nullified, and therefore the rate of interest become 8%. 8% is also market rate. But after receiving what? Guarantee, the risk has been decreased. So both are rate of interest. Both are market rate of interest only. But when you eliminate that risk, then rate of interest become what? 8%. So we'll consider the risk from the point of view of what? S, and we'll consider what? 12%. We'll consider 12%. Understood this point? Correct. So of course you can calculate that will become what? Fair value of guarantee. So what journal entry in the books of parent company? Batao. So can you see it will be investment account debit to financial guarantee obligation. How much? Whatever amount is coming. This is very simple. Up to this to very simple. Now we need to do what? Subsequent accounting. So can you say this investment will remain in the balance sheet? This investment will remain in the balance sheet. But what is the subsequent accounting of financial liability that we need to understand? This financial guarantee obligation is a financial liability. For that purpose, what IND AS says that it will be higher of two amounts. Higher of two amounts. First is amortized cost. Second is expected loss allowance. Expected loss allowance. So how to calculate this expected loss allowance, that we need to understand. Means can I say expected loss allowance means what? If the default rate will increase, so of course can I say if they will default, so they need to pay. If subsidiary company will default, so parent company need to pay or not? So we need to find out what is the probability of default of which company? Subsidiary company. Based on that, we'll find out the impairment loss. As whatever we have done in impairment loss concept, that is nothing but expected loss allowance. Expected loss allowance. But can it, that will depend upon the 12-month ECL and lifetime ECL as per the information given in the question. As per the information given in the question. Means we need to find out stage 1, stage 2. This is detailed discussion. But what I'll do, I'll take one question because that question is going to ask in exam. Similar question will be asked in exam. So what they have given, check करते हैं. On 1st April 2001, Sun Limited guarantee 10 lakh loan of subsidiary Moon Limited, which bank STDK has provided to Moon Limited for 3 years at 8%. Interest payment are made at the end of each year, and the principal is repaid at the end of loan term. If Sun Limited had not issued a guarantee, then bank would have given a rate loan at which rate? 11%. Sun Limited does not charge Moon Limited for providing guarantee, means nothing has been charged. Nothing has been charged. Suppose it is given they have charged, so that only become fair value of guarantee. Then there is no need to calculate fair value of guarantee because they will charge the fair value of guarantee only now. But related party will not charge. Correct now. Means suppose it become unrelated party, so they will charge, and that amount whatever is charged, that become fair value of guarantee. Then don't calculate fair value of guarantee. I hope you are understanding. They can give question of unrelated party also in exam na, but they will not give. Chances are rare. But if they give, you should know this point. Then they have given On subsequent date, on 31st March 2002, there is a 1% probability. They have given default rate, probability of default, that Moon Limited may default on the loan in the next 12 months. This is 12-month probability of default. This probability default for next 12 months. Means 12 months is here. 12 months is here. If Moon Limited default on Sun Limited does not expect to recover any amount from Moon Limited. On 31st March, the probability of default increases from 1% to 3%. Same information given. Provide the accounting treatment for the year ended 31st March 2003. Is from the beginning till 31st March 2003. So first separate initial recognition. We'll find out cash flow based on 11%. Then cash flow based on 8%. Difference will come 30, 30, 30. We'll find out present value factor at which rate? 11%. This will become fair value of guarantee. What journal entry will do? Investment account debit to finance a guarantee obligation. Now subsequent accounting, first do one working of amortization cost table. So you will prepare one amortization cost table. What is the initial liability? This liability. Then interest at which rate? 8%. This present value you have calculated which rate? So at 11%. At 11%. Then what was the benefit? Benefit means what was the differential cash flow? Differential cash flow was 30. That was the benefit provided by parent company to what? Subsidiary company. Correct. So this is imputed benefit, you can say. So that 30,000 minus this become amortized cost of first year, then second year, then become nil. Correct. Now we'll do 31st March accounting. So on 31st March, can I say we'll find out the higher of amount of loss allowance and amortized cost. So amount of loss allowance was 1% of 10 lakh, which is how much? 10,000. And what is the amortized cost of first year? 51,385. Whichever is higher will take. The subsequent accounting will be done at what? 51,385. But the initial liability was this. Subsequent accounting liability will be this. So there is an increase in liability or decrease in liability? Increase in liability or decrease in liability? Decrease in liability. Gain or loss? Gain. So this gain will be transferred to PL and will pass one journal entry financial guarantee account debit to gain. Gain will be transferred to PL. Chalega. Then we'll come to next year 31st March 2003. Once again we'll do that higher. So higher of what? Once again higher of what? 3% of 10 lakh. 3% 10 lakh how much? 30,000. And what was the amortized cost? Amortized cost already we calculated. How much? 27,037. Now which one is higher? 30,000. So this become our subsequent liability. Now what was the previous liability? Previous liability was how much? 51,385. Now it become how much? 30,000. So once again decrease. Decrease how much? Decrease means 51,385 minus 30,000 means 21,385. This will be also transferred to PL. What journal entry? Financial guarantee obligation account debit to gain, and gain will be transferred to PL. They have asked this much only. Now in this they have not asked what last year accounting, because last year accounting will depend upon actual information whether they have defaulted or they have not defaulted. If not defaulted, entire liability will become zero and they will start dancing because there is no obligation to pay. But if they default, so now it depends upon how much they are supposed to pay. So of course if nothing is given, they will pay how much? 10 lakh. So 10 lakh plus any interest liability which is outstanding. So that will become liability. So we need to increase the liability from that amount to 10 lakh and that will become loss, and loss will be transferred to what? PL. And then when paid, will pass financial guarantee to bank. That is not yet asked, but you can do by your own. Na? Understood? With this chapter to over. This chapter over. चलो this chapter तो over. India's 37 में कर ही लेते हैं, छोटा सा चैप्टर है. ठीक है. India's one must be that point today I will not do. So that is pending. Whatever is pending I will do at the end of the now. This is the last day. India's 37 let us, can we do? You want to do ना? क्या बात है यार, आप तो मेरे से भी ताकतवर हो. I was thinking if you'll say no then चलो ठीक है, बाद में करवाएंगे. India's 37. Very simple. India's 37. Nothing to discuss much. India's 37. So Ind AS 37 discuss what provision, contingent liability and contingent asset. So first we need to understand meaning, then what? Measurement principle, recognition principle, the measurement principle and then disclosure requirement. This is the objective of this chapter. So meaning, what is the meaning of provision? Provision is a liability of uncertain amount or timing. So whenever there is a liability with uncertain timing or amount, that become what? Provision. Correct. Means can I say provisions are liability? Always all provisions are liability. Means provision are always liability. Correct? Yes sir. Of uncertain amount of timing. So what do you mean by liability? So liability means present obligation arising from past event. Present obligation arising from past event, the settlement of which is expected to result in outflow of resource. Outflow of resource. So this is the meaning of liability. So what do you mean by present obligation? Present obligation means any obligation which is probable on reporting date. Probable on reporting date means chances are more than 50%. The chances of occurrence is more than 50%. Correct? Chances of occurrence of that event is more than 50%. It means there are three conditions. If that three condition is satisfied, we recognize provision. We recognize provision means we pass journal entry for provision. What is the first condition? There must be present obligation arising from past event. Outflow of resource which is required to settle the obligation is also probable, and the amount means the amount of obligation can be estimated reliably. From examination point of view, if these two conditions is satisfied and question is silent about amount, always assume amount can be estimated, because we can estimate any amount. If nothing is given about amount, so don't say amount is not given, will not recognize. In exam, whenever amount is not given, we'll assume amount can be estimated and the provision can be recognized. Understood? Correct. I think this condition is very simple. Nowadays, these obligations are of two types. This obligation can be legal obligation or constructive obligation. Means we recognize provision for legal obligation as well as constructive obligation. Legal obligation means which is arises due to any contract or any act. Any contract or any act. Constructive obligation means which arises due to entity's own action. Entity's own action means it may be either due to past practice or any published policy or any specific statement. It may be due to past practice, a published policy or any specific statement. For example, right now if I say you, I announce one statement, if you pass, I will give you 1000 rupees. Correct. And of course, I have a binding on that part. Correct. So it means, can I say this is specific statement given in public, given to public student only na? So it means it become my constructive obligation. So for this also I am supposed to create provisions. Supposed to create provision. Understood? Yes, sir. Correct. Now, what they say that any obligation which are dependent on future conduct of business, any obligation which are dependent on future conduct of business, that will not be recognized as provision. Because can I say, in that case outflow is not probable, because that outflow may be avoided which is dependent on future conduct of business. For example, I'll give you a simple example. Suppose there is some amendment under Income Tax Act. Amendment under Income Tax Act, and for that employee required training. So because of amendment under Income Tax Act, employee required training. Yes, but that depends upon future conduct of business. It is quite possible we may hire some trained employee and training is not required. So for that training expense will not create any provision, because that is based on what? Future conduct of business. Means we should recognize only those obligations which exist independently from the entity's future conduct of business. Chalega? Yes, sir. Okay. Then legal obligation, whenever we consider legal obligation for provision, so legal obligation arises only when legislation are enacted, means when the act is enacted by the end of reporting date, or it is virtually certain by the end of reporting date that it will be enacted shortly after that. Then only we create provision for legal obligation. Means if the act is not enacted, or it is not virtually certain that it will be enacted shortly, then will not recognize any provision for legal obligation. Understood? Yes, sir. Okay. Correct. Then contingent liability means what? What do you mean by contingent liability? Contingent liability may be present obligation or it may be possible obligation. So present obligation means what? Which are arising from past event but which are not recognized as provision because either outflow of resource is not probable or reliable estimation cannot be made. Means there is a present obligation but second condition or third condition is not satisfied. Then we can't recognize provision, then disclose the fact as contingent liability. Or there is a possible obligation arising from past event. Possible obligation means what? When the chances are not more than 50%, when chances of occurrence is not more than 50%. Understood? Then for recognition of contingent liability, they say will not recognize contingent liability, require only disclosure in financial statement. We require only disclosure in financial statement. Chalega. Now coming to contingent asset, the contingent asset means it is a possible asset arising from past event. So any possible asset arising from past event are what? Contingent asset. Correct. Now for accounting treatment of for what? Contingent asset, it means which you think about inflow. Contingent asset means what? Possible asset. Possible asset means possible inflow. So what they are saying, inflow are virtually certain. If inflow are virtually certain, then it is not a contingent asset. Then it is an asset and recognize such asset. Recognize such asset. But if inflow are probable, means chances are more than 50%, more than 50%, correct now? More than 50%, but not virtually certain. But not virtually certain, then it will be a contingent asset and we should not recognize any contingent asset. It should be only disclosed in the financial statement. But if it is not probable, means chances are less than 50%, then no treatment is required. No treatment is required. Means a summary has been given. Summary is what? For outflow and inflow. Outflow and inflow. If outflow is certain, means 100%, it is a liability, it is an asset. When it is more than 95%, so it is also a liability, it is an asset. Up to this, so no doubt. But for this liability, a name, different name has been given, it is a provision. But provision is also liability. Now, if it is more than 50%, but not virtually certain, this is a liability only. But this is not an asset, it is a contingent asset. When it is less than 50%, but more than 5%, so you can see it is become a contingent liability and there is no treatment for this. And when it is less than 5%, so outflow is also when remote, then we don't disclose it as contingent liability, then ignore it, here also ignore it. Understood? Yes, sir. Then coming to measurement of provision and contingent liability. So measurement is done based on best estimate of future expenditure which is required to settle on a reporting date, which is required to settle at the end of reporting date. At the end of reporting date means, can I say it should be recognized as present value? Present value. So what Ind AS 37 says that if the effect of time value of money is material, if the effect of time value of money is material, then we should always recognize provision at discounted amount. If question has given rate of discount, so discounted amount. If suppose question has not given rate of discount, then we can't do anything. Then we'll assume that time value of money is not material and we can recognize that what? Undiscounted amount. Undiscounted amount. Understood this point from examination point of view. Correct? Correct. Now how to measure? So this also depend upon two circumstances. When the obligation involve large population, then we calculate one expected value. Expected value is nothing but weighted average of all possible outcome. Weighted average of all possible outcome. This type of question can be asked in exam. But when there is only single obligation with two possible outcome, then we take most likely outcome. I think Ind AS 115 may be discussed here. Correct now. Most likely outcome. However, this type of question they have not yet given in ICAI study matter. Means suppose 70%, 30%. There is a chances of high damages 70%, low damages 30%. Two outcome, we will take 70%, 30%, 70%. And suppose 70% chances that we need to pay 10 lakh, we will create a provision of 10 lakh. If time value of money is not material. If material, then at discounted amount. Chalega? Yes, sir. Now when you use discounting, the discount rate should be pre-tax. And any gain or loss on expected sale of asset, means suppose there is some asset which you are going to sell it, so any gain or loss on expected sale of asset should not be considered for creating provision. That should be ignored for creating provision. Chalega? Yes, sir. Okay, sir. Then these are now there are some important point: reimbursement, future operating loss, executive contract, onerous contract, and there is one point restructuring. These are important from exam point of view. Normally they can ask question based on this at CA final level. At CA final level. So first is reimbursement. Reimbursement means what? When the expenditure which is required to be when the expenditure for which we are creating provision is expected to be reimbursed by third party. Means the expenditure for which we are recognizing provision is expected to be reimbursed by third party, then that is known as reimbursement. So what the question arises, for reimbursement should we recognize any asset? The answer is very much simple. When reimbursement is virtually certain, then recognize reimbursement as a separate asset. Separate asset in the balance sheet means you can't set off with provision in balance sheet. So it will be separate asset, that will be separate liability. But in SOPL, net amount will be recognized as a expense. So in SOP we will do provision minus reimbursement, net amount will be recognized as a expense. And can you say amount of reimbursement assets should not exceed the amount of provision. So amount of reimbursement assets should not exceed amount of provision. Understood? But if it is not virtually certain, then no treatment. If it is not virtually certain, so it will not be recognized as an asset. But can you see if it is probable, then disclose. If it is not probable, then do not disclose also. Understood? Correct? So I is similar to contingent assets. Similar to contingent assets. Then for future operating loss, here is a future operating loss is based on future event. Because if I am saying operating loss, so operating loss means future business, therefore it is outside the scope of this chapter and it will be neither provision nor contingent liability. Executive contract means, can I say, it is also future performance obligation. Means both the party will perform their part of obligation future. So this is also based on future event and therefore executive contract also not covered under Ind AS 37 and Ind AS 37 will not be applied to executive contract unless it become onerous. So what do you mean by onerous contract? An onerous contract is a contract in which unavoidable cost of meeting the obligation under contract exceed the economic benefit expected to be received from that. Means if the cost is more than what benefit, so that contract become burden now. The contract become onerous. So at that point of time, Ind AS 37 will be applicable. And what Ind AS 37 says that amount of provision will be equal to unavoidable cost. Amount of provision will be equal to unavoidable cost, which will be equal to lower of cost of fulfilling the contract or any penalty payable to exit from the contract. Whichever is lower. Correct? Understood? Correct. Then they have given the meaning of unavoidable cost. The unavoidable costs are incremental cost for meeting the obligation. So any incremental cost will be considered. Means any cost related to ongoing activities should not be considered. Chalega? That you can read. Yes. Changes in provision, very simple. We need to reassess it. Unwinding of provisional amount, you know that we need to add interest every year. That interest will be borrowing cost charged to PL. Use of provision, the amount of provision can be used for the purpose for which it is created. It cannot be used for any other purpose. Restructuring. What do you mean by restructuring? Restructuring means any program which changes the scope of business. For example, sale of division, termination of division. Correct now. Closing of a business location or shifting of a business location, etc. So whenever we do this type of restructuring, it will change the scope of business. For example, I change my premises from this area to another area. So of course my number of students will be affected now. It will either increase or decrease. This is known as changes in the scope of business. So whenever you do this, whether we should create a provision for restructuring cost. Suppose right now you have decided to close down, but closing down actually may take after some year. So should we create any provision for actual closure cost? That is the doubt. Now do you have understood why we are doing this? should we create any provision right now for actual closure cost? So what they are saying, yes, if if all the condition of provision are satisfied. Correct now. Well, yes, a provision for restructuring is required when the recognition criteria of provision are satisfied. Can you say it is based on constructive obligation or legal obligation? Constructive obligation, because entity has decided to close down. So what India 37 says that constructive obligation in this case arises when two conditions are satisfied. Constructive obligation is constructive obligation arises when two conditions are satisfied. First, entity has a detailed formal plan of restructuring. Entity has a detailed formal plan of restructuring, and entity has started to implement such plan. Entity has started to implement such plan or announce the main feature of plan to the person who are affected by it. Announce the main features of plan to the person affected by it. Means they have done announcement to the creditor, announcement to the employee, announcement to the shareholders. It means they are committed to that. So in simple word, once their management is committed, will create provision for restructuring. Understood? Correct? How to measure the amount of provision? So of course the restructuring cost will include all the expenses which are directly related to restructuring. Means it will not include any costs which are associated, it will not include those costs which are associated with the ongoing activities of the entity. Chalega. This you can read. This is simple. These two conditions are important from exam point of view. Chalega? Yes sir. Scope par lena. It is not applicable to executive contract unless onerous. It is not applicable to financial instrument. It is not applicable to income tax because we have Ind AS 12. It is not applicable to employee benefit because we have Ind AS 19. It is not applicable to insurance contract because we have Ind AS 10 form not in syllabus. It is not applicable to contingent consideration in case of business combination because for that Ind AS 103 is applicable. Disclosure you can read. Done. For this all the questions you do by your own. Provision I will not take any question. MCQs do by your own. Any doubt we'll discuss. Okay, now. I think today to our target over. Financial instrument chapter and Ind AS 37. ठीक है ना? Do all the questions of this chapter. Any doubt we'll discuss. Tomorrow we'll take I think consolidated financial statement and Ind AS 24 related party. ठीक है ना? तो कौन CFS one day CFS लग जाएगा पूरा. ठीक है ना? CFS consolidated financial statement. But for CFS now this one weak point is what? Every teacher have a different style of teaching CFS. Therefore, I will teach as per my style. ठीक है ना? So don't be confused in that. ठीक है ना? Because end result will be same. But थोड़ा teaching style of every teacher will be different in CFS. ठीक है? ठीक है तो. But I will teach as per my style because I can't adapt that. ठीक है? Okay. Thank you very much. We'll meet tomorrow. Till then, bye bye. Take care. Enjoy your remaining day. Live class. I hope you are understanding and you are doing all the MCQs. Correct? Okay. Any doubt, ask me in the comment box. Where are you? 1 minute. Let me see. Okay. Ask me this doubt, whatever you have asked tomorrow because already I have ended the session. So now whatever doubt is that I will ask, I'll do tomorrow. Thank you very much. Bye bye. Take care.